fun. Have you been
Yeah, look,
keeping up with the story? It caught me by surprise.
yeah,
I haven't had a chance until in the last 24 hours I started looking into it. I thought the financial the financial institutions in the US kind of recovered since the fear we had a few months ago, but it doesn't seem like it.
no, I think it's there are significant concerns, isn't it, based on the global situation that yeah, there is going to be there is a possibility of a certain collapse, or if not a collapse, a significant downturn.
Were you there? What were you doing in '08? How old were you?
I was quite young. Let's put it that. No, I was in my 20s. So
Were you following the '08 financial crisis? Do you know
yeah,
much
of
about
course.
it?
Yeah, of course.
Oh shit, yeah. Well, I think you're. There's gonna be a lot of comparisons done to this. Oh, I see Scott in the house as well. Just sending out the invites to all the speakers. But there's one interesting comparison that was made. Not sure if I think I tweeted it, and the comparison is we're going through the global financial crisis we're going through now is the GFC for crypto and for startups. And what everyone's worried about is whether it will spread to the rest of the markets. So to the rest of the financial system. So that was a really interesting comparison. Scott, how are you? Let me send out the co-host invites.
Doing
How are you,
doing
man?
well, buddy, man. Kind of a crazy day as you guys are talking about, but glad to be here with you.
That was. Am I a bit naive in not expecting this? I know I didn't expect. Yeah, in crypto, Silvergate didn't catch me by surprise, and we were I got a lot of hate in the crypto space when we did a space with one of the executives from Silvergate, and we put him on the spot. So and eventually the press covered it. So we had one of the executives from Silvergate Bank come onto our space during the FTX saga. We started ringing the alarm that we were a bit concerned. It was a really good space that we did. But I got a lot of slack from the crypto space about it. And then obviously now they've just gone bankrupt, haven't they? They filed for bankruptcy, haven't they, Scott?
Yeah. I mean, I think that I'm not sure if the status is actually Chapter 11 yet. I can't recall, but they definitely have closed down and are moving in that direction. As for whether you're naive or not, I mean, Bitcoiners can scream from the top of the mountaintop that banks are scams, but I don't think anyone actually expects it to happen in real time, especially after witnessing Lehman in 2008. I mean, I saw you were asking how old people were. I was, a bit older at that point. I was already in my 30s and experienced basically losing everything as a result of that financial crisis myself. So it's a bit surreal to see I guess, beginnings of something similar here. Uh, I mean, Silvergate was one thing. Silicon Valley Bank. It's hard. I don't like to be hyperbolic or exaggerate, but it's hard to really comprehend the gravity of this failure. I mean, the bank was just closed by by the California regulators today. Obviously, the stock isn't trading at the moment, but this is the bank for the tech industry and the bank for any VC-backed company on the not to say on the planet, but I can tell you that I've had calls with three of my very close friends who I went to college with who are being materially impacted by this in real time, who had withdrawal wires going out this morning that have yet to hit. And then seeing this news, obviously, for anyone who's, an FTX or Voyager, or any of these, probably gives you a bit of PTSD. But like, we're talking about any Series A through E venture backed company that's earnings. It's not making money. They're building something. They've been invested by VCs. They're not going to make payroll. It's over. Like, assuming, I'm not saying if this happens and there's a collapse and it goes into a Chapter 11, there's no immediate liquidation of the existing assets. Those people don't make payroll. Those people don't have a company anymore. There's no money. And what's insane is I'm talking to people about it. It's not only that obviously those companies miss payroll or have no cash, right? They're burning through cash on a daily basis. Most of their lead investors and the huge investors that invested in all of these companies also have their banking at Silicon Valley Bank. I mean, it's hard to express how awful this actually is.
Before we talk about what could happen next, and while we wait for more people to join and for the speakers to come up, um, what led to the bank's failure? I'm referring to the Silicon Valley Bank.
Same thing.
Can you give us a bit more overview?
Yeah, I mean, I
Tell
think
me.
that the specifics are still coming out, but it seems to be very similar to Silvergate, which is funny because, as you said, I think a lot of people we're not so surprised at the Silvergate failure because it was crypto adjacent. But once again, it had really very little to do with crypto. This is the classic example of a bank poorly managing their reserves, poorly managing their liquidity, and then there being even the slightest bank run and then not being able to meet their obligations and the bank going under. And you would think that this is a lesson that humanity would have learned by now, but not the case. I can tell you specifically with Silvergate, they effectively, or I mean, they're idiots. You obviously spoke to the guy. You were sounding the alarm. They basically put a massive part of their reserves, and everybody knows that banks are fractionally reserved. So they're only holding a fraction of the money that people deposit because they're using that money to loan. When you put your money in the bank, you're lending money to the bank for almost no interest. People should be very clear on that. And you're only insured up to $250,000 of your balance. Okay, that's where we should start. But what Silver
And what's legal? And what's the legal requirement for banks also? For every $1,000 you give them, how much do they need to
it's
hold
like
in their reserves?
$100. I can't remember if
As
it's
cash.
an eighth, a tenth. I mean, it's somewhere in that ballpark, right? For some reason, the exact number is escaping me. A seventh, a eighth, a tenth. But and so what happened was they took that and they either effectively, because of Dodd-Frank and the laws, they need to either be in cash, like at the Fed, sitting in reserve, or they need to be in certain kinds of treasuries and bonds that are approved. So what they did was they bought short-term treasuries, but they did it before the Fed started tightening, which is the worst mistake you could possibly make. So they were buying bonds that were yielding like 1 to 2%. Okay. Well, now you can go directly to the Department of Treasury and buy a bond that's yielding 5%. So when they needed liquidity and needed to sell bonds that were 1 or 1.5%, there are no buyers, right? So they have to do a fire sale at a massive discount, take a huge loss. Then they don't have the liquidity to fulfill those withdrawals, and the bank goes under. And it seems that that's exactly the same thing that's happening with Silicon Valley Bank right now. They had 1.75% yielding bonds. They had to sell like $21 billion worth of them, took a $2 billion hit on that sale. That causes more of a bank run and a panic. People see the news, and it's a self-fulfilling prophecy.
That's actually really interesting. So just for the audience, the money that you give the bank, to kind of simplify it for anyone outside the financial world, the money you give the bank, they don't just keep it there for you. They don't hold it there for you. Most of you know this. They use it to make money themselves. That's where the profits come from. And one of the things that banks buy is government bonds. Now, bonds that were purchased years ago had very low yield. So they were getting a yield of whatever, 1-2%. And obviously interest rates have been going up significantly. Never really thought of this possible damage from the interest rate hikes, is that the bank now, as people were drawing their money from it, people are a bit worried, they were drawing more and more money. So the bank needs to sell the bonds they hold that yield 1 to 2% to be able to give that liquidity back to the people who are drawing their money, to give them the cash. The problem is, Jesus, such a complex financial world. The problem is that government bonds are yielding significantly more now because the interest rates are higher. That means governments are giving you more money. Anyone that's buying the government bonds is getting a better yield, getting more money. And that makes the old bonds worth a lot less. So now they're trying to liquidate those bonds. There's no buyers or heavy discounts, and their liquidity got fucked accordingly. Scott, is that a good overview for the people outside the financial world?
I think that's absolutely perfect. And then there's one second dimension to that, which is related, which is that the banks, they have a crisis with what they can borrow because they're paying such high interest rates when they're borrowing from the central bank. That's A. But B, your average person who's willing to deposit, not for an active account that they're paying their bills out of, but like if you want to save money for a couple of years, are you going to put it in a bank savings account? Right, the banks need liquidity. They need more people to be depositing at sub 1% interest rate, or are you just going to go to the United States Treasury and get 5% risk-free yourself on a bond? Right, so they have a liquidity crisis from the other side as well, which is nobody really depositing because they can do better elsewhere.
Yeah, and Scott, there's a whole nother facet here that needs to be hit on, is that when they did this fire sale, they took a $1.8 billion loss on their bond portfolio. They then tried to do a capital raise to cover that loss, and that capital raise, it failed. They were unable to even raise capital, so they went directly to hiring Goldman Sachs, hiring advisors to sell the company. And I think that I mean, the fact that they've gone right to selling the company, the FDIC is now seizing the bank, shows that the sale is really the last hope to keep SVIB kind of alive right now. And it's still too early to say. It's not. I mean, this isn't like necessarily a 2008 event where all the other banks have exposure and the whole system's going to collapse. But I think it's really a testimony to. I mean, in the last 24 hours, you've seen the complete collapse of this bank. And when they tried to do, a capital raise, there wasn't any appetite. So I think it's just another testament to how bad liquidity is right now in the face of rapidly rising interest
rates. I think
rates.
Banks are extremely hesitant to bail out other banks after JP Morgan and Bear Stearns, but that's a completely other conversation.
Yeah, of course. Right? Yeah. There is an element of like PTSD here, right? Everyone's thinking, oh my God, is this another 2008 moment? And it's almost just putting everyone back on the sidelines.
Scott, just for the people who are listening, so what is fractional reserve banking? It's basically money creation by banks, isn't it?
I mean, to some degree. I see, by the way, I know I'm not a co-host, but I see Greg Foss has his hand up, and he's a master at explaining these things and probably would do it much more justice than me. Greg, I would take your mic off and go for it.
Well, hi, guys. Thanks for having me. Scott, that was an excellent a description of what's going on, but I need to I need to clarify something, people. It wasn't a fire sale per se where there were no buyers. There's very specific bond pricing math that equates old bonds to new bonds to yield the same open market rate as new bonds. This didn't move the bond market at all. There were plenty of buyers at the prices that they needed to liquidate their portfolio. It's just that the prices reflected a change in interest rates, right? So the price, as interest rates go up, bond prices go down. But that was not a lack of buyers. What it was holding these securities in a held to maturity account where you don't have to mark to market your losses. And then all of a sudden you get redemptions from your depositors, and you do have to sell these treasury securities and incur a mark to market loss. So this is nothing but accounting gibberish in the system of BIS, Bank for International Settlements, capital guidelines for all banks. And I'm going to take a liberty here to say I was 45 years old, so don't do the math, but I was 45 years old trading at a credit hedge fund in the great financial crisis, okay? So yes, I'm close to 60, and yes, the world was ending in 2008, 2009 because of contagion in the financial system driven by subprime lending. Well, this same contagion exists today, and I'd be very careful to downplay it because a loss of confidence in the banking system is what causes runs on banks and depositors to flee. Now, don't forget, a bank only holds $4 of equity risk-absorbing capital for every $100 of loans they make, which is to say, $96 of every $100 loan a bank makes is depositors' money. And when those depositors leave, they need to sell the loans, or in the case of treasury securities, which are more liquid than loans, they need to hit the bid. They need to sell it and incur a mark-to-market loss. The banking system is regularly insolvent, people. It's like watching a bus come around. So I've traded in 4 financial crises. Each time the banking system was insolvent, which is to say the book value of their equity is negative. And those financial crises were 1988, Latin American debt, 1998, the long-term capital management crisis, 2008, notice how these things happen every decade, the great financial crisis, and then 2019, the COVID crisis, and here we are. So only math, people. It's very simple. Banks are extremely risky, but don't forget, they're too big to fail unless they're not. So the regional banks right now is where all the risk resides, because the regional banks are not too big to fail. But the big boys that lost $47 billion of market capitalization yesterday and have over $1 trillion of mark-to-market losses on their treasury holdings, those are too big to fail. those were the ones that did not fail in the 2008, 2009. But there's going to be a lot of failures in the regional banks, in my opinion, because of this treasury. Thanks for having me up. It's great to meet everybody.
Mario, I don't know if you
jump
guys
in,
can
man.
hear me. Can you guys hear me? It's Ran.
Yeah, man. Yeah, good to have you back. Ryan,
Mario, can you hear me?
Yeah, bro. Yeah. Oh, Slayman, can you tell him I can hear him? He can't hear me. Slayman.
Yeah, Ran,
Yeah,
we can
take
hear
over.
you. We can hear you. Do you want us to drop you
no.
down and bring you back up, or is it?
No,
you?
he dropped out already. The question I have for while waiting for Ryan to speak, I've got a question for you, Greg. What would it take for this to spread beyond a bunch of small banks that deal with startups and obviously with crypto?
Well, you know, it's a crisis in confidence, and there's never just one cockroach, right? Here's the problem. The Silvergate was a small bank, but Silicon Valley Bank yesterday still had a market cap of over $6 billion. Okay, to put that in perspective, Credit Suisse, which is a very much larger institution than than Silicon Valley Bank, only has a market cap of $13 billion, yet Credit Suisse has way more risk than Silicon Valley Bank did. And if Credit Suisse fails, guess who's next? Deutsche Bank. And guess who's after that? Oh, we're back to the big boys again, because the counterparty risk is all a game of confidence. And it's not who you've lent to, it's who you have exposure to. And get me out of that flaming piece of turd, because guess what? If they go down, I go down. So again, it's a game of confidence. And you know, I traded in the great financial crisis, and I was a hero because I had default protection on Bear Stearns. And guess who I owned it from? Lehman Brothers, which meant I had to go out and buy default protection on Lehman Brothers to ensure my position at Bear Stearns. You see how this all works? It's a game of whack-a-mole. And when you have counterparty risk with any of these big financial institutions, and all of a sudden your insurance policies don't happen to be insurance policies anymore, you're scrambling around and it becomes a whack-a-mole fest. So yeah, this is contagion, people, and understand that it's only a game of confidence.
I agree. I must say, I truly agree. Yeah, and I think let's just go through what's actually going on. So if you think about what banks do with your money, they invest the money in T-bills, as Scott said, because that's one of the safe things, in inverted commas, that you can invest in. Now, when the COVID crisis hit, the interest rates on, for example, 10-year treasury yields were about 0.75%, which was the highest you could get. So you couldn't get real interest on 1-year T-bills, and you couldn't get real interest on 2-year T-bills. And so what the banks decided to do was they said, look, we need interest. Otherwise, if we're not investing the money to get interest, we're screwed. And so what they did was they went, so let's say they went for 10-year bonds where they probably should have gone for shorter duration bonds. And that's not a serious thing in a low interest rate environment, but I want to break it down for you. So a lot of people don't understand the concept of a yield on a bond. People think a high yield means the prices are going up. With bonds, it's actually the opposite. With T-bills, it's actually the opposite.
Ryan, you dropped out.
So I want to give an example. If you take a
back.
10-year T-bill, a $1 million 10-year T-bill, well, that means that the US government will return $1 million for you in 10 years. So it's got a maturity of 10 years, and the US government will return, for example, $1 million to you in 10 years. Now, when the interest rate is 1% or thereabout, the value of a 10-year T-bill is about $900,000. So you buy the T-bill for $900,000 and you hold it for 10 years, and then you come out and you get $1 million back, and you effectively make about 1% a year. That's why they call it. I'm very much simplifying it for you because there are coupon payments, etc. But for now, let's just call it a 1% T-bill with 10-year to maturity at $1 million trades at $900,000. So you buy it for $900,000, you hold it for 10 years, and then you've got yourself $1 million, and you would have made about 1% per year. The problem is that then the Fed started increasing interest rates. And today, the yield early on I looked at the yield on a 10-year treasury bill, it's 3.75%. It doesn't sound like a lot, but what that means is that if you buy a 10-year treasury yield instead of paying 900,000 when it was 1%, you're paying 690,000. So there's a difference of $220,000 on every $1 million. Now, what happened there is the bank invested all their money, or a lot of their money, too much of their money, into long T-bills, because they were counting on the fact that consumers wouldn't ask for their money back. The problem is that as soon as a panic starts, they want their money back. And what the bank needs to do is go and sell these T-bills at the market rate, which is today 3.7%, or $690,000 for every $1 million T-bill. And when that happens, the bank starts to take huge losses until eventually it just goes insolvent, which is probably what we saw with Silicon Valley Bank. Now, the problem is that I think a lot of banks did exactly what Silicon Valley Bank did, because the only way that you could generate any type of interest was to go into long-term T-bills, because short-term interest rates were going to be at zero, and therefore they weren't yielding anything, and therefore the banks wouldn't have been able to invest in those, or wouldn't have had any returns in investing in those. And so now I think what we're going to see is a lot of people start questioning their bank and saying, hold on a second, where did you invest the money that I gave you? I gave you a deposit, where did you put it? And what we're going to realize that a lot of them went into 10-year T-bills and maybe even longer T-bills where they were available, and they locked it in at a rate of 1.7, maybe even 0.5. And it's a huge knock. This is not a crypto thing. This is a massive thing. So much so that when the news came out today around how bad Silicon Valley Bank was, the probabilities of a 25 basis point rate hike went 20% to over 50%. Now, yes, that was accompanied by stronger than expected non-farm payrolls. Weaker than expected non-farm payrolls. But the main reason here is they're realizing that if the Fed continues to raise interest rates, there is a massive chance that a lot of banks are going to start going out of business. And I think, as Greg said, the problem with banks going out of business is that every single bank has exposure to every single other bank. I think I read somewhere today, and I may be wrong, but I think I read somewhere today that the major banks lost $52 billion on
no, that was just Rand. That was just market cap yesterday. But your point is well taken.
Yeah,
they got a huge exposure.
Yeah. So that's what I'm saying. So I think that we thought that the Fed would continue to raise interest rates until something broke, because that's when the Fed has to stop raising interest rates. Until then, they've pretty much got a license to do whatever they want. I think that we're seeing the first sign of something breaking, because I think that in 2008, the Fed put in capitalization ratios, minimum deposit ratios, etc. But what they neglected to regulate was the maturity of short duration versus long duration assets and liabilities. And I think that now the next wave of regulation, because that's how the US works, the US works very much reactive. They overreact, and then when they overreact, they create amazing systems and processes which they then over-enforce. And I think that that's unfortunately where we're going to now. We're going to be, this bank is probably gone, which is it's a huge loss. It's a huge loss for crypto, and it's a huge loss for tech. It was one of the major tech banks, crypto banks in the States. I just want to say one last thing before I give you guys the mic. For me, it's a personal thing as well. So I have a family member who sold his company to Gemini. He built a brilliant company, and he sold his company to Gemini. And because it was a crypto-related company, there were 2 banks that would have accepted him as a client, or 3 banks: Signature, Silicon Valley Bank, and Silvergate. And so he decided to bank with what he thought was the biggest and the safest, which is Silicon Valley Bank. And basically, all the money that he worked for is now caught up in this in this bank. So it's a pretty personal story for me.
Wahid, we've done a lot of spaces on this, and Rand was in those spaces as well. And you've always said exactly what Rand said. Interest rates will keep increasing until something breaks. Do we have something breaking? Could we finally see a reversal?
So first of all, thanks, Rand. It's also personal to me. One of my companies is caught up in it as well. We're just trying to figure out if our wire transfer actually got executed. Sorry for the background noise, Mario. I'll be very short here.
You've got a lot of it. Yeah, you've got a lot of background noise.
Things are breaking, and and they were breaking with Credit Suisse. People don't realize that the Swiss National Bank actually saved Credit Suisse and tapped the Fed window and did a Fed swap back in October in order to keep it solvent because they were losing so many assets. Obviously, crypto has majorly broke. A lot of the VC tech companies, even before SVB, were are having a hard time and running out of liquidity. So that is all breaking. And what's frustrating to me is that and I learned a lot from your Twitter Spaces, citizenship journalism here.
Wahid, your background noise is way too much.
All right, well, I'll be quick. Go ahead.
Yeah, Mario.
Yeah, go ahead, Zach.
Yeah, I was just going to jump in here off of what Ran was saying, because he
Ran,
and I both
the background noise is. Hold on, guys. Ran, the background noise. A lot of it's from you, bro. Okay, now it's much better. Yeah, Wahid, do you want to try now? I think the background noise was from Ran. Do you want to give it a try now, Wahid?
Yeah, well, I was just saying that a lot of things are breaking. It irritates me
much
that we
better.
have to break things.
Much better.
It irritates me that we have to break things. I don't understand why we give this much power to these individuals. It kind of reminds me of your whole, debacle around the vaccine stuff and all this. It's just these people are not held to account. They've broken things for 30 years, 40 years actually, since Greenspan, and they're not held to account. And it's frustrating that
but could we? But Wahid, could we see? Wahid, if we see a reversal in interest rates, Wahid, could things just improve? Could this go behind it? And could we see no contagion or limited contagion?
Okay, so we're still going to have inflation, Mario. Okay, because the entire inflationary cycle is supply driven. That means not enough power plants and equipment, not enough capex, shortage of labor, skilled labor, all that. Okay, is a supply shock, and yet all they do is hurt demand. They try to destroy the supply, the inflation by just destroying demand. Okay, that creates a recession, and they have a license to do that, which is asinine. The reality is, and not to be a broken record, the amount of debt that we have globally and derivatives and everything suggests that, something breaks and you will have an immediate contagion. Okay. And, there's a lot of insurance companies and banks in Europe that are not marked to market, and they held bonds by force when they were negative yielding. Okay. They have a bigger problem actually in Europe than they have in the US. And so, duration is a bitch, right? The fixed income term, that when you interest rates spike this much, the sensitivity and what Rand described very eloquently, just absolutely neuters balance sheets. And there's just not enough money around the world to keep our fiat banking system afloat. Okay, so come mark to market in this kind of huge amount of interest rates, when you have this much debt in the system, just to remind everyone, it's 330 trillion of sovereign debt, another 200 trillion of unfunded liabilities, pension funds, etc., and another 180 trillion of consumer and corporate debt. Add up, that's a lot of trillions. Okay, so no shit, Sherlock. You interest rates spike by 5% in a nanosecond, and this happens. So I don't understand what people were expecting. Of course it's going to break, and then we're going to have to repeat the whole damn cycle over and over again. And yet a lot of people lose their jobs, and a lot of businesses go out of business, and a lot of people, 50% of VC money flows through SVB. Okay, it's not a joke, right? And I do not understand why they get a license to fuck things up every single time.
Because it's the fiat system. Well, he very well said. It's nice to hear you talk about the debt spiral, which is 100% certain. What is the debt spiral? Total global debt is 4 times the size of total global GDP. Okay? Your tax base cannot support total global debt. How do you support total global debt? You continue to print money, meaning quantitative easing infinity, which will rescue the system. Yeah, because it always happens. But what is your protection against that? It's called Bitcoin. Bitcoin is your credit default swap insurance on a basket of fiat Ponzi currencies. It's that simple, people. Learn math, okay? The debt spiral is a certainty. There's no way to escape it. And Fiat debasement is a certainty. So you got to own protection. And that's called Bitcoin. And that's why I love Bitcoin as your insurance on the Fiat Ponzi scheme.
Zach, jump in.
Yeah. Well, first off, I just want to jump off all those points, Greg. I think you're right. And when we're talking about crypto, I think it's just been wild to watch the difference in the way the politicians have been reacting to the Silvergate collapse and now SVB. Because, Elizabeth Warren, Sherrod Brown, everybody was real quick to blame crypto when Silvergate ran into issues. But,
how's the response? Yeah, so Zach, how's the response after Silicon Valley Bank? What are we seeing?
Certainly. I mean, obviously, I think a lot of politicians have their foot in their mouth saying that, okay, if crypto was to blame on that one, what's different here? And I think it's been interesting to see the contrast between what happened. They're similar and they're different. And I just wrote a newsletter about this, is because they both shared the same issue of having a bunch of their depositors operate in the same industries. So for Silvergate, they had a lot of crypto companies all withdraw their money at the same time, experienced a bank run because, to Greg's point, there weren't a lot of options. And I experienced this personally too, because, where do you want to bank? There was really only Silvergate to turn to, Signature as well, but really there were only a few options. And so when the crypto industry had its struggles, basically they suffered a bank run, and Silvergate saw all the money flow out, and obviously they ran into their issues. But a lot of that was because, as we highlighted as well, the government was not approving new banks. They didn't want crypto banks to exist. And Caitlin Long, who I think, is one of the smartest Bitcoiners out there, was saying that this was all on purpose, that the government was conspiring to basically have something like this happen, because they only approved one bank. And as hard as she fought to get approved, she kept getting blocked for no good reason, but just because I think, a lot of people believe that the government wanted this to happen, wanted crypto to suffer. And then they could turn around and say, oh, this is all crypto's fault. What's interesting, though, is that you have Silicon Valley Bank, which basically was not super attached to crypto. They were attached to lending to a bunch of startups, fintech especially. And they ran into a similar issue where they were overexposed to one industry. Obviously, as interest rates have risen, VC funding has dried up. A lot of the startups they've been funding, a lot of the startups that have, turned to them for help, basically all had the same issue as well. And when you're overexposed to just one industry, it's not crypto that's at fault. It's, something that I think regulators hadn't really thought about, which, yes, interest rates rising and the idea of bonds, going down and having to sell things whenever you're dealing with panic certainly happens. But I think, the similarities between Silvergate and SVB is that they were both extremely exposed to just one industry.
Yeah, so it seems this is the risk mitigation is one, but what worries me more is the risks of a contagion. Greg, you've been through a few of them. I want to go to you briefly because you've been through a few financial crises. Do you see? So I read out a quote here from the Chief Investment Officer at UBS Global Wealth Management. We are not currently seeing classic signs of contagion, such as stress in the interbank market. However, the Fed now has very clear evidence that they are having an impact on the financial system and the economy. Rate hikes are starting to bite. And while that's not enough to give them a pause, it's something they will take into consideration. So based on this statement, now I know in 2008 we saw similar statements before the collapse. So him saying that there's no classic signs of contagion doesn't mean much to me. But the second part I want to focus on, the Fed, if they start seeing things get really bad, if we start seeing possible contagion, other banks not having that liquidity, could we see a reversal in rate hikes? And if we do see that, is it too little too late? Or considering how high interest rates are, it shouldn't be too difficult to reverse sentiment and gain trust back?
So great question, Mario. So first of all, when a chief risk officer comes out and says we are not seeing stresses, I can guarantee you he's seeing stresses. Okay. So the first sign is they are seeing stresses. Don't listen to that baloney. At the end of the day, there is a stress indicator in the system called the TED spread. It's as old as the day is long, and it's the difference between the T-bill rate and the funding rate, euro-dollar funding rate. Okay, measure that. You'll see stresses in the system. I don't want to get too technical with you guys, but look, yes, the Fed will have to cut rates to provide liquidity to the system to rescue the system, or else the system will collapse. Now, here's the problem, and someone brought this up before. They are raising rates to fight inflation. Now they're cutting rates to save the banking system, which means inflation could run even more rampant. So the Fed can't suck and blow at the same time, okay? It's going to have to pick something. It can either fight inflation and collapse the banking system, or it can save the banking system and all of a sudden they have to change their inflation target, okay? So I'm going to watch for a number of things like them walking back their 2% annual inflation target, and all of a sudden they'll come out and say, well, we've reconsidered, and 7%, 7's too much, and 3.5% inflation is good for you. In fact, we've seen, the guy at Allianz, the famous guy at Allianz there that was at PIMCO before, Mohamed El-Erian, saying, 3.5% interest rate inflation target may be the new goal. And that might be what the mathematics require, guys, because it's only mathematics. The system is broken. There's too much debt in the system. And if they try and squeeze the system, it will fall down. So yes, huge contagion risks in the market right now. This is the beginning of another financial crisis like we lived through in 2008, 2009. And a final word of caution to everybody. We are talking U.S. Treasury bonds here, which by and large have very low credit risk, not zero credit risk, because there is credit default swap spreads on U.S. Treasury bonds, but very low risk. All of this is being caused because of interest rate risk, not credit risk. Credit risk is what caused the 2008-2009 crisis, which was subprime mortgage lending. That's credit risk. This is interest rate risk. There are the same risks, but they are completely different from how you manage them. And yes, these people did a horrible job of managing what's called their gap, which is the difference between short-term funding and long-term funding rates. Let's say taking in deposits and putting them in 10-year Treasury bonds, and then the price of the Treasury bonds go down because the interest rates went up. But listen, there's a lot of credit risk lurking out there under the system as well. Think of commercial mortgage-backed securities exposure for these banks now, and the office buildings in LA that are being defaulted on by the likes of Blackstone and Brookfield, a very large Canadian property developer. These risks on the credit side also live in the banking system. It is starting to blow up, and everyone will come out and say, we don't see any problems. And guess what? That's because there are problems. And Credit Suisse only has $13 billion of market equity against trillions of dollars of assets on their books, including derivatives. And it really is the smoldering pile of shit in this fucking heap here, okay? And when Credit Suisse goes down, so does Deutsche Bank, and then things really, really get interesting. So don't pretend you're walking or whistling past the graveyard. This is a combination of risks in the financial system that the Fed is in the midst of blowing up. If they don't
I want to go back to this the whole Fed pivot thing that all of a sudden is all over the news, and CNBC and Twitter is now, the Fed has this is a path for a Fed pivot. I mean, you're really picking your poison. You're on one hand, you can save the financial system like Greg's been explaining, but on the other hand, you have 21 consecutive months of 5% plus inflation. You have PCE inflation rising for the first time since October of 2022. You have upward revisions in CPI and PPI data for multiple consecutive months. You have housing market at the least affordable levels in history, or going back to even the 1980s. And the Fed is now in a spot where, okay, yeah, they can do their quote unquote Fed pivot. And even if they want to start raising their inflation target to 4%, 5%, whatever you want to call it, 10%, that's fine. They can raise their target to wherever they want. At this point, it's pretty arbitrary. But on either end of this argument, there are going to be some significant losses. So I think it's come to the point now where the Fed did way too much too soon in lowering rates overnight back in March of 2020, and they didn't really know what they could do. No one knew what they should do because it was an unprecedented pandemic. But then they made the classic mistake now of doing too much too late, and you're seeing the whole system start to collapse for that reason. So I don't really think that, now the SVB collapse and we're seeing stress in the financial system, you can now say there's a clear path for a Fed pivot, because then you got the whole other facet of the economy and the whole side of this argument where, okay, well then what happens to everyone that's struggling from inflation right now? What happens to rising costs all around the board? What happens to the housing market? What happens to every other thing that has been bogging down this market for the last 12 months that would only get exponentially worse? And I think now we're really, and this is why we have been bearish for so long now. This was really an inevitable thing. I mean, by the Fed waiting so long to raise rates, and then now it's starting to pivot back to 50 basis point rate hikes, which we do believe there needs to be a 50 basis point rate hike this month, regardless of this event or not. It's really putting us in a situation where this is going to start to grow beyond just what we're seeing right now.
I've got a question for you, Kobasi. So the bank, I'm going to read out two things regarding Silicon Valley Bank. All insured depositors will have full access to their insured deposits no later than Monday morning, March 13th. The main office and all branches of the bank will reopen on Monday, March 13th as well. Can you explain on what those 2 points mean?
Yeah, I mean, look, that's fine. I mean, you're insured up to $250,000 at the FDIC, and they'll have access to those funds. But I read a stat that it's something like 97% of the funds with SVB are above that insured limit. So, I mean, the $250,000 FDIC insurance is a great thing for your typical, just people that are putting their money in the savings, your average American.
So the insurance, so you're saying the insurance is only at $250,000 per depositor?
Yes, right. And I think it's $250,000 per deposit. And I think, if I'm not mistaken, it's individuals only, so it's not corporations. And if you think of a bank,
and the FDIC is not here to protect from an event like this. I mean, these large funds, venture funds, private equity funds, anyone that has large amounts of money, hundreds of millions of dollars at the bank, is not waiting on the FDIC to come knock on the door and say, "Here's your money." The FDIC was created to insure retail. I mean, people that have $50,000 in the bank and they want to know that their money is safe. That's what it's there for. It's not there for a systemic failure like this, where you have funds that have millions and billions of dollars in an account, and then, all right, great, in 3 days, meet us at the front door. The branch will be open. You can get your $250,000. That's really not doing anything in this situation. I think that actually speaks to more as to how this issue is concentrated in large amounts of institutional capital.
And you've got a protocol. Can you just share what you just sent me now?
Yeah, I think they said 93% of the bank's funds are not going to be insured based on what they said. What we've been discussing.
Okay, yeah. I didn't know if it was 93. Regardless, even if it was 50%, it's that speaks to how little this whole FDIC the FDIC insurance isn't going to change anything right now.
So what could change things? What could turn things around to avoid what Greg talks about in terms of another global financial crisis? Because I do want to point things out. I just cannot determine how bad things are, because it just gets too complex and goes too deep, and there's too many things to understand. I still trying to figure out the 08 financial crisis and all the various instruments they had back then and how they all work. So the question to you is, every time, go ahead, Ron.
Drop interest rates or put more money into the economy. Take your pick.
100%, Rand. That's exactly.
When you say put more money,
that's exactly right, guys. They got to get liquidity back in the system. That is the crisis we are dealing with, is a liquidity crisis right now. And all due respect to the people who want to raise rates by 50 basis points to combat inflation, you do that and goes kaboom. Okay, kaboom, kaboom, kaboom.
And okay, so the first one is reversing interest rates is one, Rand. What was the other point? In injecting more capital.
Inject liquidity. You need to create liquidity. I hosted a Spaces. I think Kobasi Letter was on my TKL was on my Spaces. I called for a 50 basis point rate hike way before there was even a real probability of a 50 basis point rate hike. I'm now saying that Powell's looking at this and going, something started to break. If I do another 50, there's a good chance here that I'm going to destroy all the hard work that I've done so far. And so right now I'm putting my money back on 25 basis points. And I wouldn't be surprised if in the next couple of days we get a probability of a 0 interest rate hike, depending on what happens in the next couple of days. because I think in the next couple of days we're going to see a lot of people that say, "Oh, we have money. We had our money in Silicon Valley Bank." I mean, I don't want to be fear mongering here, but very simple question: how much of Circle's reserves are sitting in Silicon Valley Bank? Because remember, Silicon Valley Bank is one of the few banks that actually would bank crypto. I really want to know how much of Circle's backing of USDC is sitting in a SVB account.
What's for crypto? Isn't there just 3 banks that bank crypto companies? 3 major banks. There's only one left standing, and that's the smallest one. Or do I have my facts wrong?
So I don't know if there were 3. I don't know if there were only 3. I'm sure there were probably more that we're not speaking about. But the most prominent, which is Silvergate, that was one where I think the total movement in and out of Silvergate in 2021, 2022 was about a couple of $1 trillion. I can't remember if it was $3 trillion or something like that. It was a real number. It was in the trillions of dollars. Then you've got Signature Bank, which is small and has voiced their intent to reduce their exposure to crypto. And
they've been doing it for a few months as well.
Yes, and then the one which they
also tapped their home loan bank, right, to inject liquidity. Like they've been messing. A lot of these crypto banks have been, turning to, the government chartered lenders due to these customer withdrawals. This has been going on for months.
Yeah, and so now, I mean, Silicon Valley Bank is a much bigger story than that, because it's the home and the hub of startup America. It's the home and the hub of tech startup America. You take away Silicon Valley Bank. I mean, I'll give you one example of a service that Silicon Valley Bank provides that most banks won't provide. But if you're a founder of a company and you've got vesting equity, Silicon Valley Bank would give you loans against the vesting equity. So if you're one of the shareholders in Uber or whatever, and there was no liquidity, you could borrow against the value of your equity. Now, there's not many banks in the US that would do that for tech companies. And so Silicon Valley Bank, the collapse, and if I don't get rescued somehow, is going to cause a massive, massive hit to the US tech economy. And I'm not only talking crypto. I think crypto is.
Could we see a rescue run? And I'm not talking about what options do we have. It's just way too small for a government bailout. Like way too early, way too small to even consider that.
You could get one of the big banks scooping it up. So JP Morgan did come out before this whole thing and said, look, this bank's starting to look cheap before the whole thing. I think now the problem is, look, kudos to the regulators for jumping in so quickly when things started to go wrong. Because the longer they would have stayed open, the worse the hole would have become. The more they would have had to sell T-bills to pay current obligations. It's now stopped. The bleed stopped, and I think investors will see something on the dollar. And I don't know, maybe for one of the other banks, you're picking up a good client base, you're picking up a great niche, you may be picking up a whole lot of good staff. So I mean, I think there is a possibility of it, but it's like when FTX collapsed. The issue is we want to know how big the hole is. When we know how big the hole is, we can identify who the potential suitors are. And again, I'm not one to often commend the regulators, but kudos to the regulators for coming out and putting a stop on this thing immediately, and maybe giving it a chance of being salvaged.
The unfortunate part about all of this is and especially if the Fed is now going to start pivoting and letting inflation, take its course, is that your everyday people are going to pay for this. Just as you saw in 2008, your everyday people are going to pay for this, because the Fed and the regulators and the government are going to side with, saving the system, which obviously is beneficial for the everyday people as well. But if the Fed pivots and they're now in this situation where you're either saving the system or you're taming inflation and you're trying to protect the people. Either way, and this is something that we have been saying since the last 4 years now, beginning with the $4 trillion in stimulus that was handed out during the pandemic. this entire inflation situation and the printing of $4 trillion was the biggest involuntary tax in U.S. history. The inflation situation right now is impacting consumers perhaps even more than we saw in the 80s. And it's really unfortunate that this event seems to be the event that's going to push us to the brink of just passing this on to your everyday American or everyday person out there that is having to deal with, another failure of accounting, another failure of the Fed, and another failure of the institutional system not keeping itself in line.
Kobeissi, I've got a question for you before going to Bob. I'll read out a quote, and then that leads to the question. SPVs, so that's by co-founder of Claros Group. SPV's institutional challenges, SVB, Silicon Valley Bank's institutional challenges reflect a larger and more widespread systematic issue. We talked about this earlier. The banking industry is sitting on a ton of low-yielding assets that, thanks to the last year of rate increases, are now far underwater and sinking. The question I have is, how much are they sitting on? How deep does this go? Because I have no numbers and I haven't looked into any numbers. Any idea, Kobeissi?
I don't have the exact numbers on that, but I think Greg was.
I want to see, honest. Does anyone know if these numbers compare to the numbers we saw in 08? And again, it's way too early, but the numbers of all these risk assets, all those junk bonds and CFDs and all that stuff, the numbers were insane. Are we sitting on similar large numbers of low yielding assets that these banks will have to liquidate if we see a run on the banks?
So the numbers for the 4 largest banks in America, and this is only on their mark-to-market losses on their treasury securities. This is not credit risk. You said junk bonds. This is government debt run into the trillions of dollars on the 4 largest banks in America. But remember, these securities could be held in what's called held to maturity accounts, which means they don't have to take the mark-to-market losses. And by and large, these large banks have a much more stable deposit base than do the smaller regional banks like Silicon Valley Bank and the banks that are found in the KRE index, the regional bank index that trades on the stock exchange. So there's a much difference between the large money center banks and the regional banks. But the regional banks, again, this is a mark-to-market loss that's held in their for sale account versus held to maturity. Well, when you have depositors that find that they don't need to hold their deposits in the bank anymore, they'd rather hold it in short-term T-bills, and they take their deposits out of the bank, they have to sell these securities and incur a mark-to-market loss. So let's be careful about calling a run on the big banks like the JP Morgans and Bank of Americas of the world, who themselves have trillions of dollars of mark-to-market losses. Accounting rules dictate they do not have to realize those losses because they are held in an account called held to maturity. So, this is where you can mix and match your asset, your asset exposure, which is loans, bonds, junk bonds, commercial mortgage-backed securities, et cetera, et cetera. This is part of managing your asset base at a bank. One final thing for you guys. I love this discussion. Sometimes you have to pick between inflation and the stability of the global financial system, because we could cure inflation and nothing works in the financial system, or we'll have to stomach higher inflation and a financial system that actually functions. And that's called QE infinity, because that's what the mathematics dictate. The Fed will have to accelerate their printing. You define a pivot in many ways, but providing liquidity to the system is QE infinity. And that means fiat dollars race to the bottom. The US dollar, it is the best looking horse at the glue factory. Okay, people? The US dollar will debase and everything else will debase faster. So get your insurance. It's called Bitcoin.
Bob, would love your thoughts. If you don't mind, guys, just want to go briefly. Oh, Slayman, I'll give you the mic right after Bob just jumps in for a bit.
Sure.
Okay. Oh, do you want me to wait for a second?
No, go ahead, Bob.
Okay. Yeah, appreciate you having me on. For those that don't know me, I've been in the investment business 30 years. I have also I run one of the largest private depositories for gold and silver. Been doing that since 2008. We store about 600 million in assets. And I also run a hedge fund as well. So pretty adept with the financial sector and as well as obviously with systemic and counterparty risk. Back in 2008, what I was doing, actually in 2006, as I was seeing everything leverage up, we were actually in the process of setting up the depository and moving assets outside the system for this actual, for what we saw in 2008. I kind of saw that coming. The issue you have right now, it's not necessarily credit risk. It's an insolvency issue that you really run into. And there's a few things when you're talking about treasuries. The issue with treasuries, with not just the low rates that when the pandemic happened and then they did all the stimulus and created all the money and money supply and so forth, issued all the debt. They allowed banks to basically buy treasuries without having to count against reserves, and that inflated their portion of treasury holdings quite a bit. And that also allowed for them to take in all this deposit money. They had to actually fund, even though they were paying zero interest rates on deposits, they still had to run a business. So they were locking into whatever yield they could find. The problem you run into is with a contagion, you need two things. One is you need leverage. The other one you need is a contracting liquidity. And what the Fed's been doing, not just with QT of pulling money outside the system, they also have been running what they call this reverse repurchase program, which has been pulling money, typical money market accounts that would normally buy T-bills, for example. With the lack of T-bills out there, the Fed has created this account to basically sop up some of this capital. Otherwise, interest rates would actually really go down, irregardless of what the Fed was doing. And then you also have Janet Yellen with the Treasury performing monetary policy with a continuation of either paying down T-bills, adding cash into the system, which tends to rally the markets, or they start contracting. They start selling debt into the market like they've done here recently, and that puts a cap on the financial markets because you're pulling money or crowding out the market with Treasury debt. The real issue is going to come in June when basically this debt ceiling limit gets lifted and the Treasury is forced to dump more paper onto the market. The question is who's going to buy it. And if the Fed doesn't pull back from the brakes, it's going to create a massive crowding out effect that'll, if you think we're seeing any type of.
So Bob, I've got a question. Sorry, it's very interesting what you said. Just specifically what you said, and then you can carry on your point. With the ruble being backed by gold, does that, based on what you said, does that help Russia, or is that just Putin making things up?
Yeah. Ruble's not backed by gold. They have the level of gold that they actually have is probably the highest percentage to their M0 than any other country out there. I mean, they have a lot of gold relative to their reserves, but it's not really backed by gold. They've created some of these programs to try and incorporate, because Russia's a big supplier of gold to the markets, but because of the sanctions, that gold's been kind of clipped off, I guess. So they were trying to come up with other avenues or markets for mines and so forth, refiners, to be able to sell that gold into the market. So that's really what they've been focusing on.
Scott, jump in. Malcolm.
Yeah, I'm here. Sorry. I just wanted to make a very quick point, because I know that probably most people who are listening get confused when we dig into the minutia and the nuance of all this. We continue, and I say this over and over again on Spaces, talking about Fed policy and whether it's going to be 25 basis points or 50 basis points or 0 basis points. It is a dog and pony show, and you should not pay attention to any of it. And honestly, I'm guilty of it as well. There's no reason for us to debate what the Fed might do at any given moment. Yesterday, it was an 80% chance of a 50 basis point hike. The day before, it was an 80% chance of a 25 basis point hike. The fact is, The Fed has a 100% hit rate of being completely wrong in history. They always overshoot to the upside and they always overshoot to the downside. And to give the Fed credit for any of their current policy when it's their fault that we had 9% inflation largely in the first place, and it's Fed policy that created that, and now they're trying to fix a problem that they made themselves. They have now backed themselves once again into the same corner that they always do, which is deciding whether to fight inflation or save the system, as Greg said. And they will have to choose one or the other, and something will continue to break. But today, the bond market and the bank stocks are telling us that something is fundamentally broken. Bank stocks obviously have been crashing for 2 days. I mean, 10-year treasuries went from over 3.9 today to about 3.6. That is an absurdly large move for a 10-year treasury in a matter of hours. So something is broken here. The Fed now will be forced to make a choice and will once again be forced to break something after they're the ones who broke the whole system in the first place. So I just want to echo Greg's point, which is that the only strategy here is to find a way to opt out, because this is going to.
But how did we? But Scott, did we really find? Is it really that systematic? Like, we have Michael Burry from The Big Short. He tweeted saying, what did he say? It is possible today we found our Enron. So I think he's implying there's just an issue within Silicon Valley Bank and not a systematic issue. Is that also a possibility?
It is possible that today this is not a systemic issue, but I think Greg Foss already laid out the very clear case for the problem here in the way that the system is structured in the first place. Eventually these debts come due, you know what I mean? And there's no way to avoid this problem. We do go back to QE to infinity one day. It's 100%.
But Scott, if this is systematic, we could be, it could be a lot worse than 2008. There's a quote here by Bill Ackman. I'm going to read exactly what Bill Ackman said. After what the Feds did to JP Morgan after the bailed out Bear Stearns, I don't see another bank stepping in to help.
I quoted that
earlier.
If
banks don't step in, if the big guys, there you go, exactly. So if big banks don't step in.
There's no bailout. There's no government bailout. Clearly, no bank was interested in touching this. They had the chance in the last 24 hours. If there was going to be a buyer who was particularly interested, they would have largely jumped in by now. This bank is going to most likely fail. I mean, they've already effectively been shut down. Listen, as I said at the beginning, we've had Wahid, right? He already said that he had a friend or himself had a company impacted. Rand said that he had a family member who was impacted. I've spoken with 3 of my close friends who are in their 40s who all have multiple companies that are impacted, wires that they can't get out of the bank already. I'm talking about people who are running multi-billion-dollar family offices, who have 12 companies they've invested in that are all literally waiting for wire transfers that are not going to come to pay their employees next month. Right?
What are the cascading effects? I just wanted to ask, because he's talking about multiple companies unable to meet payroll on their obligations. Do they have any contingency or any outside?
This is their contingency. This is their bank account. This is the cash they raised from venture capital.
This is the money for days like this.
This is literally.
No, I understand that, but I'm curious. Yeah.
That's it.
And just to give you a protocol before you jump in,
they're screwed.
But this is like, just to tell you how big Silicon Valley Bank. These are some of the clients of Silicon Valley Bank, obviously in their early days. Moderna, DocuSign, Zoom, Coinbase, Uber, Fitbit, LinkedIn, Apple, Google, Amazon.
Mario,
they've all
it is the Silicon Valley Bank. I don't think you understand. Every tech company in Silicon Valley banks with Silicon Valley Bank. You're talking about I think at one point nearly 200 billion worth of deposits. This is not a joke. This
will be this.
We're about to see.
Sorry, go ahead.
This is a huge.
Could you see, Rand, could we see, I'll read out another quote. Just want to get your thoughts on this point. Like, we all talk about the dominoes, and we have, again, Michael Burry. I'll read out the quote. The risk of failure and deposit losses here is that the next least well-capitalized bank faces a run and fails, and then the dominoes continue to fall. And then he says, this is why government intervention should be considered. And he's saying it at such an early stage.
Ackman said the same thing.
It's not early. It's not early, guys. It's not early.
Yeah.
It's not early. We're in the. Hold on. What happens if some of the biggest tech companies in the States cannot pay salaries? What happens? You're talking about a run on the banks, which is what I said earlier, which is I think it's imminent. It's imminent. You're talking about the best companies in Silicon Valley not being able to pay their employees and maybe having to re-raise capital in low interest rate, in high interest rate and low liquidity environments. This is huge. This is
100%.
I mean, I use the word this is cataclysmic,
guys,
in the big scheme of things. This is huge.
This would be the second largest bank failure in the United States. 208 billion assets. I mean, this is absolutely massive. I think Washington Mutual probably was the only one that was larger. I mean, I'm sure a lot of people here have read the book Sapiens, right? To Rand's point, money is a construct, it's a shared myth, and it only works as long as everyone believes in it. And that's the same as the banking system. And the reason that these things continue to happen is once the bank run starts, people lose faith. And once you lose faith, there's no value in the assets, and there's no value in that system.
I'm gonna go out on a limb here. And I mean, I know I'm a crypto person, and I know I'm a person that is, opted out of the current financial system. And I know we're myself, Scott, Mario, a couple of others, Zach, I see here, we're all Bitcoin people. But when I got home today, I said to my wife, look, this is what's happening. I told her the story about my family member, and she said, well, where is your money? And I was, well, it's spread around a couple of banks. I was like, she said, well, are they safe? And that got me thinking, hold on a second, they're probably not safe. And then I thought to myself, hold on a second, let me try and get money into stable coins. And I thought to myself, hold on a second, Tether and USDC 100% has some kind of exposure to Silicon Valley Bank. Tether may or may not, I don't know, because I don't know if they can still bank in the US. And then I thought to myself, whoa, hold on. That USDC may not be safe. I don't know if it is or it isn't. I don't want to be fear mongering. I don't know whether or not they have any deposits in Silicon Valley Bank. But if you take their market cap, and I'm not sure of their exact market cap, I think it's somewhere around 30 billion maybe. Let me quickly just check it. Hold on, I'm just quickly checking.
Hey, Rand, a quick point on that is they do have accounts at BlackRock. So I'm not entirely sure if they have all their money at BlackRock, but I do know it was released a while ago that USDC does have accounts open at BlackRock. And I'm just pointing that out because earlier people were saying there's
I don't get it. So where's the safety? Guys, where's the safety?
Well, that's what I think. So that's what I think. I think remember, Bitcoin was created in the first banking collapse. That was the 2008 mortgage crisis, and that was the banking collapse. I have a feeling that this may be Bitcoin's moment. And I'm not saying that because I'm a crypto person and because, because we drank the Kool-Aid. I'm just saying when you start doubting the banks and you need something liquid that you need to invest your money in right now, what are your options? If the banks are not secure, what are your options?
Ran, I've got a question on that, and this is just for the average person. So what do you say to people that say that crypto is the real Ponzi scheme, such as, Rubini or William Quinn, their statements? Because obviously that's a concern people have, that is it a Ponzi scheme?
Look,
I would answer, maybe when you answer them, maybe differentiate crypto and Bitcoin, because crypto is, not everything's
exactly.
Exactly. And that's why initially I said this is a Bitcoin moment. I didn't say it's a crypto moment.
Yeah, exactly. So anyone that's sitting on anything, not anything, but like if you're talking about stables, if you're talking about USDC and USDT no longer being safe, these are like the US dollar of crypto.
Yeah,
and it's pegged to the US dollar.
And the banks are no longer safe. Let's just you don't know which bank's going to collapse next. I guarantee you that within the next 30 days another bank collapses. I don't know which bank it's going to be. And then, as Michael Burry says, and I'm not a big Michael Burry fan because I think the guy needs to take some antidepressants. He always sees the glass half empty. But the reality is that when the banks start to collapse, either the Fed has to print more money and add more liquidity, which means that your money is going to devalue, or if the Fed doesn't step in, I don't know if your money's safe in the bank, guys. And I'm not fear mongering here. You've just seen it, and you can't tell me that the other banks don't have a mismatch in obligations.
But let's be fair. You're speaking to businesses and companies. The average American, the average global citizen doesn't have much in savings. So, technically they would be covered by FDIC. I mean, let's differentiate here.
In America, in America, I guess most individuals would be covered by FDIC. There are a lot of high net worth individuals that wouldn't be covered by FDIC.
I understand, but you're speaking very broadly. There's a lot of people here who are just average Main Street people. I don't want to, I think we need to
Yeah.
be very specific with our words.
Yeah, so I think suffice to say that any individual with less than $250,000 in an account probably has nothing to worry about. And most of the banks are FDIC insured if they're real banks. You don't really have anything to worry about. But if you have over and above that, you got to really question the solvency of your bank, and in case of a bank run. I don't think that.
Ran, I just want to ask a question, because obviously there is 11,000, 12,000 listeners, and not all of them have your guys' level of understanding of the depth of this. So in terms of, because obviously you made a differentiation between crypto and Bitcoin, but for example, and I don't want to veer this off too much, but because you're presenting it as an alternative, I do need to just ask the question that a lot of people are thinking. So the concern people have is possible government intervention when it comes to Bitcoin and crypto. And in addition to that, when I quoted Quinn, he also mentioned Bitcoin as well. So if you can just explain them 2 points, that'd be brilliant.
So
yeah, and I'll add one more. Ran, I want to add a third point to kind of move away from. If a government bailout comes in, doesn't that just change everything? Interest rates starts to drop again. Government comes in to bail out the system.
Yes. Let's answer both questions. So the first thing is, let's differentiate between Bitcoin and crypto. Bitcoin is digital gold. It's a scarce digital store of value that can be sent from one side of the world to another side of the world in a matter of seconds without government intervention, very quickly. Sorry, 1 second. Not now, Wilbur. Okay. That's Bitcoin. The rest of crypto is what you call venture capital investments. Venture capital investments for the average individual, not something that I'd recommend to the average person on the spaces. You also mentioned regulation. So Bitcoin is regulated. There's no debate around whether or not Bitcoin is a security or not a security. It's already been regulated in most jurisdictions in the world as not a security. And I think that there's absolutely no doubt about Bitcoin's regulatory status. The rest of crypto, there's a war with the SEC at the moment, where SEC is trying to claim that everything else is a security. So the risk around Bitcoin, you don't face the regulatory risk. You don't face that which you face with the rest of crypto. You also don't face what I call the venture capital risk, because Bitcoin does what it's supposed to do, and it's now in the adoption phase, whereas most of the other cryptos still don't do what they're supposed to do. Bitcoin has been doing what it does for the last 2010, so 12, 13 years. Whereas the rest of crypto still has to prove what it does. So to me, look, I think if the first banking collapse was when Bitcoin was born, maybe this banking collapse is where Bitcoin actually finds its real place in the world. It's a long shot, but if banks do start to collapse, then I think
just for anyone listening, by the way, Slimane, my mic is playing up, so if it messes up, you can take over. But for anyone listening, Rand is not a Bitcoin maxi. He owns a whole bunch of cryptos and invests in startups. So just want to make sure you understand that for the record, where his bias is. Well, there is no bias in what he's saying. But I do want to point something out. My other question, Rand, is what if we do? Stop it right. Okay. Can you hear me or no?
I lost you.
I can hear you.
Yeah. Oh, we go. It's playing up. As I said, Slimane, it's playing up. But the second point I said, if interest rate hikes stop and we do see a bailout, then we could see things back to normal. And, but then I see headlines like the following. I'll just read out a headline. More Fed rate hikes could be on the cards. That was 4 hours ago after another strong U.S. job report. And then while the news may encourage the Federal Reserve to raise interest rates higher again. And I'll quote out something by Richard Flynn. Investors will interpret today's strong job reports as a sign that the Fed is likely to continue to tighten monetary policy in the months ahead.
The job reports don't matter. What matters now is what happens to the banking system in the next 12 days. We have an inflation reading on Tuesday. And in the absence of a collapse in the banking system, that's a very important piece of data. If inflation is on the decline, which is, by the way, what the forecasts are saying, then the probability of a high interest rate rise
so
decreases.
They're discounting the inflation rebound in Euro countries that recently occurred. They're expecting us.
So I think right now, You know, it's almost like all of this news takes a backseat, and all eyes are on the banking system. And I think that what's going to happen is on Monday and Tuesday and Wednesday, we're going to get a lot more news from a lot more banks.
Well, well said, Ran. It's Foss. I'm going to jump in here and then try and be quiet. Look, you're 100% right. There is no inflation talk when the system is cracking. Okay, you need to rescue the system first and then battle inflation second. Otherwise, there's no choice. And I'm just going to throw out something for people to think about. So I'll reiterate. Yes, there's Bitcoin and there's crypto. They are not the same. One is decentralized. The other coins have a CEO. Here's the thing. What if FDIC insurance is not sufficient to cover all bank deposits? And guess what? It's not. Okay. The FDIC is on very shaky terms as well. So this is all part of the banking system, fiat Ponzi. You need insurance. You called Bitcoin digital gold, Ran. Thank you for that. I actually think of Bitcoin as digital energy. It's even better than digital gold. Okay. And one day Putin is going to price his oil in Bitcoin. And then it's over for the US dollar as petrodollar and the ability of the US to print energy. So think about all this, and the only wrong allocation to Bitcoin.
Did you see today that China just announced in secret negotiations that Iran and Saudi Arabia resumed diplomatic relations?
It's part of it's part of the whole thing. Anti-US dollar, right? So look, the only wrong exposure to Bitcoin is owning zero. Get yourself some insurance. Anything greater than zero.
Foss, can I ask you a question? Just based on how do you get out of QE infinity?
You can't. It's math. It's impossible. This is the beautiful thing. I could explain this to a grade 11 math student, and they would say, "Well, we have to keep printing money to pay the interest expense on the debt, don't we?" And I'd say, "Yes, very good. You passed your grade 11 math. You have to print money to pay the interest expense on the debt because the debt is growing faster than the economy." Simple, pure and simple. Fait accompli comme ça. So it's very simple, guys. Don't overthink.
James, I've been reading your threads as well. So anyone that's listening right now, check out James' profile, check out the threads he's been writing. James Lavish. Would love your thoughts. Just give us an overview of what you were talking about in the threads and what your thoughts are on the discussion so far. Because I came into the discussion, I was pessimistic. I didn't understand the gravity of how big Silicon Valley Bank is. And I wasn't too concerned about systematic risk. I just thought it's just bad risk management, and thought, if things do get worse, the Fed will just reverse course. Do you share my stance, or am I just too optimistic here?
No, I appreciate you having me up here, Mario. So, I mean, it's a question of confidence, right? All eyes have been on the Fed for months now, and everybody's waiting for the pivot. And so we saw stocks run up in January and February in anticipation of a Fed pivot, and then they started to sell off this last number of weeks because of positive economic news, which is negative for people who want to have the Fed pivot, right? So everybody's been looking at that, but what we don't realize is that when you raise rates so dramatically, so rapidly, the problem is it's difficult for the Fed to know where that neutral rate is, right? So we don't know where that neutral rate is yet because everything happens like they're looking in the rearview mirror. Everything is happening slowly. So the effects of these higher rates have not really fed. They have not really fed into the economy fully yet, right? So we're looking at all this economic data. We're waiting to see what happens, but we're raising rates so rapidly that we don't know where that neutral rate is. What do I mean by that? We don't know where above a neutral rate is contractory. So it makes the economy contract. Below, it allows it to expand. So we don't know where that level is. The problem, and Greg Foss has talked about this ad nauseum, as have I, there is so much leverage in the system. There is so much borrowing. There's so much debt, and it's all interconnected. The problem is when you have that much debt and you don't know where that neutral rate is, you get what we're seeing with Silicon Valley Bank. So what happens? You have zero interest rate policy going forever. You know, just 18 months ago, where there were $15 trillion of negative yielding bonds, not real yields, nominal yields in Europe. That means that the Bundesbond was you would give Germany your money and get less back when that bond matured. That's just insanity, right? So borrowing at very, very, very low rates. However, the problem is how do the banks meet their obligations, right? They have depositor obligations. So you've got zero interest rate policy. It forces banks to buy longer duration bonds. They have to go out onto the yield curve a little bit further to get higher yields, right? So then when you have interest rates rise because the Fed and central banks are manipulating the interest rates to battle inflation that they cause with excessive money printing, right? So once you have that happen, you have these unrealized losses that are on the bank balance sheets. Worried customers want their deposits back. It forces the banks to sell the bonds at now significant losses. I think you guys talked about this earlier, but I had to jump off. But basically, when you have a bond and interest rates go up, that means the price of the bond goes down. So if you have to sell that bond and you can't hold it till maturity, you'll have a loss rather than a gain. And that's what we're seeing. And then it just snowballs on itself, and you have a bank run, and the bank collapses. Well, it's not just that bank though, because they're interconnected. So the next step is contagion. And that's what we've been worried about. I've been worried about a credit event because of just the sheer speed at which the Fed has been raising rates, and they haven't given us a chance to see where that neutral rate is yet, and something will break. And this may be that something. We will find out. Sorry, that was a long answer, but that's kind of where I'm at.
And I just want to share the news that there's concerns around First Republic Bank. I saw their stock price, I think, is down 24% today. How fast, if there is a contagion, how fast will we see the dominoes fall? In 08, it started off slow and then suddenly started accelerating. But now I do sense there is, after 08, the wounds are still there. It's not that long. So I just fear that if contagion starts to kick in, it will be a lot quicker than we saw back in 2008. Is that a fair assumption?
Yeah, it's fair to me just because there's so much leverage in the system. Look what happened in the UK this past fall, right? You had the finance minister come out and say that he's going to have this massive tax cut. He doesn't say how he's going to pay for it. The bond market gets spooked, right? So the gilt market, which is the UK bond market, gets spooked. The UK gilt starts selling off because how are they going to pay for this without money printing? Okay. And so the pension funds, literally overnight, they were going to go bankrupt. They had to go into the Bank of England and ask for relief, because what happens is they were all so levered to the system. People have been, the companies, investors have been starved for yield for so long that they've been in risky assets. They made bonds risky by levering themselves up. And this is what happens. It can happen so quickly. They were literally going to collapse.
Yeah.
The Bank of England.
Mario,
right?
Liability-driven investing. So they were levering their long bonds to enhance the 3% return, or sorry, the 1% return. They levered it 3 times to get a 3% return because they couldn't meet their pension obligations without a 3% or higher target. So they used leverage. So to answer, well said, James. And by the way, James and I are pretty close friends. We spend a lot of time together in the last few years. But here's the thing, Mario, you said very astutely, yes, the cycles get shorter as the leverage gets greater. So we've been kicking the can, and every time we kick the can, the cycle gets more severe and the time for a slowly then suddenly event gets shorter. Okay, so I think that we could be at the beginning of an event that will accelerate very quickly. Right now, the financial system in North America is a bug in search of a windshield, okay? It's going to fucking splatter unless the Fed gets their acting gear. So watch it happen this weekend. It always happens on a Friday, right? It's like the Titanic. It went down at midnight London time. Guess what? the same thing will happen with the American financial system.
So, guys, I see you both agree. I'll go to you, James, again. Two questions. Number one is the party over?
I mean, we're going to find out this weekend, right? The question is okay, it's a question of confidence. Okay, we like we just said, these banks, they first of all, they're lending out their, multiples on the fractional lending, on the fractional reserve basis. They're lending out multiples of what they have in their accounts. What's left in the accounts are held at significant losses. If you have customers who want their money back, right, who are worried that they're not going to get their money back, they start withdrawing. And this happens with companies. I mean, you've got companies who have deposits there at these banks, like Silicon Valley Bank. You've got these young companies, and they want to spread some of their cash around. Well, they've got to withdraw from one to put into another, or just start buying short-dated treasuries that they know that they're going to be able to hold to maturity. But when they do that, they're forcing the banks to sell. So it's all a question of confidence. And it's always just one bank. I mean, I kind of put this out last night just because I saw this kind of this coming to fruition. I don't know if this is happening right now, but I just said it starts with a run on one bank. Then you have a full-on credit event, and that leads to contagion. And that contagion is that's what we're on the lookout for, and that's what I'm worried about. I'm worried about the next bank and then a succession of them. But yeah, my good friend and partner David Foley and I were talking about this just a minute ago, and it could be the Lehman moment where Lehman collapsed, and it was a long time. It was months and months until we had another. We had evidence that it was systematic. It was system wide, and that this was going to be a problem that was going to take down the whole system. And so, but what I can tell you is that if and when we do have a major credit event, there is going to be absolutely no choice but the Fed to step in and print more money. Whether they raise that FDIC insurance and then have to top up the FDIC accounts in order to pay for that, they will have to print money in order to save these institutions, period.
I do want to say, Gary Tan from Y Combinator, there's a quote here I want to read because it's very important for anyone that has a startup or any money in the bank. I'm going to read out the quote. Anytime you hear problems of solvency in any bank and it can be deemed credible, you should take it seriously and prioritize the interests of your startup by not exposing yourself. It goes back to crypto. Whenever this, we rang the alarm on Silvergate Bank and they're gone now. We rang the alarm on DCG and they're facing issues now. Genesis, etc., and obviously FTX and other exchanges. So just want you, better be safe than sorry. The second thing I want to ask you again, James, before we go to other speakers, there's a narrative I've been hearing. So I started obsessing over this back in 08. It's obviously much younger, and there's been a narrative since, and I've just been waiting for it until I gave up waiting for it. And that's like, in 08, we placed band-aids on the financial system, and we kept placing band-aids, especially after 08, especially after COVID, but throughout the last decade or two. So my question is, how bad is this? Is this a case where, we're just going to see a potential systematic risk, a few players for the government come in, and then the party continues as we saw a few times in the past? Or could this be the event that's been part of the narrative for many, many years, especially about a decade and a half ago, where we're going to see the great deleveraging. We're going to see the financial system globally. And I'm going to go a bit extreme. I'm going to take a few steps forward. The discussion, the depression narrative that was part of the discussion in 08, and we saw it again during COVID. Is that something even worth discussing? And I know it's too early, but I'm saying, is the system at a stage where it could get to the trust in the system could fall to levels that cannot be saved by a government bailout?
Could it? Absolutely. Do I think it is? No, I don't think that's going to happen this round. Will it eventually? Absolutely. There's no question about it. I mean, look, we kind of kicked the risk up the ladder, right? So in the tech bubble, we kicked it up to the banks, and then in the 2008 great financial crisis and the housing bubble, we kicked it up up to the sovereigns, and now the sovereigns are sitting on all this debt, and that's where the leverage is. So at some point, you will start seeing some currencies collapse, and they will fold into the U.S. dollar. The U.S. dollar, in my belief, will be the last one to fail. So we're very fortunate. The ones who are sitting in the United States here are very fortunate that we're denominated in dollars. But that doesn't mean that the dollar won't eventually fail. I think it will. It's just a matter of time. Does it happen in the next few years? I don't think so. I think it's going to be decades or longer. But you know, this could be the spark that kind of wakes people up to that fact. And it could, I think Greg was saying it, it could be a Bitcoin's moment. This could be the point where people realize I've got to diversify my assets into a store of value that cannot be manipulated, that isn't overrun or overseen by a sovereign. That could be the moment. But I sure hope that we have yeah.
But James, this is the Bitcoin, the narrative of this is Bitcoin's moment. We're not seeing that in the price of Bitcoin, though. We're seeing people dump Bitcoin, which was surprising to me. But that takes time for that to sink in, or what?
I think that's more of a product of just a general lack of confidence right now, and liquidity and risk appetite in the entire system. I mean, it's important to note that we're going into this whole bank collapse right now with consumer confidence at its lowest levels of all time. You have 21 straight months of 5% plus inflation. You have people are struggling to pay for basic necessities. So I think right now you're seeing a lot of just risk off appetite, and I still think Bitcoin and crypto as a whole is viewed as a risk on asset, right? It's viewed as a risk on thing that you buy when you have more risk tolerance, and when you do think that we are in a bull market and when everything is good. So I think that's the problem with Bitcoin, is that and crypto as a whole, it is in a way a safe haven asset. In a way, it is like a gold right now, right? It's like a more stable, centralized.
What are other assets? What are other risk-free assets that people could flock to in the next few months?
Can I add, James? Guys, you're absolutely right. The problem is Bitcoin is actually insurance, and therefore should be a risk-off asset. Now, James is an Ivy League guy, and I'm an Ivy League guy, and I say this with all due respect. The algos are being programmed by Ivy League cucks who are 25 years old and have no idea of the insurance or long volatility protection that Bitcoin applies to the system. Well, they haven't done their research. Over time, people will understand that Bitcoin is a long volatility asset, which means as volatility increases and risk increases, you actually want to own it. I won't go any further. I'll step off stage. You're in good hands with James, but don't listen to the Ivy League cucks, okay? And I'm one of them. The fucking education system is absolutely broken as well. Nobody understands the danger of the fiat system because they can't. No one can tell you the truth about the fiat system, because if we learned the truth about the fiat system, no one would deposit their money in banks, because they realize that banks are actually very, very risky because they're levered 25 times to 1 against their true risk-absorbing capital base. Don't believe me? Check the BIS capital guidelines for banks, okay? It's a fucking Ponzi. Over and out from Canada. I love you guys. I want the USA to survive, but you're doing a shit job of ensuring that your financial system will survive because you have an idiot lawyer at the helm. Good day. God bless America.
So I've got some questions, because obviously on the space there's a lot of pro Bitcoin guys, and obviously people have genuine questions. So a few questions. So the first question I think most people have is, the Bitcoin inventor Nakamoto. He said, obviously, as all of you know, that when it comes to Bitcoin or Bitcoin cryptocurrency, it has a cap limit to the supply. So is it really a true alternative?
Hey, it's decentralized. You don't want, if your coin has a CEO, it's not decentralized, okay? Bitcoin is decentralized, defended by math and code with the strongest computer system in the world, okay? That's what you get when you own Bitcoin, and you're able to track. Yes.
What are other assets other than Bitcoin as well that you'd look at as a potential safe haven? I'd love you and Kabasi to give us a bit of an insight. What you
in this market, you're going to see absolute rotation to long bonds. That's because it's a knee-jerk reaction. But U.S. Treasury bonds over the long term are a debasing asset as well. But as a trade, you'll see a rotation to risk off, because finally interest rates are high enough that they actually have some duration component where if the interest rate falls, the price of bonds go up again because the Fed has succeeded. But other than that, be very careful, and particularly people understand your counterparty risk. Oh yeah, and guess what? If you hold Bitcoin in cold storage and you self-custody your own Bitcoin, there's no counterparty risk. It is the most beautiful asymmetric insurance policy I've ever seen. I got to leave now. James, take over. Yeah.
Yeah, and then, to add to
just
that,
to ask a question, the similar question, because I feel like it's not fully been answered. Like, even if you decentralize it, that doesn't answer the question in terms of the supply.
It's math and code. You cannot have a 51% attack. Go ahead.
Greg, I think he's more wants clarification on the lack of them, meaning that there wouldn't be enough to go around. Is that correct? But
that's fundamental. Does not understand the fact it's not one for one.
Right. It's infinitely
hold on,
divisible.
Fidget, let's understand.
Yeah, it's infinitely divisible.
Let's understand. So, Slayman,
sats.
Is that what you want to understand, Slayman? Like, is it limited by the number of Bitcoin?
That's right. Yeah.
Yeah. It could be divided into as many pieces as you can. So one Bitcoin could be divided into how many satoshis?
100 million.
100 million.
100 million.
There you go. Each one Bitcoin could be divided into 100 million satoshis, which could be used as a metric. So yeah, it's not whatever the number of Bitcoin limit is. I do want to, if you don't mind, Simon, I do want to go back to just James and Kobasi about I'm just very curious on where we're going to see inflows over the next few months if that contagion continues.
Yeah, I think you're already seeing a flow into gold, and that's normal. That I think that makes sense. So last month you saw gold selling off because people were looking for the pivot and said, well, we're going to take our money out of risk assets. We're going to take our money out of anything that is not a growth asset, and started rotating back into stocks. But now you're seeing stocks fall and gold go up. And so, that's obviously one place that it should go. And sorry, Kobayashi, you go ahead.
Yeah, I mean, I think I would look if this collapse does mean that the Fed is going to pivot and that actually comes to fruition, which honestly would be unfortunate that this is what it took for the pivot, and honestly that the fight against inflation is not even over and they will have to pivot. Then bonds and gold are the clear benefactors from this situation, because you're going to start to see a rotation back into just traditional risk off assets. I mean, if you guys would go back 20 years before all this crypto and all this stuff came out, I mean, gold and bonds were the safe haven assets. And I think now people are starting to sort of turn back there. But I also just don't think that we're in the clear as far as a Fed pivot. I mean, seems to be like an assumption now that the Fed is no longer going to raise rates anymore. I think if the Fed still is raising rates, and I still think there definitely is a case for that, we're not at the point right now where you just go buy bonds and you go buy gold. I don't think we're in the clear. So right now, and you know what's interesting is right now a lot of people were just kind of rotating back into cash. That was almost viewed as a safe haven because everything else was just kind of tanking simultaneously. But now you don't even know if your cash is safe or if it's below.
But I want to go through the contagion. We're talking about contagion to other banks, and financial contagion. But how about contagion within the tech industry? So I'm going to read out a tweet here by Alex Cohen.
That's a huge issue.
I don't think exactly like I just I just didn't take into consideration enough. I don't think many people understand the level of chaos happening in tech right now. This is just fucking insane. Every group chat, Slack, and email chain I'm in is going crazy.
Yes.
Founders have no idea if they'll make payroll. Investors have no idea which companies are impacted or if LP funds are safe. Employees don't have the slightest clue what's going on. Anyone cheating this can go fuck themselves.
Yeah, Mario, I've been screaming about this. I've been saying this since there was 1,000 people on here, right? And I've been tweeting it for 2 days.
Yeah, we talked about it yesterday as well. I mean, it was inevitable.
Yeah, I was gonna say these.
Yeah, go ahead, Scott.
I mean, I'm getting these messages over and over and over again from very close friends. I just got a message when I popped off for a second. A friend called me. They have a fund with and I can't name who it is, but a $2.5 billion fund now have gotten multiple companies that were unable to get wires out, which I've mentioned before, but this is yet another example. We're talking about 20, 25 portfolio companies now are asking the fund for bridge loans to pay employees in the next 2 weeks, up to $500,000, some of them individually, but the fund can't do it because they're leveraged with their loans from Silicon Valley Bank. So not only are the portfolio companies not able to get their money out, but the company that funded them all can't give them more money because their money is tied up in Silicon Valley Bank.
And this issue is not going to go away. I mean, this bank banked 50% of the ecosystem, and the waterfall when you go into receivership is first the insured deposits get paid out, then the non-insured deposits get paid out, and that can take sometimes years. As you go here, it might be sooner because you have a held to maturity book that they can sell, but the loan book, right? The 70 billion of loans, 50 billion of which are illiquid, right? It might take several months, if not years, to get through that, and 50% of the VC ecosystem is relying on this capital to fund payroll. I mean, these rounds only provide you 6 to 18 months of capital. So it's going to, and by the way, Silicon Valley Bank owns equity, has free equity, and owns convertible preferreds and stakes in some of these companies as well. If they sell and punt those stakes onto the market, it's going to depress valuations because the people on the buying end will actually value these stakes using cash flow type multiples. They're not going to use the prior round, right? They're going to assume down rounds. They're going to assume multiples that are, very, very, they'll penalize these companies. So all of a sudden you'll see markdowns, right? Perceived markdowns across the entire industry. And it's much worse this is actually a worse outcome for the VC industry than if 5 of these big guys had just come and, provided some financing to support this bank. I'm surprised the FDIC just let it fall through so quickly.
Yeah, Wahid, I want to quickly go to you. Can you hear me, Wahid?
Yeah, I can hear you, and I should have better.
Did you hear what?
Yeah, I did. I mean,
you're good now. Did you heard the tweet that I read? Founders have no idea if they'll make payroll. Investors have no idea which companies are impacted.
I
and you talked about one of your companies.
Yeah, I heard that, Mary. You know what sucks? And let me just be a little bit whatever. It just, all they needed to do is, you want to punish the shareholders, no problem. Senior subordinated debt holders, no problem. But you could have stepped in, and this is 50% of the ecosystem, and you could have basically said, we're going to backstop deposits. I mean, you could have freaking done that instead of funding Ukraine every month to the tune of $20 billion. You see, this is what I don't get. I do not understand.
Well, it's the headline risk, right? So we bailed out all these banks in 2008. And taxpayers, believe it or not, they don't want
100%. But this time you're not keeping the bank. Hold on one second. You're not bailing out the bank. You're bailing out depositors. You let the seniors, you let the bondholders and the equity guys get donuted. So this is not J.P. Morgan, Goldman Sachs bailouts 2.1. You let it all go.
In most cases, the equities got wiped out anyway in those bailouts as well, right?
Sure, but at the end of the day, they continued. At the end, they basically got the TARP deal. They got this. I'm just saying, like, the depositors, this bank didn't do anything really crazy. That's the tragedy.
No, they actually made a huge mistake. What they did was they didn't use rate hedges, which any small $500 million company knows how to do that.
But they didn't take.
That was a horrible mismanagement.
But they bought 3-year treasuries, okay, had a completely duration mismatch, granted. Need to be punished for that.
The 91 billion of held to maturity securities at a much higher duration, right? It was over 5 years, and the available for sale book, which was 21 billion that they sold for the 1.8 billion loss, that was 3.6 duration. They took a 9-point loss.
So let me take a step back. What the depositors? Why is that their fault? People say they could have taken another bank. They cannot take another bank. There's 2 or 3 banks that takes this kind of business. This is a social fabric of the VC community in America, people who just got started. So for people that say, well, they should have done a better job picking another bank like JP Morgan, screw that. JP Morgan would never accept this business, ever. And so I think there is a duty to protect some of these depositors because there was no fault of their own. The majority, because I've been through this process. I have a fund and I have these companies. You get your funding, it's an interbank transfer. Okay, you get it from Peter Thiel, you get it from whomever. He just deposits it straight into your account at that bank. So you as a founder are not going through that math. And by the by, SVB is very much pushed as a conservative bank. You know, look at their, of course, they don't know how to do duration management.
No, you're absolutely right. It's 200 billion of assets. I've done stuff in the venture space and have been part of rounds, and they were factoring receivables. They were doing pretty low risk stuff, and they were perceived as being the one and only, you know, venture debt lender. And it's very sad what happened. I don't want to be perceived as saying, you know, anyone deserved what happened. I think it's terrible. But I'm just trying to explain, you know, when it comes to, you know, the perception of a public bailout, why it may not have happened in the way that some might have wanted it to happen.
I've got a Galaxy Digital CEO, Wahid, just quickly, before going to James, the CEO of Galaxy Digital, quote, "I am shocked that the Fed is going to let depositors lose money in Silicon Valley Bank.
Good, exactly.
Are all banks going to be treated like hedge funds? Seems like a policy mistake."
A huge policy mistake. And I'm not saying, you know, the problem last time is they bailed out GM, Ford, etc. These corporate boards, these companies stayed intact. I'm not about that. I'm about backstopping the depositors. It's very, very simple. What we call a controlled, organized wind down. That's it. And frankly, shareholder depositors and you know, the population, right, usually gets their money back there, because if the assets and liabilities are what they are in a controlled unwind, things should pretty square up in the end. So yeah, it's, for me, it's a huge policy mistake, especially since there are bailouts every single day for like not worthy things. You know what I mean?
Right, but it's all,
yeah. I mean, that we bailed out a lot of companies and PPP fraud.
Go ahead, James, and then we'll go back to.
That's a good point. Really quickly, I mean, it all comes out of 2008, 2010 Dodd-Frank, and the Fed declaring that they'll no longer inject taxpayer dollars to prevent big bank failures. And so they've kind of painted themselves into that corner, and they basically opened up the authority for the banks to use all debt capital as equity, including not just unsecured creditors and common and preferred equity, you know, shareholders and bondholders, but also the deposits. And so they opened it up for that. And that's the issue that we're at now. So how do they walk that back? Do I agree with you? Yeah, this is a major issue. It could lead to contagion that people are not even realizing because of all of the leverage in the system. So go ahead, special speaker. Sorry.
But is it? But before, guys,
Sure.
is it? But I don't know if we can compare that leverage to 2008. You know, I'm going to read out another quote here. Mike Mayo from Wells Fargo. Quote, "This is night and day versus the global financial crisis for 15 years ago. And for anyone that doesn't remember that, wasn't there then, it sounded like the world was going to end and we were going to go through a depression similar to the 1930s. And if you don't know how that feels like, you can Google it. It's not a place you'd want to live. Banks were taking excessive risks and people thought everything was fine. That was back in 2008. Now everyone's concerned, but underneath the surface, the banks are more resilient than they've been in a generation, which is kind of what I was thinking as well before starting the space.
Yeah, the
Like,
tier one capital ratios across the banking sector are about 12.1%, which is the highest they've been in history.
What were they in
a little
08?
bit lower.
What were they
They're
in
less
08?
than half. They're less than half. You guys remember Lehman Brothers was levered like 40 times. These banks are levered like 9 times. If you look at SIVB, the tier one capital ratio was 15%, but that didn't matter because all these VCs came together and said that they're going to run. Now, the banking system is a lot safer now than it was in 2008, but there are a couple of things to just keep in mind. In 2007, JP Morgan and even Ben Bernanke said that we were going to experience a soft landing in the economy. Today, in the banking system, there's a $21 trillion problem, and that $21 trillion problem is commercial real estate. 40% of that commercial real estate is office and malls, where capacity utilization is like less than 70% in 4 of the buildings that were just defaulted on by Brookfield, PIMCO, and Starwood. So this is going to be a slow bleed over 3 years, with commercial real estate being a huge drag on banks. The second thing is there's 650 billion of AFS and HTM losses on bank balance sheets. On February 9th, 2023, there was actually a St. Louis Fed blog that you can probably look up and post here that was talking about the risks. The Fed raised rates so quickly in the last 6 months that banks have taken huge losses that they haven't realized on their books. Now, they might never have to realize them if they just hold these securities for the next 10 years. However, if they're forced bank runs and you have to take losses on these securities, just like with SIVB, you might force some of these tier 1 capital ratios to go much lower. So banks are reporting next quarter. I expect a lot of bank analysts to start doing work and figuring out which banks, like Schwab, for example, have a very large held to maturity book of securities. That's why it's down. And if they were forced to sell this book, not to say that they will, don't want to scare anyone, but if they were forced to sell it, what would the actual realized loss be on the bank balance sheet? And what would the near tier 1 capital ratio look like? And would they have to raise capital? That's kind of why this is happening right now, even though on the face of it, tier 1 capital ratios are the highest they've been, the second highest they've been. I think they're higher the year after COVID.
Wahid, I want to quickly go to you. Just read out another thing here, another stat. Rate increases have effectively wiped out approximately 28% of all the capital in the banking industry as of the end of 2022. Would love your thoughts on this particular point. Wiping out 28% of all the capital in the banking industry, 28 because of the rate increases.
So that's that's 100% believable and tenable. The kind of interest rate, if you had a 5% hike, we've only done half of that in Europe. I can assure you, because I'm from Europe and have equity in a bank here and all this, there is no equity. There is, I mean, you look at the derivative report in here, they don't mark to market, right? And they have zero risk weights on all the sovereign bonds, no matter which country you buy it from, be it Greece to Germany, any country. I can assure you, most of those bonds were held on balance sheets at negative rates. And just suddenly now, and that for many, many years, right, since 2012, 2013. And now suddenly, you've got this massive hike in rates, right? And they don't mark to market. And they have a derivative portfolio like 5 to 6 times the size of the US. So I can assure you, based on those numbers, Mario, there is no equity in the banking system in Europe, none. So let me take another step back.
I think the German banks and French banks are in a really tough spot.
But, I mean,
there's
nothing there, right? They just lie. The way we do it in America, well, the way you guys do it in America, I should say, is a tad bit more honest. But just to go back to bailouts, you talked about they never want to go back to 2008. In 2018, there was a massive bailout. It was the repo market. Had they let that thing go belly up, because rates were like going up 100, 200 basis points, and the repo market essentially shut, JP Morgan would have been out of business within a week. See, that's the.
But they were able to do it They were able to do it quite quietly.
But because they always do it for
so
systemic banks. The reason why I root for this bank is the social fabric of the VC community. Okay, it's not Jamie Dimon, right? And yet this cabal of banks always calls the Fed and they tap the New York window when there's a repo crisis or, God forbid, Credit Suisse last October. Look it up, guys. Okay, tens of billions of swaps were done with the Swiss National Bank. Why?
That's right.
Can we talk about the UK? I'd love to just put in a UK perspective, if possible. I used to be an economist at Chase Manhattan in London. That was many years ago, but I worked in financial services. I have no ability, as many of you have, on the details of the bond market, except to say that from a regulatory point of view, my big concern, having been in many real estate groups and many investor groups with United States citizens and professionals over the last year, I am absolutely terrified by the leverage in your subprime markets, your lending, your lack of asset ratio, or whatever the terminology is you use in the US in banks. I do not believe that after 2008, 2009, America learnt the lessons, and I've seen outrageous amounts of lending.
Money. I want to keep.
The lending is off balance sheet. There's $90 trillion of off balance sheet lending in the form of CMBS, private credit, CLOs, which are 80% of corporate high yield lending, BBB minus, Baa3. So I think the things you're pointing to are right, but they're not at the banks. They're actually outside of the banking system today. 80% of the leverage lending is outside of the banking system today.
Could I ask, do you not have a bank assurance sector? Maybe that's what I'm referring to, is that our banks, our Barclays, NatWest, HSBCs, all have very big mortgage lending areas, which are tightly regulated.
Are backed by Fannie Mae, Ginnie Mae, and Freddie Mac, and they're securitized and sold to hedge funds and insurance companies. These banks are not taking huge mortgage risks.
Umbrella, jump in. I've got my team just now. Holy shit! I've just got my team. Umbrella. I've just had my team just now. I got a message from one of my finance guys. He's like, "Yo, should we?" And he doesn't. He's not too deep into this. He's just got a message from him. "Yo, should we swap our USDC?" This is the fear that Rand is talking about. This is exactly all about trust. I've just got my team now DMing me. This reminds me of the FTX spaces we did, where I'll be hosting a space, and I got my team messaging me, freaking out in the background. Umbrella is actually perfect time to go to you. What's crypto gonna do, man? Like, is Bitcoin the only thing that people could go to now? Like, genuinely speaking, anyone outside of crypto, you find this very interesting. Anyone inside of crypto, you'll find this very important. All these actually, Umbrella, I'll let you explain it. What's the risk there is now in stables and essentially holding their money, their one-to-one backing in those crypto banks?
Well, just on that, and to what Scott was saying, a founder also DM'd me that saying, they had exposure to SVB, and for them it was, if you had any loan facilities with them, there was a requirement to keep your deposits with them. So it wasn't like, well, we had a choice of putting our deposits with different banks.
Hold on. So if you got a loan from SVB, you had to keep that money with them?
Yeah, I'm sure like the bigger parties were able to negotiate that, but as kind of a smaller kind of founding member or founding team had a request.
Is that hold on? Is that, again, I'm not.
That's 100% correct.
Is that normal, Scott? Is that normal?
Yeah, with a bank like this, I mentioned that earlier, right at the beginning. I said you raise capital, you put the $10 million in their bank, and that's how you get the loan back. So it's sort of this circular thing.
That's right. Do you remember with FTX, Scott? When I'm not comparing this to FTX. I'm not comparing Silverbank to FTX. Yeah, we had, I can't remember who it was, the guy from the movie, we have our Enron, and then he deleted his tweet.
Michael Burry.
I think he's a bit too extreme.
Yeah,
but
I mean, with it.
Yeah, Michael
Burry.
Burry.
That was too extreme.
Yeah,
it's more like WAMU. WAMU's a $300 billion bank that went bust.
Exactly. I mean, people are saying this is the Lehman moment for venture capital, but I don't think they would liken it to Lehman for the entire system.
Yeah, but the point that Umbrella mentioned, I'll go back to my question now, for people in crypto, just to kind of get an answer. It's like in FTX. What was it? If FTX invested in your startup, you had to keep that crypto on FTX.
Yeah, you might. Yes, you might you might also remember that FTX bailed out BlockFi, who then loaned the money to Alameda.
Yeah,
it's the same logic. Umbrella, I didn't mean to interrupt you, buddy. I think you should go ahead and finish your point. I'm sorry.
No. I mean, it's no problem. I think it's the same point you're making, is that this will impact crypto and Web3, because crypto and Web3 firms would have had exposure like we've seen Circle do. So I think it's prudent, if you're in the space, to speak to your founders and ask them, do they have exposure to SVB? Because obviously you're only kind of insured to the first 250,000. And then post that, you go into the bankruptcy queue. So I think it's prudent for kind of any projects you're either invested in or interested in or talking to, and to ask those questions, because I think there will be some that are exposed to them, and we will see some contagion relations. That obviously Circle is, we don't know how big it is. Where was it just a smaller bank within their ecosystem, or was it one of their kind of main partner banks where they kept USD deposits?
Have we actually seen that reported? Because I heard Rand mention it as a possibility, but I haven't seen that. Perhaps it's because I'm here and not looking around. I do know, as was mentioned before, I mean, Circle is largely through BlackRock.
Well, Circle has deposits on SIVB and SBNY, right?
Guys, I just want to understand, like, who's left, Scott, who's left standing in crypto, man? Like, I remember I kind of stepped away for a bit with my show after FTX, so I've been keeping a close eye after Genesis and DCG.
Coinbase.
But
yeah.
Okay,
I mean,
Coinbase, Kraken as well.
Kraken and Coinbase, I would say, and Gemini, their earn business obviously was effectively ended by the Genesis bankruptcy. But as far as I know, Gemini.
But what contagion could we see in crypto now? We haven't talked too much about crypto, but what contagion could we see in crypto? Talking a lot about Silicon Valley with SBV and the Silvergate gone in the last few days.
I can't speak specifically to who is banked where. Obviously, we saw number of companies back off of Silvergate within 24 hours, which to me, I just want to, as a side note, I think is very sad because Silvergate was the first bank to effectively take a big risk on the crypto industry, banking Coinbase and Kraken and Circle and a number of these companies. But they quickly said that they had ended their relationship all within 24 hours. But I guess the question becomes, where are they going? It's becoming obviously much more narrow. Signature is not pursuing that business anymore. Metropolitan Bank, I don't think is either. They obviously were banking Voyager when Voyager went under, which was the entire sort of scandal with the claim of FDIC insurance at Voyager. I would say I can't speak to any specific contagion with Silicon Valley yet, but this plays back into the concept of Operation Choke Point that's been sort of circulating, which is something that Caitlin Long has come up here quite a few times. She told me last April at Bitcoin Miami when I interviewed her, she said, listen, we're all talking about the SEC and the CFTC, that regulatory regime, but actually the conversation we need to have is about the OCC and the FDIC and the Fed, the bank regulators, the big regulators, because the single point of failure for the crypto industry is if the banking system cuts off crypto exchanges, therefore cutting off retail, and there's no on and off ramps for your crypto in and out of the system. Now, I can't speak to the legitimacy of that or what has actually happened in that regard, but we can definitely see that we are having a very major narrowing of banks that are servicing this industry.
Guys, just got an update here from my team. Justin, if you're here, who's a regular panelist, just sent me through this information. Anyone that has any news related to this, do DM it to me. We have a team checking all my DMs. If you've been impacted by this, if you're a startup, DM me as well. I want to bring up a couple of startups just to share their experience. But in the meantime, what I'm going to do is, Slayman and Scott, I'll send you through what the team just sent me now. But Wells Fargo is facing an outage. I'm not trying to spread fear, so I'm hoping anyone has any clarity. And I'll read out here on a thread. Got a text alert at 3 a.m. that my account was overdrawn and my paycheck that posted is now gone. A few minutes ago, I get a text saying that I need to add money in my account by tomorrow to avoid overdraft. Others are having their account. I got no love that day's grace period. Okay, so I'll send you through what I'm getting, Scott, regarding Wells Fargo and an outage report for the last few hours. Not sure if anyone knows anything about it, if it's a point of concern, but it'll be great to get some clarity on this just for the audience. But Umbrella, we did take the mic from you, so I'll give you the mic back before going to Nitin. And any speaker that wants to speak, just jump in or put your hand up.
Could I just ask on crypto? Yeah. The FCA, our regulator in the UK, has only regulated 15% of all the crypto market. Those of you who are aware, the FCA are pretty heavy. We also closed down a whole load of cash points across London just in the last few days for any crypto, because we found out that there is an 80% what they call toxic crypto market that the FCA is now keen to clamp down on. I just wonder what impact that will have on crypto, as you're talking about in the United States and wider. But I did feel that somebody earlier said crypto was an asset. I wouldn't put it in the class of an asset because an asset needs liquidity. And with the crypto market being clamped down on so much and also not standing up against long-term bonds, gold, and the others, I don't understand how crypto can be described as an asset.
Bitcoin and Ethereum have extremely high liquidity, but once you go further down the risk curve, I could definitely see that argument. But I mean, I think one of the arguments for why crypto has traded like a risk asset is because it is extremely liquid and trades 24/7, 365. When someone's panicking on a Saturday at 3 p.m., they can't sell their stock. They are likely to sell their Bitcoin because it's always liquid. But I disagree with you. I mean, it's $1 trillion market. I don't think it's illiquid per se.
Just will be in the UK.
Positive, but guys, that's positive news just about for anyone in crypto. USDC just said, and I've sent you through the report, Scott, but they did say most of their money is in BNY Mellon. So that's just their exposure to SVB is very limited. I've just got the report here. I'll read through it. But I'll go to Umbrella and then Nitin. Jump in, guys, while we go through the Wells Fargo reports.
But that is worry that why would they keep most of their money with a single institution? So even me, that's why I preferred BUSD, because BUSD were smart and kind of Simon Dixon agreed on this, is that they kept money across different banks below the insurable threshold across the different entities, so that if any one bank did go down or had
yeah, but if you talk about, I think you talk BNY Mellon.
BNY or State Street go down, the largest custodians in the world, then literally the world is ending.
There's no diversification. It's like, why don't people?
Valley Bank is the largest custodian on the planet.
Yeah. Imagine saying to someone, I don't know why you're holding their cash, all their cash in US dollars. What if US dollars just goes down to zero? I'm like, I think we should be looking for a new planet to live on.
There's actually more money going to these banks: State Street, JP Morgan, Wells Fargo, Morgan Stanley. There's someone that I know that transferred $300 million from SIVB at like 6 p.m. last night to Wells Fargo. So believe it or not, the big banks are benefiting a lot from this.
So I've got enough things. I've just brought them up. Nitin, jump in.
Yeah, sure. Thanks. So I was waiting for a while now, but just a quick introduction. Part of Lehman Brothers, when it went belly up, really seen very closely the whole financial crisis, and what's really surprising.
You were at Lehman Brothers when it collapsed in 08?
Yeah. I was a research analyst that time. I was in London.
Did you have to walk out? Did you have to walk out with a box out of the building with the cameras filming? Or no?
I didn't get a chance to get hold of my box either, that time. So it was just very chaotic. Just trying to work out my expenses and everything, So everybody was filling out.
Let me ask you a question then, since you were part of that collapse. I just got to ask you a question. For anyone that wasn't there or that was watching it live on TV as I was, obsessing over it, how fast did things collapse in 08?
Yeah, so that's a good question, because that's what I wanted to talk about. First of all, ever since Bear Stearns happened, and that was in March 2008, right? It was very chaotic in the financial markets, and really the question was who's next? Suddenly the issue became political, and suddenly, there were talks about that, okay, no more bailouts. And I think Lehman Brothers was at the unfortunate end, really, in September 2008, when it could have been bailed out, but because of political pressure, because of media pressure, the whole decision was taken that, probably a bailout of Lehman Brothers specifically was not on the cards. So how fast did it unfold? Idea is that it was probably brewing since the start of 2008. Bear Stearns was in March 2008 was one of the first signs that, the market is really stressed out and things might go south, from there on. Second, just the week preceding, 15th of September 2008, I think that's where things went really, really from bad to worse. And internally also within Lehman, we were quite nervous about how things were shaping up and where would this land up and end up really. And as weekends come, right, and this is where we stand today as well, that on a Friday afternoon/evening, whichever part of the world you guys are signing up from, really, that's where whole idea is that, what will happen over the weekend, So for past few days, I can't take my mind off, and my thoughts are with employees of all the banks which are getting impacted and their families, of course, because I personally, went through that pain and agony, of that time of the whole financial system collapsing in front of you, and you sitting there as a helpless sort of a worker and trying to figure out, why is it impacting you personally and everything that, comes with that. Second is, of course, if you take 5 steps back and think about it, there were banks circling today as well.
Before you continue, just whenever there's something important, I always interrupt to mention it. Just for anyone before they freak out. So Wells Fargo, the concerns that we're seeing seem to be a glitch in their systems. And this is a quote: "But we are aware that some customers' direct deposit transactions are not showing on their accounts." But they didn't provide a timeline on when the issue is going to be fixed. So there's no concerns around Wells Fargo. Jesus.
What a time for a glitch, right?
That's good to hear.
What timing is,
yeah, I've got a small checking account that I just logged in. It's fine.
Yeah. So I remember back, because just James, for us in crypto, and I know you're in the crypto space, when there's a glitch in the midst of a meltdown, we freak out, because every player that has financial issues suddenly has a quote unquote glitch. So just wanted to be on the safe side. But sorry, Nitin, to interrupt you. Go ahead, man.
Yeah. So that's a good news, So please feel free to interrupt me when you're sharing good news, So definitely that's most welcome in this environment. So really, I mean, the point I was making that every bank which is like gone through the books of these couple of banks, in last week or so, I don't know, what they're really smoking, because, in 2008 itself, it was very clear with the financial crisis and the lessons that banks took, collectively, and the economies took collectively, that nobody's going down in isolation. And this is something which I was like really happy, when I pursued my banking career from 2010 till 2023 now, that probably this whole cascading effects were like really well understood by the system. And this is where, the whole idea of some of the things that, nobody's going down in isolation. People need to bail out, for whatever mistakes is happening from the regulator's perspective, from the bank's management perspective, and need to fix up that. So I'm really surprised that, none of these things happened in last 1 week or so. What has really changed, that from 2008 to 2023, where we are now in last 15 years, probably the instruments have sort of, changed. Otherwise, we could have had like the same Twitter spaces way back in 2008 and talked about like the same set of, decision and the policymakers.
We're just, would you say, Nitin? And on that point, I want to actually get Wahid's feedback on that particular point before you continue, Nitin. Is that we're a lot more aware, we're a lot more careful, we're a lot more conservative. Special situations was mentioning that the numbers look a lot better, the bank reserves look a lot better. Wahid, hearing what Nitin was saying, do you share that same?
No, I disagree. At the bank level, absolutely. But at the macro level, we've got quadruple the leverage. Quadruple since 2008. I mean, the numbers don't lie. And you've got huge asset classes like Chinese real estate, 350, 400% debt, debt to revenue. The entire Chinese market is at 300% debt to GDP. When we look at our funded liabilities on top of the sovereign debt, we're talking about 150 to 200% debt to GDP. The system is way more levered. That's why, unfortunately, these cute guys at the Fed, cute guys and girls, think that they can just raise rates and, until something breaks. And then when they break, they have to cut rates aggressively, restart a QE, and then we're back to the same point. And yet what happens is you destroy a lot of people's lives, just like you destroyed a lot of people's lives with these lockdowns. And me, Mario, I plenty of vaccines in my system, and I was a goody good tissues, listening to the authorities. It was all bullshit. Okay, we over rely on quote unquote experts when in fact they're completely narrow-minded academics that really don't see the big picture. So we're going to have to go through this. I think it's going to get a lot worse over the weekend, unless they do something systemic to reliquefy the system. Regional banks are going to start getting stressed. Everything happens on the margin. Liquidity is going to dry up very quickly. This is not Lehman. This is more Bear Stearns. And then in the next 3 to 4 months, you're going to start seeing the build up to the big Lehman, unless they cut the umbilical cord today and really reset.
The larger banks are fine.
I do think that the government debt that you're talking about has little to do with the financial debt, and you need to look at debt relative to GDP. I do think that the situation's gotten worse. Japan, the UK, Europe, Asia. But when you actually look at the financial leverage ratios, it's really, outside of the banking system where most of the risks are. And that's actually, in a perverse way, it's a positive. It actually means that the Fed doesn't have a lot of room left to continue to raise. You look at, there's several $100 billion of debt maturing in 2023 and 2024, just to your point, in commercial real estate. And by 2025, you start having the $5 trillion leverage loan and private debt and high yield bond markets start to see their maturities that were pushed out during COVID. They can't do this for very long. Not only that, with a 31 trillion of debt, net the 8 trillion that's at the Fed, you have 25 trillion in debt, a third of which is rolling over in 2 years. Every 1% increase in rates is $400 billion in taxes. $400 billion in taxes.
So let me stress test this.
Matures in the next 3 years.
So 3 to 4 trillion.
Go ahead, hold on, guys. I think everyone's just speaking at the same time. James, I'll let you quickly respond, then we'll go to Wahid and I think. Go ahead, James.
Oh no, I was going to add to what Special Situations was saying is that half of the federal debt matures
Yep.
in the next 3 years. Half of
In
it.
2 years, so a third in 2
Yeah.
and half in 3. That's
And
what
what does so what does that mean exactly,
Well, they're
James?
going to
So
get
that means.
refinanced
That
at a
means
higher
that
rate.
the
That's what it
debt
means.
has to
Go
refi
ahead.
to a higher rate.
Yeah, just
Go
to
ahead,
put it
Wahid.
very simply
Okay.
simply for everybody is look, we run at deficits. We cannot pay off our debt as it matures without issuing new debt. And so when you do that, you're letting this debt that's maturing at Special Situations, correct me if I'm wrong, but somewhere between 3/4 and 1.5% that is yielding on the debt that we're retiring. Well, now you're issuing new debt that's somewhere around 3.5% to 5%, depending on where it is on that yield curve.
It's all short term,
And
so it's going to be close to
yeah,
5%.
So there's just
yeah.
U.S. Treasury, Yellen so that's from Yellen. Financial regulators that just 1 minute ago convened today expressed reliance in banking system resilience. Just obviously
Yeah, well,
meaningless,
they
but worth mentioning.
But
remember
the
what they
FT
said
is
back in
calling
the
this
great
a
financial
US
crisis.
created problem. It's saying that the US, the Fed's failure to implement Basel III across what they call the community banking structure and only to use it at the large sort of international level is entirely a US created thing. Says the Fed adopted the rule under which only the largest international banks were subject to the full Basel NSFR requirements. And basically that means that the ratio only had to be 85% on their second tier. 70% was calibrated at the next tier. And even then, the majority of US banks are not required to follow the NSFR or LCR standards at all. This is an entirely US created system, and it is their SVB's issue that needs to teach lessons. This is effectively what the FTR
I've just got a quick question, guys. I've just got a quick question. I'll go back to you, Wahid. We talked about, and I'm going to go through the audience questions. So bottom right corner in that purple circle. Let's go through some audience questions as well. But my question is, we talked about how everyone was more conservative. I think me and James were talking about this. How everyone's more conservative after 08 and they're being more careful. Yeah, my concern though is everyone's also a lot more edgy, a lot more scared after 08. So that means as soon as one bank fails, the fear will kick in a lot faster and memories from 08 will kick in a lot faster. Could this mean that the dominoes could start falling faster based on the experience we had in 08 and the fear that people still have embedded?
Well, information goes a lot faster, right? And
exactly
the reason why,
and this is an example of it right here.
So, I mean, we had a gentleman talking about 08 and he was talking about Bear. The Bear issue started in July of 2007 with the 2 hedge funds that blew up. And then that fed into the stability of, the capital ratios of Bear. And then that fed into Lehman. It was a 2-year thing. Like people were shorting in 2005 ahead of what happened in 2008. Like this is a lot different. Things are happening very, very, very quickly. And information, on Twitter, through Discord, through mass media, it travels in an instant. You had 1,000 VCs on a newsletter, and by yesterday morning at 11:30 PST, you had 13 venture capitalists telling their portfolio companies to essentially run on the bank. You would have never seen the speed of that. It would have taken a couple weeks for that information and for that to actually have taken place 15 years ago. So I do think
by the way,
it will happen faster.
I think FTX had a lot. I think FTX had a lot to do with that. But honestly, like people saw how quickly FTX unwound. That I think a lot of the knee-jerk reaction yesterday from the VC funds was that. It's not
what could we see? Like I've got Valkyrie Asset Management 19 minutes ago. They said about the SBV collapse. Its closure will have widespread impact. What widespread impact will we see in the tech industry?
Let's get out of the ivory tower for a second. Next week, San Francisco, it's a morgue. It's a morgue. Okay, Silicon Valley, people not knowing the payroll. Half the companies have exposure. Not 10%, not 20%, half. So, I mean, it's right in front of you. It's like a 7.58 earthquake in California. So it's very, very bad. And we're doing a lot of stupid things, globally in terms of funding stuff, wars and stuff like that. And here we are, an entire sector, half of the entire startup sector of technology is exposed to this. Okay, SVB, and I'm not rooting for, I'm telling you, did not go through anything systemic during Lehman. their problem was duration mismatch, bad on them, based on a record century speed hiking of interest rates to fix a problem the Fed created in and of themselves. Okay? So that's why I'm angry, because I find it very unfortunate, because I can assure you and everyone on this call, nobody who had deposits at SVB was reckless. No one.
Okay, so what do you expect to see? What would be? Okay, go ahead, NF. Thanks.
I mean, you were reckless if you had them for over FDIC insured, right? But I mean, that's besides the point. It's not going to be a morgue, and there's not going to be a long systemic bank run either, and it's not going to affect the large banks. I think Wells Fargo is fine. I get that there was a glitch. Look, you're going to see this you're going to see long-term problems for private equity. You're not going to see them for large public banks. Where you're going to end up seeing
and I think I'm gonna jump in just because your mic isn't great. So as you fix it, I'm just gonna jump in. Could the impact be? So that's why it goes back. I would ask the question again to you, Wahid. Is that what are we gonna see in the tech industry? What are startups? What are the businesses gonna do? And what are VCs? How are VCs gonna respond?
They need bridge loans. They need to fund payroll. There's the element of chaos.
So where's that money? Where's that money gonna come from?
I don't know. It's not gonna come. It dries up.
It's not.
Everyone shuts down.
Okay, so there's 500 billion of dry VC powder. If you have a great company and they lose the AR factoring line, Founders Fund for their best companies is going to come in and they're going to do some sort of a bridge. It's not like all these companies are going to zero overnight, but I do think that some of them will find new banking relationships. Some of them will have to close down, unfortunately. But for the broader banking system, what people may not realize is that 20 years ago, we had 17,000 banks in the United States. Today, we have 4,970 banks, of which 500 are publicly traded. This is the 14th largest. It is outside of Silvergate. It's really the only commercial banking.
So what did you say? How large is it? How large was it? Sorry, what did you say it ranks?
So 14, but it's one out of 4,970 banks.
It ranks at number 14. Is that big?
It was 220 billion of assets. I might have misspoken. It might have been 4.
It is.
Yeah.
Mario. It is. Yes.
It's just the top 10 are very concentrated, and then the super.
Well, what did we? Sorry. Special situations. Not sure if I will call you a different name, but hold on.
Jay,
have we had others? Have we had other banks that I missed that have been dropping like dominoes, excluding Silvergate in the last few weeks? Because I just haven't seen much build up to this.
SBNY and FRC and Schwab in the last few days, but SBNY for several weeks.
And then what do you think about the point that I mentioned earlier? I can't remember who said it, that 28%, and Wahid agreed with it, 28% of bank capital has been wiped out because of the interest rate hikes. I just don't understand how that's not a...
I think it's a little high because there's a nuance there. That the AFS losses, so the 600 billion plus is spread across AFS, about 50%, 50% across HTM. The AFS losses are already they're already in capital ratios because they flow through the GAAP income statement through AOCI into the CET1 ratio. So I think that number is too high. It's probably less than half that, but it is a big number.
Yeah, so the source here is the website. I probably need to open an account, biznow.com, bisnow.com. The person who wrote it, the author is Patrick Sisson. I'm trying to get his source, but it's gated, and I don't have an account.
Yeah, does he give you the exact dollar number of what that 28%?
Yeah, so I'm trying to. Yeah, I'm gonna try to find it. I'm gonna try to find it because that number.
That's not uniform across every bank, right? Special situations.
Oh no, not at all.
You will have.
There's some banks like JP Morgan that only have 12% securities, and you have some banks like SIVB that have 40% securities. That, by the way, they wouldn't have had any problems. There were no major problems yet in the loan book. It was they didn't use interest rate hedges on 91 billion of mortgage-backed securities that they bought at the top of the market. It's like buying tech stocks at the top of the market with no insurance. It was completely management problem.
And then a bank run. Monetize them on a bank run. That's what happens, and you will see. I mean, That's what everybody's talking about. And I'm going to have to run here, Mario and Scott. Thank you so much for
Thanks,
having me
James.
up here. It's good to hear all of your perspectives, and I appreciate. I've learned a bunch this panel as well. So,
No, I appreciate
but
it.
you know, the bottom line is what we're waiting for before I leave. What we're waiting for this week, and what everybody's watching for is there another bank that's experiencing a run that we have not heard of yet, and that's what we're waiting for. And we will be, you know, we're listening and
James,
and
Well,
just
there are
one.
a lot of names. I just don't want to name anyone because I don't want to create any type of fear.
There's a lot of names.
Agreed.
With that, hold on. Yeah, sorry.
Sure.
So a lot of names. What, guys? Just can you? I know you're finishing a sentence, James. What's that concern you're referring to before Special said or before Ray said? There's a lot of names I don't want to mention.
I'm concerned that there are other banks who are related, you know, to SVB and who are experiencing similar runs and are undercapitalized or have their books marked to a point where if they have to liquidate, it's going to cause a liquidity crisis. That's
And are
what
you
I'm
looking?
concerned about.
Are any of them larger? The ones that you guys have in
No.
mind? Are any of them larger
No,
than
more
SVB?
regional,
No, they're not big.
or tech focused, more regional or tech focused. Yeah, that's right. So, but those that just starts a waterfall, you know, and that's what we're watching out for. Will JP Morgan collapse this weekend? No, of course not. That's nonsense.
Diamond will be stronger, right? He's getting hundreds of millions of dollars every
They will get
hour.
stronger. Yeah, it's consolidating wealth into the largest banks. All right, guys, I got to run. Thank you so much for having
Thanks,
me. It was
James.
awesome. I learned a ton, and I appreciate it.
I appreciate it too. So I'm trying to get those numbers as well. Wahid, just quick question for you. With Yellen saying that she expresses reliance in the banking system's resilience, does that show that we might not see? Obviously, there's like I don't know. Does that indicate anything that a likelihood of a bailout is unlikely, and the likelihood of a reversal of interest rate hikes is also unlikely, or is that just an empty statement that you'd expect from the Treasury?
Yeah, from the Treasury, who said that we will never see a financial crisis in our lifetime. Anyways,
Completely empty. I agree with you.
Yeah, empty. But when she says that, it's the equivalent of Bernanke saying it's contained. So that puts the odds of a crazy.
But she also says, and regulators have effective tools to address this type of event.
Okay, put out a statement so that there's no panic with Silicon Valley, that deposits will be protected.
That is a press release. What I'm just reading out now, that just came out 10 minutes ago.
Okay. Apparently, depositors can pull out $250,000 of money starting on Monday, but it's only the government insured first.
Well, that's because they were transferred to another bank. But that's usual with FDIC. I'm concerned about the other money. I really am. Really concerned.
Yeah, I just want to go back to the Fed rate conversation. I actually just pinned a tweet with the updated probabilities of rate cuts / hikes over the next year or so, and it's actually crazy. We're now seeing at least 5 rate cuts priced into futures, and
what happens? So this kind of leads to a question from the audience. If you don't mind, Kabese, I'm going to ask it to you. Yeah. And audience, I'm going through your questions or comments just for the audience, so bottom right corner. And if you do have any information you want to share with us, just a reminder when there's like urgent spaces with breaking news, and we do this all the time. Just DM it to me. My team is checking my DMs. We have to just make sure you mention the source, otherwise we can't mention it here. And if you've been impacted, do share your story via DMs. If you want to do it anonymously, we can read it out. If you want to come up on stage, we can send you an invite. But basically, one of the questions in the comments is if we start seeing a reversal by the Fed, what do we see then? What do we see in crypto? What do we see in the tech industry? How would risk assets respond?
How would you define that reversal, though? There are various flavors of a reversal.
I think what he means is the Fed pivot to not raising rates as aggressively or cutting rates, right, Mara?
One or the other, yeah, exactly. How would the markets respond to each one?
I think the initial response is going to be a rally in risk on assets, because the markets will finally get that buzzword they always wanted: the Fed's pivoting and not raising rates as aggressively. But then I think after that initial hype of the Fed finally pivoted, people are going to come back and say, well, look, now we have, you're basically picking your poison. You either now inflation's either going to keep running, or if the Fed goes back and doesn't pivot, then this financial system is starting to feel the pain. So I think the initial reaction would be you see some upside in risk on assets just naturally based on the way this market has been trading. And also building kind of on what Jay was saying, it's with the access, the ease of information. I mean, just on Twitter alone, this market is moving literally on headlines that are sometimes not even confirmed and honestly being interpreted completely different ways by multiple different people. Today's jobs report was a perfect example. It was completely mixed, but the market had, complete opposite reactions throughout the day. So I think, the long answer short is we'll see risk assets bounce a little bit if the Fed does pivot. But I think the longer term prospect for the market, if the Fed pivots right now, are not too bright, because then inflation is going to come back and you're going to have to sacrifice something here to save the system.
Yeah, I mean, I think that's definitely valid. I just think that, listen, there are a lot of leverage players in the market today that didn't exist in 2008, right? You have a huge amount of CTA buying. You have, the U.S. is perceived differently overseas. So you have 250 billion of foreign money that came into the market, which drove it to local highs in February. You have retailers trading 1 trillion notional of 0 DTE options every day. And you have hedge funds, right, which are the swing players that were levered, 3-4 times gross, that brought down their nets and then had to aggressively buy when the short covering started. So and retail is now 35% of trading volume, up from 15% in October of 2019 before Robinhood came about. So you have all these leveraged players whipping around the market, and believe it or not, there's a lot of cash on the sidelines, right? People made a lot of money during COVID. Corporations have a lot of cash, banks have a lot of cash, and there's just a lot of capital. So
there's always
the valuation.
I think that's right too, Jay. But there's also the point that a lot of that sideline capital has rotated back into markets, into equity markets specifically, over the last, call it, 3 months.
But there's 6 trillion in money markets, right?
Right. No, and I think though there's a lot of capital that is. I agree that there's a lot of dry powder on the sidelines, but I also think there's a lot of capital that rotated back to the markets on this Fed pivot thing, just like we saw in September of 22. And then the data was revised, and Powell talked about this in his testimony. The data was revised higher. And before this whole SVB thing took over the media, we were already seeing the S&P down over 5% just on that very fact that people that were betting on a Fed pivot realized that the data literally changed. And PCE inflation was rising again for the first time in 4 or 5 months. I think that argument goes both ways. I mean, you do have a lot of sideline capital, but at the same time, a lot of it rotated back into equity markets over the last 3 or 4 months.
Could I ask how this affects institutional 401ks, Fidelity in particular? Because as you know, what happened when we had one of our many 3 prime ministers, 5 chancellors in the last 6 months, we had a situation where we were very close to closing up some of the bigger institutional pension funds.
Stock Talk, maybe you could take this one, and I'd love to get your thoughts on what you've seen today, because I know you've been tweeting about it heavily, Stock Talk.
Yeah, no, me and Jay actually hosted quite a lengthy space yesterday on it. Hosted 2 of them.
What's the sentiment like? How would you summarize it in like 3 sentences or 3 minutes?
Yeah, I mean, I think this is it's not a small bank. We were talking about it yesterday.
14th largest, no?
No, not the 14th largest, but it's about a tenth of the size of JP Morgan, less than a tenth of the size. But it's a niche bank in terms of what they did, right? They're very VC tech focused, and so the contagion, if there were to be one, or I imagine there will be some level of contagion, is going to be in that industry specifically, and there's going to be beneficiaries from a market share perspective, right? Me and Jay talked about this last night as well. There are going to be other banks that are in this niche of providing capital to tech VCs that are going to be flat out market share beneficiaries here, right? Because the industry is not going to disappear, right? But what is going to happen is that there is going to be some level of short-term contagion and sentiment. I mean, today, one of the big standout trades of the day today was shorting Sunrun, which is a company that was depending on a cheap credit facility access supplied by SVB, the stock cratered today. I mean, I think it's trading down 17% today behind this SVB collapse, as are a number of other small growth and technology companies, biotech companies, variety of small to mid market cap publicly traded companies that were depending on SVB being a niche bank in this space to provide them relatively cheap credit facilities. And now those companies that are high cash burn companies whose valuations are already, under a lot of pressure in this monetary policy environment are becoming really good short cases. And today the market jumped on a bunch of them. I mean, there were dozens of these names down 15 to 30%. Even in the regional bank space, I mean, there's names that today were down 30% that have no affiliation to SVB at all. So there's a difference between like the fear driving markets and then the actual implications of this. And I think that Jay had a very sober outlook on it last night when we spoke about it. And I agree that this isn't. I don't think that this is necessarily like the moment that like collapses the economy, but the fear becomes that other banks, maybe bigger banks, could get put under pressure by this. Now, do I think they're at risk of insolvency? No, that's a separate conversation, right? But the fear and how long that can last, the selling pressure that can create in markets is a concern. We saw it today. I mean, the impact today was very broad. I mean, anyone that was paying that pays granular attention to markets, like I scan markets by industry every day.
It was unreal, right? It was like you just
unreal.
go look.
Like
You could have bought FRC at basically a fraction a book. It doubled and then sold off 25% after the receivership news. Like we're talking about a $220 billion asset bank.
I mean, I just combed through filings yesterday when I heard about this news and identified like 25 different small to mid cap companies that were quite literally dependent on these credit facilities provided by SVB. And a lot of what happens is these funds like Founders Fund and other VC funds, Y Combinator, Jay made a great point yesterday where he was like, it's so stupid for them to be clamoring, and rooting for the downfall of this bank, because what a lot of these guys have done is they've told every company they work with or invest in, hey, just bank with SVB, because all of the companies we invest in bank there, and we get favorable credit facilities or whatever the case may be, and all of these companies go and bank there. It's something like 40+% of all tech VC money had some affiliation with SVB. So this is a massive bank in that industry, and that's
Hey
really
man,
like,
Jay, man, look, I've just been researching Stock Talk. I've just been researching because I want to get my numbers right. So we didn't have speakers on the panel about half an hour ago. I mentioned that Silicon Valley Bank was the 14th largest bank in the US. And I've just confirmed it now on another website. It says it's as of 2023, it's the 16th largest bank in the US with $210 billion in assets.
I don't know the exact rankings off the top of my head, but yeah, I mean, it's not one of the top 10 banks, but yeah, it's not a small bank. Yeah,
it's not bad. Man, I had no idea. I just, again, I was surprised when someone mentioned it on the panel. Asked for clarification. They confirmed it, and then I mentioned it to you, and you reacted. It's not. And I've doubted it again because I couldn't believe it initially as well. So I've just Googled it. And now that I'm telling you it's the 14th or 15th or 16th, in the top 20 largest banks in the US, does that change your perception of how big this is?
If it was,
because I honestly thought when I first saw this, man,
what I'll say is that if it was a broader focused bank, then maybe that would change my outlook. But because their focus is niche, again, I could be completely wrong. Maybe this contagion does spread, right? Like I don't know if you guys already touched on the Wells Fargo thing from today. That could be a complete non-issue.
I don't know if Stock Talk. Hold on, bro. Hold on. Can you tell me the Wells Fargo glitch again? I don't sit there looking at glitches, and I wasn't doing live spaces in 08 or during COVID. That glitch, I just ignored it, and we talked about it very briefly. Could it be something worse? Because there's no way they're going to call it a glitch when it isn't. We're not talking about crypto here.
Look, this is the thing. This is the tricky thing.
I don't think
has that happened? Has it?
The tricky thing about banks like making statements like that. Again, I want to be clear. I'm not making the implication that there's any problem with solvency at Wells Fargo. I'm not saying that, but I think the sentiment issue when banks say things like, hey, it's just your money is safe. The issue is that like when people put money in banks, the reason people just like sign up for a bank account and put hundreds of thousands of dollars or millions of dollars in a bank without thinking, the reason that happens is that there's an implication. It's a set implication, right? I'm not saying everyone believes this, but broadly speaking, people feel safe putting their money in a bank because they think, all right, it's insured, it's protected, it's safe, a bank is regulated. There's no way that my money could just disappear. And so when there are errors like this at banks, and then banks come out and say things like, hey, don't worry, we're working on restoring services, right? They may just be saying it to reassure, and it could be a nothing burger. But in a lot of cases, it creates the sentiment that like, why are you reassuring me? Like, in a normalized environment, Bank of America isn't sending you emails every day saying, hey, just wanted to remind you, like, your money is safe. Like, just wanted to let you know, like, they don't do that, right? And so that's why reassurances are perceived in the banking industry as scary, because they're like, they should have a cause to reassure you. And, in the case of yesterday with Silicon Valley Bank, like I tweeted when the reports first started coming out that business clients couldn't access their accounts, I tweeted out a screenshot of it that one of their business clients had sent me on DM, and immediately people were in the comments and they're like, this is FUD. My money's safe at Silicon Valley. One guy commented on my thread and said, I have $20 million there. I'm not taking it out. It's safe. And
when was it? Hold on. When was that? When was that? When was that?
That was yesterday. I tweeted yesterday.
This is the shit that we went through. This is why whenever someone calls me saying,
but Mario, my point was the message that they had yesterday was, hey, we're restoring functionality. Don't worry. Right. And so
hold on.
Morning, the FDIC is in the office. So it's
hold on. Silvergate, fucking Silicon Valley Bank. They just said they're restoring functionality. They blamed it on a potential glitch. Is that what you mean?
The tweet at the top that I tweeted yesterday, and then a lot.
But hold on, is that? But hold on, man. We're not talking about crypto anymore. Is that even legal?
I mean,
no. They can say at the time that was the case, and the FDIC came in today and said there's no sale. Right? They could say that. And also just to your point, you were talking about
hours ago, and I have the quote there. It says, Silicon Valley's online banking system is currently unavailable. We apologize for any inconvenience this may cause and are working to restore service as soon as possible. Sure enough, they never restored service. This morning, the FDIC took over the bank.
And if I want to go, everyone just have a look at that tweet. Just go through the comments. Like the first comment is misleading. It is working just fine. I remember that's during FTX days. And it goes back to one of the quotes I read earlier. I think it was the founder of Y Combinator. It's better. It says, I'll summarize it in being better, be safe than sorry.
Mario, I sent you an article from Australia. It's worrying me. US bank, Silvergate Capital, major US bank goes into liquidation. Have you seen the article I just sent?
Okay, so let's put it in perspective in terms of number of assets and number of deposits. So as a percentage of deposits.
Sorry, just two secs. I do want to mention one more piece of news. Scott just sent me. Scott, can you tell us about the USDC piece of news you mentioned before we go to special situations? Or Ray?
Sure. This is coming from Unusual Whales, which is a large account on Twitter. Circles USDC, the second largest stablecoin with 43 billion market capitalization, has an undisclosed part of its 9.8 billion cash reserves at the now collapsed Silicon Valley Bank. This is something we were talking about earlier. Now we did a bit of digging here before we cause any panic. I'm actually looking at the attestation from November of 22, so it's not entirely updated. This was a tweet from Jeremy Allaire, the CEO of USDC at that time, which links the attestation. 80% of USDC reserves are held in US 3-month or less US Treasury bills and in custody with Bank of New York Mellon. The remaining cash reserves are held across 7 to 8 banks in fully segregated accounts for the benefit of USDC holders, to which he links the attestation. And that then links the banks that they have exposure to, which is Bank of New York Mellon, Citizens Trust, Customers Bank, New York Community Bank, Signature, which they got out of, we know, before the collapse of Signature. Silvergate, then Signature, Silicon Valley Bank, and U.S. Bancorp. So before this causes a mass panic, 80% is with Bank of New York Mellon, at least as far as the end of last year. And the rest, being 20%, is spread between these 7 or 8 banks. But that means it could be a few percent, certainly.
Yeah, it could be 3% if you take the expected value.
Right, but considering that they moved out of Silvergate the other day, right, we don't know how they amortize that or spread it around these other banks. But listen, I don't know that I would never make a claim that this is going to collapse USDC. I have exposure to USDC. I don't think there's a reason to panic, but I think that this should just tell us, going back to what we've been talking about the entire time, that there are always going to be unforeseen things that are coming from all of these, because obviously the main topic here is contagion. And to the point of a lot of people who have spoken here, I think we're just going to see a lot of little stories like this, some large, some nothing burgers over the next few days.
Yeah, like if anyone sees a tweet, if anyone sees a tweet saying Yellen warns U.S. House members of economic collapse from default, now suddenly spreading. You know, that's been a warning for a while. It's a silly. It's nothing to be worried about. It has nothing to do with the current banking crisis that we're facing. I do want to read out, and I'm asking that person if they can come up on stage if they want to share their identity. I'm going to read out exactly what they said. I'm an employee of Wells Fargo. With how much they've lied in the past, I would never believe them with all their wrongdoings and the highest ever penalty with a recent scandal and $2.2 billion fine. Again, I'm not saying their glitch is not a glitch. I don't want to imply that either. I just thought it's worth reading something coming from an employee of Wells Fargo. But I'll try to, if anyone knows of any similar. Actually, does anyone know in 2008 did any bank try to blame an issue due to technical issues when it was due to liquidity concerns? Because I just genuinely don't think banks would ever do that. I think the risk is too
let's
high.
just put it in the numbers in perspective, right? So Wells Fargo has 1.9 trillion of assets, right, against 960 billion of loans and 1.4 trillion of deposits. SIVB had 200 billion of assets, slightly less of deposits. The banking sector today is 30.2 trillion and 18 trillion of deposits. So when you look at SIVB as being the 14th largest bank, it was 66 basis points, 2/3% of the US banking assets, whereas Wells Fargo is a systemically important bank at roughly, as of the fourth quarter, roughly 6% of the US banking system. There's no way, right, that our federal government is going to allow 6.1% of the US banking system to not acknowledge a bank transfer. These banks have run old technology, and I would not be surprised. Some of these banks are still running mainframes. I wouldn't be surprised if it really was. I have banking issues with KeyBank every day. Like every day I have issues with transferring. Like at least once or twice a week.
Hey Mario, I'm not sure if you saw this, but it was just released that the CEO and CFO of the Silicon Valley Bank sold $4.4 million of stock in the last week.
I don't get
So I
this,
was
so I'd
muted.
love
I
to
just
have
said
it explained.
Say that again, Moneypenny.
I said I'd love to have it explained. This Silvergate apparently has lost 1.5 billion Aussie dollars in just the last couple of months, it says. And why are we not even taking this on board? I don't understand.
Well, that's a very small organization. Yeah. It's a very, very small organization.
It's more for crypto. Yeah.
Australia, I think it's big.
More,
they're calling it major US bank.
I mean, anybody.
Sorry, I just pressed the mute all. I mean, on mute. But it just shows that I don't know how big of a problem is this to TradFi or the tech sector versus just crypto. I just think crypto's just been assaulted month after month, and every time you think things can't get worse, you have something like this coming in. And I asked the question earlier, who's left? Scott, I just don't know how things could get any worse here for crypto. I thought FTX was it, then I thought DCG was it, and now the Binance FUD was it, and now we see this.
Bitcoin's still $20,000.
I mean, Silvergate was a $2.3 billion of assets, 268 of equity, and 1.7 billion of deposits that went away. It is 1/100th the size of the 14th largest bank of SIVB. So obviously the media is going to say it's big, but it was almost meaningless when it comes to the commercial banking.
How does it? What does it compare to? How the size of Silvergate?
The size was 1/100
Silicon Valley
of Silicon Valley.
Did you guys touch on what percentage of the deposits were over the 250K limit yet?
Yeah, it was 150 billion for SIVB. It's terrible. It's
that are over
terrible.
the 250K
Yeah.
deposit limit.
Yeah, it's most of the
I just
deposits
see-
because
I
they're
just saw-
corporations, right?
I think it's
It's not
97.
individuals.
I think it's 97% of the deposit.
Yeah, I just saw a headline
And
that said
Silvergate is 11 billion. 11 billion US dollars is Silvergate being quoted by the Australian article that I sent over to Mario.
Well, the 11 billion that they're talking about it's a lot different than the Silvergate thing because it was invested in short-term treasuries. They just liquidated that, right?
No, that was
the net
Silvergate.
of it was Silvergate, but
What
net
was
of
the
that
dollar
short-term
amount?
treasuries.
Really quick, what was
Net-
the dollar amount on the non-FDIC insured portion?
$150 billion
Oh,
at
fuck.
SIVB. And with Silvergate, net of the short-term U.S. treasuries, they only had 2.3 billion of assets. The other stuff is just very short-term. It's like 3-month treasuries.
All right, so we got here. We're trying to get the exposure of USDC to SVB, but it's fascinating to know that Silvergate, and Brian, I know you have your hand up, but Silvergate is only 1% the size of Silicon Valley Bank. That's ridiculous. Brian, I know you had your hand up. I'm just going through all the reports we're getting from the audience, and we're sharing the ones that we're able to verify. Brian, you want to jump in? Brian Krasenstein, I saw your hand up. All right, well, he's unmuting. I'm just looking at the Scott, from the numbers you've mentioned, is there still any reason to be concerned about USDC?
I mean, I think that if you've been in crypto in the last year, there's reason to be concerned about everything at all times, right? And I think that it goes back to and like I said, I have exposure to USDC. I'll be monitoring the situation. But I think this goes back to the original ethos of crypto, which is not the topic of this space, but not your keys, not your coins, right? And we've kind of beat the Bitcoin topic to death earlier.
30 seconds, just
risk.
quickly, sorry, Scott, just quickly, 30 seconds ago, the White House, US banking system has to hold more capital than it used to and has built more resilience to withstand shocks.
Yeah, sounds familiar.
PRA in the UK called, HSBC, Barclays, NatWest, Lloyds were all called together by the Bank of England today under the PRA, the Prudential Regulatory Authority, which is the regulator for the big banks, and said that it wanted to shock test the UK banks. And it came out with the conclusion, this is just obviously in a brief look at it today, that the British banks were resilient, it said, and that this was a US-made issue.
All right, so I've got the employee at Wells Fargo. He works there at the moment, but he does not want to reveal his identity, so we'll keep that private. He's currently working at Wells Fargo. So he's obviously listening to me right now. So I'll ask you questions, and I've given you my number. The team will give you my number so we can chat directly. But do let us know if there's anything of concern at Wells Fargo. I just don't expect it. For anyone in the audience, I don't expect any issues at Wells Fargo. I don't expect any issues at the big banks. Because if we start seeing issues there within hours from Silicon Valley Bank going bust, yeah, I'm I'm moving all my money to Bitcoin and getting out of all the banks.
Sorry, Mark. I didn't mean to not respond. My son got home and I had one other room.
Yeah, all good, man, all good.
But no, I was just gonna add that I think it could actually. I mean, there's a potential to be a positive for crypto in that people are taking some money out of banks and putting it in crypto. Of course, it's going to have the impact where some of these crypto companies might have some connections to SVB, but ultimately it might not be terrible for the crypto space.
Who's putting money in crypto? Most of the people that I'm talking to are just putting money at JP Morgan.
Yeah, no,
I just don't see if you saw money going into crypto. Yeah, sorry, Brian, go ahead.
I was just gonna say, yeah, I think the big banks are gonna benefit, but I do think that there's some who probably will, if they were considering putting money in crypto, this might be an opportunity. But yeah, JP Morgan, Bank of America, those are going to be the big beneficiaries.
So I'm just going to read out here. Tweet: with the collapse of Silicon Valley Bank, expect a wave of tech layoffs and shutdowns, which will shift Silicon Valley culture into he's talking back to crypto again. Shift it to decentralized finance, which I just don't see that shift. People are just terrified of crypto right now. Simultaneously, expect the push for new tech-focused banks with less appetite for risk and stronger diversification. which is interesting. I think we will see, and Wahid, you're gonna know Wahid's on stage with us. You'll know who I'm gonna refer to now. But we are talking with a really large player that's coming in to compete with Binance or all the exchanges. Now that player pride themselves on being conservative, pride themselves on being the most licensed, and you know, taking things slow, not getting into crypto during the bull market just because they had a lot of concerns. And we're going to see something. We're going to see a similar shift as that tweet says. We're going to see a similar shift in tech as well. We also did see some of the big players like Kraken. I think it was Coinbase, or who was it, Scott, that was launching their own banks. So people within crypto launching their own banks.
Kraken has a bank charter in Wyoming, state banking charter, but not. There's different kinds of banking charters. It would have to be fully backed. I believe they're not allowed to actually participate in loaning, but they are actively pursuing to become a bank, and they do have the charter. Custodia Bank, of course, led by Caitlin Long, also in Wyoming, just had their Fed master account rejected. Once again, I believe Abra, led by Bill Barhydt, which is a crypto, I call it a lending platform and exchange, much like, honestly, the one that survived among the Voyager, BlockFi, Celsius crowd. Also, I believe, is gearing up to attempt to become a bank. But I would say that with Custodia's rejection of the Fed master license in January, the very end of January, that was sort of the first opening salvo in this attack on the crypto industry by regulators and legislators. And so I think that those
that's a real risk.
Are probably going to be on hold.
Because like Kraken got their banking license in 2019. I remember Kraken got it from the state of Wyoming, kind of the end of 2019, and it doesn't look like they're going to let any new banks get that charter.
I agree with that. I think that we're at a point right now where everything would be on hold at best.
Yeah, I'm just going through all the information we're getting now. I'm seeing what we could share, what we cannot share. But I don't know. I don't know how worried we should be about this. And in crypto, I just don't think there's anything left to fall. But now it's just spreading to other risk assets, with tech being the highlight. And I'm not sure how deep this contagion will go.
Yeah, Mario, I just want to clarify again, because we said it sort of at the beginning and not at the end. I don't think that, well, first of all, Silicon Valley Bank is definitely nothing to do with crypto contagions. You could certainly argue that Silvergate was. But once again, just for people who are new and haven't been listening, the reason these banks are going under is largely because of mismanagement of their treasuries and their balance sheets. They were invested in short-term treasuries that they bought for sub 2% yields. Now you can get 5%. And when they need liquidity, there's buyers for those bonds that they purchase, but at an extreme discount, which means they lose a ton of money, which means they have a further hole. And during any bank run, they lose their money. So this is poor management by the bank of their treasuries and the money that they have. It's not a result of the tech industry or the crypto industry per se.
What about the timing? Obviously, on the announcement of the budget taxing assets at 45% that was announced yesterday. Is that related in any way, do you believe?
No, I think that's completely political, and it's because of the budget deficit and the debt ceiling that's coming.
So what triggered this today? What's the timing being triggered by? That's what I don't understand.
The timing that's being triggered is 13 VCs yesterday at 11:30 p.m. PST listened to the CEO, told him to F off, and created a run on this bank. That's why the timing, that's why the FDIC had to come in this morning and take it over. It was because these VCs forced a run on the bank.
So this is as an isolated thing based on that. That's what you believe?
Yes.
That's what I believe. Yes.
Okay, that doesn't mean
you.
There won't be contagion, but it has nothing to do in general with the previous contagion or anything happening in the banking system beyond the obvious, which is the reasons that the banking system in general, with a lack of liquidity, would have problems. And obviously the fact that nobody is newly depositing when they can get higher yields with a treasury.
So based on that, would you not say that your advice would be to people that are listening, living in the US, that they should spread their money across different banks so that they get the $250,000?
$250,000 maximum as an individual investor at multiple banks is probably the pragmatic and intelligent approach at this point. Although, yes, it seems aggressive. And again, if you're with JP Morgan or one of them, I doubt you have a major problem. But yes, I think that is a reasonable thing to do if you're concerned.
And can you do anything about your 401k, or should you do anything about it?
That's a great question. You know, it's certain firms like Interactive Brokers, they do overnight cash sweeps. So they'll sweep your cash automatically across, I think, 11 or 12 banks in their system. I think it might even be much higher. It might be in the teens. So they do it for you, I think. It depends on the firm, right? A lot of firms won't do that for you.
Because Fidelity opened up a retail platform into crypto, allowing the employees of the employer schemes, institutional schemes, I presume.
I don't think they do a cash sweep at various banks of Fidelity. I don't think they do that. They do that.
Okay, thank you.
But once again, Silicon Valley has nothing to do with crypto.
No, I'm just looking from the US, investor perspective. If they've got money in 401ks, it's just because that's what happened in the UK when we had a bit of a default, when our inflation leapt up and our base rates were high. We had a pull because of the amount of bonds held in institutional funds.
I mean, to be fair.
So hold on, Prodigal, before you go, Prodigal, I want to give you the mic. I was actually going to go to you as well. So I'd love to get your thoughts on this. You've been awfully quiet today. Usually you dominate. But I do have Mark Suster mention something interesting, is that we're talking about contagion, and just focusing on exposure, but we're not talking really about the impact that panic could have. So I'm going to read out what Mark Suster said, a partner of Upfront Ventures, and he urged those in the VC community to, quote, speak out publicly to quell the panic around Silicon Valley Bank, and that classic run on the banks hurt our entire system. Again, run on the banks hurt our entire system. So my concern is, obviously we saw what panic could do in crypto, and we saw what it could do in 08. If we do have that level of panic in the traditional financial system, could that be the main trigger for the contagion we're talking about? And it could go beyond the tech sector, which is something that most of us don't expect to happen. But that's why it changes. My opinion changes, is that panic could lead to the banking system as a whole to suffer.
I think that by the end of this, you'll probably see less than 1% of banks. So out of the 4,970, I think you'll see less than 1% of banks have this type of issue. So, think about that. The second thing is that, yeah, of course, there could be further defaults, but I think it's going to be for other reasons. I don't think it's going to be because of the same reasons that affected.
But when you say, Ray, I've just got a quick question. About less than 1% have this issue, but I'll read out a quote here by Sethi. He says, any bank with a business model is dead if everyone moves. I know it's very basic knowledge.
Sure.
But it's
so
something
if everyone
forget,
takes
like,
out
no matter,
if everyone takes out $18 trillion of deposits tonight, where are they going to put it? Under their mattress, under the underground, in their friend's pool? Like, where are they going to put it? They need it for working capital. They need it to conduct business. They need it for safety. They need it for security. So, where are they going to put all this money?
But what would it take for fear to spread to a level like in 08? The financial system just froze. No one trusted anyone anymore. Counterparty risk was an all-time high.
I think you would need an assumption that tier 1 capital ratios at banks were just going to get cut by like 30 to 50%, which would just be it would be worse than 08.
Could geopolitical risks play a role in all this? China tensions, obviously Ukraine war escalations.
These are broad questions, but if there's like a nuke that went off right in a major city, of course that could create the type of contagion you're talking about. But if China
that level, but
Taiwan, absolutely not. Absolutely not. Absolutely not.
Okay, hold on. If China invades Taiwan, absolutely not. What?
Absolutely not. Would that just start a banking contagion? I think there'd be some geopolitical stuff that would be associated with that. First of all, I don't think China needs to invade Taiwan because they already control it through all the food exports, and they basically run drones through Taiwanese airspace every day. They control it. They don't need to do anything.
Yeah, no, but they've said, but Jay, they've said, it's Ray or Jay? Sorry, because it's not on your profile.
Jay.
Jay. So Jay, but we've heard various officials, including the president, say that Taiwan belongs to China. They will reunite Taiwan, and they did not. They never said they won't use force. They even said explicitly, Hong Kong didn't have the US saying,
they walked right in.
Yeah, but then again, Hong Kong, but the US never said, US has explicitly said, Biden explicitly said that with Taiwan, the US will use military force to protect Taiwan. So that's why this one concerns me a bit more. And if what you're saying is that if China takes over Taiwan, US doesn't get involved, we're fine. But if the US and China do have a direct confrontation, obviously it's a discussion that's worth the whole space, and we've done spaces on this before. That will obviously create more fear. that could lead to a bigger contagion. And I know there are two things that are not linked at all, just they're relevant considering that we've done spaces on the other two topics as well. So I thought it's worth at least
I
mentioning.
just don't want to tie it together. I don't see the tie.
Fair point. Prodigal?
Yeah, I mean, I tend to agree with a lot of what he said. I mean, I think if it ever spread to that point, there'd be a backstop. I mean, I think the issue is this is another crack we're seeing in the economy and budgets, right? You're dealing with cities that have massive budget shortfalls from half full offices, third bankrupted businesses, and tax revenue and business plummeting with people fleeing. You have that compounded by their employees for the cities. Their government pensions were wholly underfunded to begin with, but now add to that, some departments only have 50% staff. They're unable to recruit. They're paying higher for costs. There are major cracks. What's doing good right now? Maybe green tech, military industrial complex, and commodities, depending on what's going on with geopolitics. But where's the actual growth that everybody keeps clamoring about?
Well, I mean, there's this China reopening, right? That's creating some short-term
No,
growth.
I
There's
agree with that.
lodging and
I'm
leisure.
talking about for the
You look
U.S.
at
economy and
the price of. I mean, look at the U.S. economy.
Yeah, of course, there's going to be some growth, but the numbers are mixed. They're sitting on a lot of savings, and we don't know who they're going to export their products to. Right? Europe, regardless of what they say, costs how many hundreds of billions in bailout packages and price caps and control costs were instituted in Europe. And what have we seen with the industrial base transferring over to China? There are major cracks throughout, whether it's the auto market, which we're going to see over the next
Prodigal,
year.
keep that. Just want to mention a couple of things. No. I don't want you to end it, Prodigal. I don't want you to end it. I'm not interrupting you to end it as I sometimes do. I just want to mention something just quickly important because I don't want to seem like we're spreading fear here. So before giving the mic back to Prodigal, we've got an employee, an analyst, a senior analyst at Bank of America. I just want to read out what he said. Again, keeping the identity anonymous, but has been verified. And that's just to quell any fears for whatever that means. Mario, I'm in the space right now listening in. I'm a senior analyst at Bank of America, and there are no internal concerns about our solvency. Cash reserves are good right now. There are strong concerns about liquidity in the super regional banks across the US, particularly those who are heavy in bad treasuries and the bleeding bond markets, which is what I mentioned earlier. So, and that's a valid point. I think most of us expect most of us anticipate the same concerns there with regional banks, but just worth mentioning this from a senior analyst at Bank of America. So I appreciate you sharing this. Prodigal, the mic is back yours.
I mean, the only thing I'll caution with is, I don't give investment advice. I don't care. I just post info. People can make of it what they want. But just like the altcoins are tied to Bitcoin, the entire crypto market's tied to equities. And there's never been a Fed backstop for crypto. So if people are saying, this is essentially the bottom, no, if there is runs, and major corporations and companies, big tech or whoever, are unable to access funds for their continued operations, for future investments they have, where do you think they're going to tap for liquidity, right? They're going to attack markets and to get what they need to function and continue to operate. So just like all coins are tied to Bitcoin, the whole crypto market's tied to equities. If equities go down, the crypto market's going to go down, at least in my opinion.
100% agree.
So people should be cautious.
It's a risk asset.
They should be cautious. Right? People are hedging. A lot of people are holding cash. A lot of people are holding precious metals. This is stuff where, if you're into volatility, which I don't care for unless it's a long-term macro play, you can make a lot of money, but you can lose your house right now. Like a lot of people are just trying to figure out, well, what's the safe play? And, I think that, listen, this bank going down is a big deal, but I don't think, other than the corporations that are going to be affected, which is that we'll see what the real damage is. But the government will step in if there's a backstop. But people brought this up earlier, is that this whole soft landing thing was bullshit, eliminating the geopolitical risks, right? We were always threading a fine line. What happens if Europe can't get South African coal? What happens if Israel has a wider strike on Iran that affects China's ability to secure Iranian energy commodities, right? We're walking such a fine tightrope that, this is just another crack when you look at it. We have the Bank of International Settlements coming out and saying, hey, there's 80 plus trillion in, off balance sheet liabilities. And you have central banks across the world, whether it's the Fed, Bank of Canada, Bank of England, Switzerland, posting record losses. We're trying to do Volcker at a time we didn't have debt levels in the 80s that we do now. And this is at the same time, private and public entities are going to have to roll over vast sums of debt over the next 2 or 3 years. This is not an easy tightrope walk. And anybody who has this confidence in the Fed and the ability to control it, even if they did, eliminating the geopolitical risks that could rear their head that they have no control over is foolhardy. And Mario, this is what we talked about this a month ago in the room. And I was one of two people who took a contrarian view, everybody was bullish. It's not that I'm not bullish. It's just I see a lot of issues and things that are starting to break and not function that who's going to step in to bail them out? And this is at a time.
So I agree with the last
This
2
is at a
points,
time
sir.
when Evergrande and China has basically said, well, the domestic bondholders, fuck you. And China, and as the third world and a lot of countries are seeking rescue packages from NGOs, while the West is saying, yeah, we'll cut some of these debt levels so that's more manageable, China's taking a much hardline position. There's a lot of moving parts right now, and I'll end with that.
So I think the last 3 points I 100% agree with. I think the issue is that a lot of the issues that you're talking about have been issues for the last 15 years. So yeah, they exist, but they existed 5 years ago. They existed pre-COVID. They existed after 2008.
But there wasn't this level of geopolitical tensions at the same time we were dealing with the debt and financial market risk, correct?
We always had geopolitical tensions. They just weren't in the media as much as they are today.
But they weren't.
Never to this. Listen, Iran always had nuclear issues, right? We always had issues when it came to Saudi Arabia.
But there's never been discussions. Correct me if I'm wrong, but there's never been discussions about and again, do correct me if I'm wrong. Discussions about the U.S. and Russia getting into war. The Russia using a tactical nuclear weapon was never being discussed and was never on
what
the
about
cards.
the Cuban Missile Crisis?
Yeah, we're talking decades and decades.
Yeah,
and
that
decades
lasted
ago,
a week. Europe still has to refill its tanks for next year, right? It hasn't solved its energy
That's
crisis.
the real risk. That I agree with.
Yeah.
So
Go
the
ahead,
real
Papa
risk
Joe.
out of all of that stuff, I think the main risks are this coming winter when it comes to geopolitical, right? When it comes to wheat exports, agricultural fertilizers, distillates, and energy, that is definitely a risk. And I think that a lot of the other risks when it comes to stability of the banking system, like you said, at some point there's a backstop. And when it comes to growth, I agree with you. We're entering a recession. So like there are some points that I think are very obvious, and there's some points that have been risked for the last 20 years.
What about the leak? I can't remember the general's name. The leak about U.S. and China being ready for a war between U.S. and China that he expects, or he has a gut feeling by 2025.
He has a gut feeling. I have a gut feeling. I'm
yeah,
gonna
gut
make $1
feeling.
million tomorrow.
Yeah, but you're not the general at the U.S. Army, so it's just someone in his position having such a gut feeling is I have a gut feeling that Russia would never invade Ukraine. So I think our gut feelings don't matter as much as the general. So that leak concerned me. I think the narrative doesn't usually concern me as much as it does today, just considering the situation that we have in Ukraine and what that could whether that could encourage China to make a move on Taiwan and obviously Biden's position that they'll protect
So let's
Taiwan
peel that
militarily.
back. When the U.S. budget deficit is such an issue, and like we said, 1% increase in rates, $400 billion hit. Where are they going to take that money from? It's all about money. They're going to take that money from the defense budget. They're going to take it from Medicare Advantage, and they're going to take it. They're not going to take it from Social Security, or they're going to try to raise taxes. So it makes sense for a four-star general to create fear about a potential war, because right now the U.S. Defense Department is piss scared about cuts to defense spending for the first time in decades because of this upcoming debt debacle, and to the points that Prodigal was making about the level of debts that we have today. A lot of the things he's saying could have other ulterior motives that we're not discussing.
It's a fair statement, but again, the state of things, like what we have on the ground right now, we have a war in Ukraine, with Russia fighting a country in Europe, and NATO supplying. Essentially, NATO and Russia are fighting in Ukraine, but no direct conflict yet. And you've got China with a very aggressive narrative, potentially supplying weaponry to Russia. Things just keep looking worse and worse as time goes by.
Do you know what the exact quote was, though? The exact quote from the leaked memo was that the U.S. four-star general said he had a gut feeling that the U.S. was going to fight a war with China in 2025. In 2025, is the most random quote. And it seems to be either misstated or completely biased.
Emergent, look, we'll do a quick geopolitical check. Emergent, you've been in all our spaces discussing, I think you've been in our space discussing the China. We had General Spalding on the space as well, discussing the US-China war and the risks there. Do you want to give us a quick overview on your thoughts on especially with your experience, your thoughts on those concerns before we go back to the financial risks that we're discussing with Simon Dixon's on stage as well? Emergent, the mic is yours, man.
My audio is a little bit weird. Can you guys hear me okay?
Yes, perfect.
Okay. All right. Yeah, I'd be right now just kind of looking initially, and I'm kind of reviewing a lot of the takes out there and kind of taking the temperature in the room. So I'm going to be a little reserved in my judgments here. But, if we are looking at a broad spread or spreading market contagion or crisis that could affect, multiple, if you get even a minor event in U.S. markets, it's going to spread to global markets. It is the kind of situation where you could see something like Russia or China or, any of these small powers look at that as an opportunity to do something that they want to do. I mean, I still think those things are very heavily calculated and weighed decisions. So I think you're unlikely to see Russia, China, any big global players like that. They're not gonna make a shoot from the hip decision on escalating in Ukraine or invading Taiwan or anything like that. If they make a decision or take an action, it's going to be some kind of plan or some kind of contingency that they've long since calculated, and they're just looking at, well, what's going on in the markets might be a trigger. But I'd be very reserved about seeing any big moves like that until we kind of see more how this is going to play out.
And Dr. Gorka, I've just sent you an invite. I'm not sure if you're busy. Dr. Gorka, everyone just goes into our political spaces, gives us great overviews. So it'll be great to have you for a few minutes. Just give us your thoughts on this discussion, the geopolitical discussion and the potential economic impact, before we continue digging into the Silicon Valley Bank story. Papa Joe, the mic is yours. Simon, good to have you back, man. Papa Joe.
Hey guys, thanks for having me up, man. Really appreciate it. And just want to kind of provide a contrarian point of view, if you will, around the crypto discussion. I know we're talking about the geopolitical stuff, but kind of bring it back to that space. I've been in that space since almost the beginning, was an earlier miner, all that fun stuff. And for me, watching the different sectors and the different banking sectors and the different currencies, the fiat currencies around the world, knowing that historically speaking, from a monetary history perspective, and I know a lot of us know this, for the past 5,000 years, gold and silver have been actual stores of value. Well, since 2008, when the last crash happened, at least from my perspective, we've been given, I really do think, a gift with crypto because of the blockchain technology underneath it. I'm a technologist. I've been in, my background's been in IT and all that fun stuff. From the technology perspective alone, it gives us as humanity a chance to be free of the banking sector. Now, the banking sector is great. It's offered a lot of different great, wonderful things. The fiat currency has been fantastic for all kinds of reasons. But historically speaking, every single fiat currency has failed 100% of the time. Now, we have with blockchain technology the ability to actually have that freedom, because there isn't an entity that can run Bitcoin, as an example. There isn't an entity that owns it or can control it or anything like that. I think that a lot of people, just like, again, from a contrarian perspective, I have more of a gut feeling, if you will, that as the fiat currencies of the world fail, and this could be the linchpin that starts that, I'm not saying it is, just one of those things is kind of like, well, let's see if it is. I think that if this is, in fact, that linchpin, you will see a significant amount of that fiat flee the markets and go into different cryptos in general. Maybe it won't be Bitcoin, or maybe it won't be something that's something that's a little more volatile. I think once you have a significant market cap in Bitcoin, though, the volatility goes away significantly. Now, that's, again, all speculation. It's just a contrarian point of view. Just wanted to throw that out there for everybody. From someone who's been in the space for a long time and just kind of watching things happen, and it really, really feels like we're going to be heading in that direction, where there's going to be a significant outflow in the markets and a significant outflow in the banking sector. We're already seeing that kind of bank run. Last time there was a bank run, there was nowhere else for it to go except for dollars or gold and silver. And now we have crypto. Now we have something that can't be controlled or taken away because of the technology.
Yeah,
it is everywhere and yet nowhere.
Everything you're saying, fundamentally everything you're saying is true. But we're just coming back where from our leader, Sam Bankman-Fried, who was there in Washington lobbying for us, end up being the biggest scammer in the history of crypto. So I just don't think it's like, if that didn't happen, we could be having a very different discussion. We could probably have the discussion where Bitcoin, it's time for Bitcoin to shine, but people do put crypto in the same basket. The liquidity isn't there. I just don't see At least not yet, and we're seeing it now. Like Bitcoin's back down to 20K, dropped significantly in the last few weeks. I just don't see that shift. Again, I'm all in on crypto, bro. Like I've got a lot of money in there, my biggest business there, and but I just don't see that narrative of Bitcoin being that hedge, that store of value. I think it will take longer. But then if things do get a lot worse, and maybe I'll get Simon's thoughts on this. Simon, you've been in the space for a long time. You helped us cover the whole FTX story. Do you think that it could be crypto's time to shine if we continue seeing that contagion, or is it still too early, especially after SBF?
No, we scammed the shit out of so many people, just worse than the banking sector. Some of the things that we did were freaking awful. And so, the only thing, I think the conversation is not a crypto conversation, it's a Bitcoin conversation. The problem with Bitcoin is an awesome mechanism for me for long-term, time preference savings. But it's a useless mechanism for spending because all your goods are priced in dollars or your local fiat currency. And so therefore, taking currency risk means that you end up in crypto because they got stable coins. And then that then brings us to, you either take smart contract algorithmic risk, or you end up in a situation, full disclosure, I'm a shareholder in Circle and Coinbase.
Yeah, I've got so Simon, I've just got a few questions for you on the stable coin concerns. Before doing that, I do want to shift the conversation very briefly because I know AllSource, who just joined us, he's got a few minutes and then he'll join us again later. So AllSource co-hosts a lot of spaces with me and Slayman, geopolitical spaces. AllSource, can you tell us on the point we were discussing earlier is that could other countries, in this case mainly obviously China and Russia, could other countries take advantage of the economic risks that the US is facing right now, especially if this contagion continues, to make a move? And if so, how will that impact the US economically? But the first question for me is more important. Historically, have we seen rivals take advantage of weakness in the US economy, or is the world economy so intertwined that these are not common? Like if the US economy falters, the rest of the world follows.
Hey Mario, yeah, I think I would agree a little bit more on the second point. I mean, especially I think Russia is a little bit different because the enormous amount of sanctions and how basically they've been cut off. But I think the problem that the Russians are running into is that they're so consumed by Ukraine that they really don't have the capabilities really to do much else, rather than just focus on the Ukrainian war. I mean, you could just look at the cost.
But I mean, will they have more courage to potentially use? I know we've talked about this a lot. We've had generals on stage, etc. Could they have the courage to start to use a tactical nuclear weapon, for example, saying, "Hey, the US is too busy to respond"? Like we already had one of the panelists, I think it was Wahid, who was on stage. Like, what fucking pisses me off, and a lot of people agreed. The comments were going crazy. What pisses me off is that our government is still spending all that money on Ukraine instead of bailing out a bank like Silicon Valley Bank. So with the sentiment changing in the US, could we see courage where Russia does use a tactical nuclear weapon, or China makes a move on Taiwan?
So the tactical weapons, no, because I think that's going to be dictated more on situations on Russia-Ukraine, right? So Russia's position vis-a-vis Ukraine. I think more people, the Russian calculus is more decided on the military situation on the ground, not necessarily where the US kind of is at. On that point, I think we put too much emphasis a lot of times on U.S. domestic policies when we look at international relations, and both our allies and our rivals and our adversaries have more interest, more aligned to themselves, not necessarily the U.S. I think the U.S. can, walk and chew gum at the same time. So let's say there's kind of economic concerns within the U.S. We still have a military capable of expeditionary military operations, capable of conducting military operations around the world. And that deterrence effect doesn't go away. Even after the 2008 financial crisis, the U.S. actually during the height of the recession did a surge in Afghanistan, right? So I wouldn't try to connect necessarily one point to another. And the tactical nuclear piece would be 100% tied to the military situation on the ground rather than the U.S. And I think that deterrence aspect is still there. Related to China and Taiwan, I mean, so China is way more intertwined with the U.S. economy than, let's say, especially Russia, right? Because Russia has been excluded, has been sanctioned. China is very intertwined, so there will be contagion effect, and we've seen that. And again, we fail to realize and fail to acknowledge as well that China has significant economic problems as well after the zero COVID policy and emphasis on state-owned enterprises and kind of the state reasserting itself in the Chinese economy, right? There's multiple great analysis and think tank reports reporting out there across the financial area that analyze the weakness of China's economy right now and how Xi Jinping is very intent on solidifying Chinese state control over the economy. And I think how that relates to to Taiwan, is that the Chinese realize that any move against Taiwan, which first would take, if we're looking at a full-scale invasion, right, and we've talked about this in previous spaces, a full-scale invasion would take months to prepare, right? So the world would have a good idea of what's going on and would understand what's going on, but that it would also incur enormous economic risk and domestic stability for the Chinese specifically. And I think that also goes to their calculus. And you hear U.S. administration officials publicly state that, Xi Jinping right now's focus and priority is economic stability, which is very difficult for the Chinese to achieve, and they also have their own risk. So I wouldn't put too much concern on the geopolitical aspect of this right now.
All right, cool, mate. I appreciate it. I do want to go quickly read one thing before going to Dr. Dinesh. I think that relates to Dr. Dinesh. I'm going to read out what a tech CEO was saying on a piece by New York Post. Tech CEO with at least $10 million in Silicon Valley Bank says the following: worst 18 hours of my life. His name is Turner. His company's name is Turner. And he's got 63 employees. We're going to raise a round of venture financing. And SVB was the go-to bank for that purpose. So we're looking to diversify, and everybody told us that SVB is a great bank. And obviously now all their money is just frozen. So I just wanted to kind of give you a sense of what, this is the contagion that we're worried about, is that there could be a bloodbath among tech companies unless there is some sort of bailout of SVB. And to kind of remind everyone, SVB is a top 15 bank in terms of size in the US. It's number 14th or 16th, based on two sources. So just trying to give you all an idea. Otherwise, I want to go to Dr. Dinesh. Do you want to share a similar story, Doctor?
Yeah. So, a lot of you may know me as a physician, but I'm also a founder. So our company, Resilient Health, where we went through Techstars and have raised a lot of money. And so wanted to give some context. Now, we were one of the lucky ones that did not have money in SVB, but as a heads up for people that don't know, like 80 to 90% of people that go through Techstars, actually SVB was a partner of Techstars. And I would say 90% of them, more, like 95% of Techstars companies, which is like Y Combinator, a very, very large group. All of them have all of their money in SVB, including, I believe, some level of money from Techstars itself. So Techstars is a multi-billion-dollar fund. And my understanding, I haven't talked to them directly, but a significant portion of their funds are with
I do want to
SVB.
announce, so Doctor, just quickly, I do want to announce now the Fed has called for an emergency meeting on Monday. Before you continue, I want to go back to you, Doctor, to share your experience. Sorry to interrupt. Don't want to seem insensitive, but an emergency meeting, does that mean anything to you, Jay?
Yeah, obviously they're trying to shore up the risks around the banking system. The key stat being there's 600 billion of AFS and HTM securities on bank balance sheets that could pose a risk if banks have to sell those securities. Now, I think that the risk might be overblown, but it can become a real risk if there are runs on banks. And Yellen has spoken now 3 times today about trying to assuage the market. And I think that it's not working. You can look at the QQQ down 1.5, Russell down 3.5, bank CDS spreads widening. So I think what needs to happen is they need to have some sort of a meeting that addresses the systemic risks and provide a plan. And that meeting might take place on Monday.
But will Yellen be able to do that as effectively as she did to save Citadel and Griffin in regards to their GameStop and AMC plays? Is she adept for this situation?
I don't have a comment on that.
I want to read one quick comment here, and we'll go back to Dr. Dinesh. Hey, I don't want to be named. However, the run from VCs is spot on. We've been notified by multiple VCs on our cap table that the panic alert was from trickle-down notices from Founders Fund, followed shortly after by Sequoia. No word on the initial intent of why this was triggered by Founders Fund and Sequoia, but the majority of funds followed suit rapidly. Very concerning that 2 tier 1 funds have the power to take down a bank the scale of SVB from, quote, leaked internal whispers.
That's not what
sure.
happened. That's not what happened. Yeah.
Go ahead,
sorry.
Doctor.
Just want to push back on that. I mean, so we received, and I can't tell you which investor, but one of our big investors reached out this week and said, hey, it's time to have a conversation around your financing and your banking partner. SVB there had already been conversations, and obviously there was a lot of murmurs, and a lot of people, I think yesterday I must have gotten 8 or 9 calls from our investors just saying, hey, you don't have exposure to SVB, do you? When you're a startup, this is like your entire livelihood. I think it's completely unreasonable to say, hey, it was VC funds that took them down. Clearly, SVB had poor practices. They bought mortgage-backed securities at 1.56% for a 10-year duration. I mean, trying to blame this on the VC ecosystem, I think. And then I there's no love lost, but I think like it's their fiduciary duty to ensure that this does not happen to them.
Yeah, I would agree with you. I think we see this in every case. Whoever rings the alarm first is suddenly being blamed for the outcome, and we saw this a lot. Simon, me and you saw this a lot during FTX days. But before going back into crypto, Doctor, I did interrupt you, so I want you to continue your story, and then I want to go back to Simon with a few questions.
Yeah, what I was gonna say is the VC, having known now, having gone through Techstars and being very close to some of the Techstars founders, personally know of 6 different startups that literally have no access to their capital. One of which is a post-Series A startup, and it's absolutely heartbreaking. And I think that what people don't realize is in this current environment, to have gone and raised a Series A in 2022 was a very difficult, as many people may know, very difficult proposition. And getting it done was so difficult. And then to go through that and then to lose everything, I wouldn't wish that on my worst enemy.
Could we see VCs step in and offer that liquidity for the startups, or is there too much? Why not?
Because one of the biggest challenges for the VCs right now is this is damage control mode. So if again, I'm not a VC, but if I was a VC, I would say, look, right now I need to focus. What's going to happen now is this is going to be similar to 2008, maybe even 2001. I hope not 2001 for my own company, but in general, there's going to be a pullback. There's going to be a significant lack of liquidity in the venture market, and so they're going to go to their portco companies that are most likely to survive, and then reinvest in those instead of the ones that are really struggling. It's an awful thing, but it's just So for example, with Resilient, if our plan was to go raise in 2023, which luckily it was not, we would ask them for an extension because we actually still have money in the bank, right? And so the idea would be they're going to go in and bridge their existing portfolio companies that are executing really, really well and beating all metrics to get through this dark period instead of going after and trying to save companies that currently have zero cash on balance.
Why is there's a question here from the audience, and I'm just looking at the Charles Schwab stock price, the ticker now. I want to go to Jay again. Why is Charles Schwab getting hammered by this? That's a question from the audience.
Yeah, sure. So Charles Schwab essentially borrowed several $billion from the FHLB line last quarter. They also were paying 0% on the cash you had in your brokerage accounts. So those are 2 red flags. Obviously there's something called deposit beta for banks, where when the risk-free rate goes to 5% like it has now in the last 3 Fed rate hiking cycles, about 37% of the rate hike was passed on to consumers and depositors. And in the last rate hiking cycle, which is about 9 hikes in 2018, 2019, that was about 22% was passed on to consumers. So what's happening is that Schwab was paying nothing on deposits on what people had in their brokerage accounts, and all of a sudden, right, like Interactive Brokers is paying 4%, You can go to PNC, they'll pay you 4% high yield savings. There's more pressure on them to pay, and that's going to reduce NIM, net interest margin, one of the sources of income. The other thing is that they have a large held to maturity, billions of held to maturity securities, just like, you know, the 600 plus billion number I shared before, right? In the event that they're forced to sell those securities, they would have to take a large loss. Now, you look at the market cap, right, of this company, it is a lot safer. It's a lot, you know, it's not as much of a systemic risk, and I don't think those losses would be big enough for Schwab to go under. But I think what people are worried about is it has some similarities when it comes to HTM, held to maturity securities on the balance sheet that they could take losses on. It has a lower profitability due to they have to pay more on cash at the firm. And actually, I have two stats for you. When they borrowed, I think $11 billion last from the FHLB, they were paying 4.71%. Imagine how high that is, going from 0 to 4.71%. And on the CDs that they raised, they're paying 5.15%. So imagine you're a bank that has a zero cost of capital, or a financial institution with a zero cost of capital, and all of a sudden, on a large percentage of your capital structure, you have to pay 5%. And on top of that, you own securities, and those securities, you know, are marked down, and you could potentially realize those losses in the future. So that doesn't mean that it's going away. It just means that it has 2 or 3 major risks that people are getting. And then there's a block trade yesterday of about 8.5 million shares. If you look at the average daily trading volume of Schwab, I believe it's about 3 to 5 million shares. You know, it was less. You know, let's say it's mid to high single digit millions shares per day. The block trade pre-market was greater than the average daily trading volume, and it was 4% lower than the prior day's close, and that scared a lot of players in the market. So those are 3 reasons why the stock is trading like it is.
Thanks, Jay. I do want to go. I see Tom is up on the stage as well. Simon, I want to ask you a few questions here. Just going back to crypto, when do you think, and just keeping it simple, because obviously it's not a crypto space, you know, obviously we know that Silicon Valley Bank is being used by various crypto companies. It's one of the 3 largest banks for bridging crypto and fiat. We saw Silvergate fall. Silvergate is 1% the size of Silicon Valley Bank. How do you think the market will react to this? Obviously, we saw crypto collapse in the last few days. And then could we see Bitcoin come in as a store of value? Is this Bitcoin's time to shine? We've said this multiple times over the last few years, and it never materialized. Bitcoin is still seen as a risk asset. And trying to keep it simple, of course, for the audience, please.
Yeah, sure. So I'm not sure we're going to see that. I think we're still in the type of market where people see their Bitcoin savings value in dollars go down because people still think in dollars. Then they see the value of their Bitcoin savings go down, and therefore that leads to panic. But the interesting thing and the challenge with Bitcoin as well is that it is actually a solution to all the problems we're experiencing, as in you can own your own money without counterparty risk. You can spend it person to person. And the long-term supply is designed to be a fixed supply and therefore go up in value if you have a longer time preference, which makes it a great vehicle for saving long-term with a good degree of speculation. But as you said, it's useless for spending. So you have to have dry powder. You have to have your spending habits understood, and the only way to manage spending is to have the same currency that the majority of your expenses are in. So that's yeah.
I'll link to another question as well, Simon. No, but just for anyone that doesn't know, Simon was obviously one of the largest investors in the crypto space in general, but he was with us during the FTX collapse. Celsius collapses. He was leading leading the narrative there as well with his shows. And then you were one of the early guys to kind of ring the alarm on DCG very early, before anyone else even dared bring up their name, to avoid spreading fear. So now that we saw and you were there during the Silvergate interrogation as well a few months ago. So now that you're seeing what happened with Silicon Valley Bank, did that catch you by surprise? Are you more concerned, or are you pretty chill with everything after all the collapses we've seen? It's like none of the guys. Remember, we had a chat once. It's like, who's left standing? You said it. You said there's only 3 big guys left standing: Binance, DCG, and I can't remember who the third one was. Who was the third one? Binance,
well, the
DCG.
3 concerns were Binance, DCG, and Bitfinex and Tether.
But yeah, and Tether, the 3 big players left standing, and now we're seeing obviously a lot of fear around Tether, a lot of fear around Binance, and obviously DCG. We know what happened there. And now we're seeing Silvergate and Silicon Valley Bank. What's your stance on this, and what's your fee level?
Yeah, it's concerning, but I position myself for these things, so I never have more fiat currency than FDIC. You know, I value my wealth in Bitcoin, so because I dollar cost average, I make sure I earn enough fiat to stay below the FDIC amount. And I buy Bitcoin, so the lower the price, the more I consider myself savings wealthy. And then if I ever want to, the reason I got blown up in Celsius is because I manage my finances in a way where I borrow stable coins against my Bitcoin rather than sell them, because there's various tax benefits, and it allows you to manage your fiat spending without actually having to decrease your savings. A bit technical, sorry about that.
No, good.
Yeah, but so I kind of manage my affairs in that way, but at the same time I've been investing in companies in this sector since 2011, so they are all deeply, you know, they are all affected, and so I'm doing a lot of comms at the moment because I'm shareholders in many of these companies. So one of those is I was a private investor in Coinbase and Circle, and they created USDC stablecoin, and they have exposure to Silicon Valley Bank. I don't know what have you covered?
But it's limited. Yeah, it's limited. It's limited. They have 7% exposure outside of BNY Mellon, and out of that 7%, it's spread across multiple banks, including Silicon Valley Bank. So we talked about this earlier. Since limited exposure, I do. If you don't mind, I just want to go to Name Redacted briefly. He just sent me a message, and for anyone that doesn't know Name Redacted, he's been leading a lot of the whistleblowing around social media platforms over the last few months. We've done a few spaces together, and he sent me the following message. I just did actually Name Redacted. I'll let you give us just a bit of an overview of what you just sent me and your concerns that you have about the quote unquote what you said major depression in the tech industry.
Well, maybe, but I just did. Anyone in finance knows public companies have to file, 8Ks or 10Ks like earnings reports, or an 8K would just be a sort of an event, So I just did a keyword search in Edgar. It's an Edgar SEC filing database for Silicon Valley Bank mentioned in any filings. Just in the past year, I got 3,900 hits. And I would just say that's probably 500, at least 500 companies. But every single one of these, for instance, the first one, CareCloud, I don't know, these are all publicly traded companies. And most of these filings, they're announcing credit lines with Silicon Valley Bank. So this one, $25 million, ALX Oncology, $50 million, and it goes on and on. All of these filings are like this. So the problem here in the contagion with tech, and I forgot who was mentioning it, but all these credit lines are going to be cut off effectively. In my opinion, someone can correct me, but these companies these are credit lines to operate their operations pretty much. If they don't have access to this, employees will not get paid, layoffs immediately because they won't be able to fund their operation. We're talking, billions of dollars, right? Hundreds of companies around Silicon Valley, and just on and on and on. Flux Power, I haven't heard of most of these, but they're all small companies with like 20 to anywhere from like 25 million to 100 million in credit lines. And if they're put into receivership, those credit lines are going to be shut down. All these companies will obviously try to make a run and pull out the entire credit line, but I assume that they're not going to have access to any of this money anymore for operating capital, and that's like a major hit to the tech industry.
Tom and Danish, what do you guys expect from what Name Redacted just mentioned?
So he mentioned credit lines, which obviously are pretty big, but pretty important. But think about venture debt, which, by the way, SVB was the leading provider of venture debt. For people that don't know what venture
Biggest
debt
in the country.
biggest in the country. And so with venture debt,
Who said, sorry, who said they're the biggest in the country? Who just said that?
Me.
Okay, Jay. All right, go ahead, Danish.
So they are, yeah, so they're the biggest in the country for sure. Yeah, actually. And so the reason why that's super critical is because when you look at financing options for, you know, growth stage or late stage companies, you really don't want dilution to drive decision making. And so a lot of times people will get venture financing through venture debt versus venture equity or equity financing. And so with venture debt, you are treating it like you received an investment from an investor. And so if you are relying on venture debt to be able to manage your burn or to accelerate growth, you are going to miss. And by the way, for people that don't know, with SVB, they wanted you to leave the venture debt in their account. So now you don't have access to your own venture debt that you have borrowed. And so now suddenly it's as if an investor just took the money back off the table. And that is, I mean, right now there are growth stage companies in every, I personally know a ton of growth stage companies that I'm not going to name, because if they want to talk about it, they can talk about it publicly, that have gone through like YC or Techstars, and we're part of the same communities, and they actually don't have access to their own money right now from the venture debt. And that's going to have crazy ripple effects, because now start thinking about one of your customers. If you're a startup that sells to other startups, one of your customers not being able to pay their bills, now that affects you as a company. And now you're not going to pay your bills to another company, because startups work with each other. The ripple effects, the second, third order effects of this, guys, it's going to be, this is actually quite scary for the entire ecosystem right now.
There is no doubt. There is no doubt that you're going to have thousands of companies affected that can't make payroll. There's a company called Ripple, which does payroll software, and they weren't able to pull their money out and transfer to JP Morgan last night. And they already had put out payroll for Friday. None of that payroll went through. Very sad story, but I'm assuming a lot of other firms are going through it.
Tom?
Yeah, the doctor is spot on. One thing that I'll add is that with venture debt, it's not even really debt a lot of times because of the covenants. They can't even really pull that money out if their balance goes below a certain amount. So who knows how many of these startups won't even be able to access the money that they might have in other accounts. Will be able to access venture debt from other institutions because of their inability to pull from their main SVB account.
Yeah, so here's an example. Small company, Avid Technology. I think they have like a $1.5–2 billion market cap, but they have a revolving credit facility from, you know, basically up to $120 million during the financial crisis, and that's with Silicon Valley Bank, I believe. I don't know, it was like 25–30 million of that. But what we saw in the financial crisis was all these banks, like if you were a homeowner, you probably experienced this. If you had a home equity line of credit, the bank just shut it down. Like if you hadn't taken money, they just close it. And they can do that because they don't have the capital to just, you know, people just drawing on those credit lines. And that's what's going to happen here with the Silicon Valley Bank.
I'm just going to read this out, just kind of confirming what Dr. was talking about, Dr. Danish. Expect mass layoffs later today, Monday at the latest. And given the weak fundraising environment, a number of startups have been reliant on venture lenders, and in this case, SVB is the largest, not aggressively pursuing amortization of debt and triggering default for covenant footfalls. Example, cash balances. How will the FDIC handle this? Mass defaults?
So you're going to see a lot of layoffs next week because board of directors have liability. And when you have an employee and you can't pay that employee, there's severe liability associated with having that employee work without pay. And boards don't want to take that risk. Because these boards don't want to take that risk, what they're going to do is they're just going to fire anybody they can't pay. I know it sounds ridiculous, but in a lot of cases, a lot of people are just going to get laid off for no reason.
Yeah, and if someone in the audience works at a startup, because I'm getting DMs right now from folks, you should ask leadership today what's going on. And anyone who's not crystal clear with you, take that as a sign. Even if they do bounce back from this, take that as a sign of how management is treating you.
You know, Aaron, good to have you back.
Thanks.
Aaron, you
Great to
there?
be here, Mario. Yeah, I'm
What's
here.
your
Can
thoughts
you
on
hear me?
this? We didn't expect to meet again on stage discussing this topic. I see Stock Talk is back with
I
us as
know.
well.
Here we are.
Well, yeah, there we
I
are.
mean,
What's
this is
your thoughts?
it's obviously very encouraging. All of this makes me wonder, what, if anything, did we learn from 2008, 2009? And I'm concerned that, the effects of this, the effects of the highly leveraged phantom funny money global economic system that we've built, once again, when the system falters or collapses, as it seems to be set up to do, the working class and the poor are disproportionately harmed, and the banks and other firms that are too big to fail seem to be bailed out, and most of them, maybe there's one or two sort of sacrificial lambs that end up going belly up. So I understand the need to try to rescue a system in crisis, but we did that, 12, 13 years ago, and didn't seem to correct some of the underlying dynamics that led to these problems. And I understand that the system is more complex now and it's different and it's not all the same factors, but I think the deep currents underlying the crisis of 2008 seem analogous to the currents underlying the current crisis. And I'll just say, Mario, the other person, it would be interesting to pull Ed Dowd up here. He's a Wall Street analyst. He was on Tucker recently talking, interestingly enough, about COVID. And his hypothesis, which seems interesting to me at least, is that not COVID itself, of course. He's not claiming that people with financial or economic interests created the pandemic, but that our pandemic response and many of the policies that we adopted during the pandemic were a sort of alignment of interests and a convenient way to stave off what many were seeing as a global economic crisis in 2019. That through policies like lockdowns, that we saw massive transfer of wealth upward. We saw certain opportunities to basically move a lot of capital being maybe taken advantage of in ways that were meant to either stave off the crisis, or, I mean, we did see obviously economic impacts of the pandemic, but to have maybe some of those impacts on the system with with something else to blame. So I'm not saying I endorse Ed's interpretation of the alignment of economic interests with certain COVID policies, but it's certainly an interesting hypothesis. And he has presented what felt to me to be pretty credible evidence that there were a lot of people that saw this coming in 2019, and maybe now those bills are finally coming due.
I want to just quickly ask another question to Jay. Jay, if you don't mind, I'm just while Aaron was sharing his thoughts on this, I was going through SVB's chart and looking at their stock price, and their stock price kind of bounced back a bit, and it's just sitting at the same levels as it was in 2019. So it's not like just it dropped significantly. It dropped 63% today alone, but it hasn't completely collapsed. So my question to you is,
it's halted. It's halted because of the FDIC.
Oh yeah, shit! It was halted. Okay, I was sitting there trying to figuring it
It's
out.
been
Is that
halted
just
all
people?
day.
Okay,
Yeah.
okay, that makes more sense. Okay, that makes more sense.
And then to the gentleman earlier,
yeah, go ahead.
I do think that there have been like 3 major reforms that have actually made the environment a lot safer. I know that this is very sad, and when it comes, you can empathize with what's going on, and it is a systemic, it is an important institution, but you compare what's going on now to what was going on then, there was just zero liquidity. I don't know if you guys were around. There's zero liquidity. There was zero bid. Like first lien loans that recover first in bankruptcy were trading at like 20, 30 cents on the dollar for decent companies. It was a completely different scenario, and there are 3 reasons why that those types of things are not happening in the same way today. One is Basel III, which set minimum capital requirements for very large banks. For the large banks, 10 times higher than before the crisis. Then you had the Volcker rule, which prevents a lot of these banks from taking equity risk and trading for themselves. And then on the third, you had the Dodd-Frank Wall Street Reform and Consumer Protection Act, which did a lot of different things, including regulating S&P and Moody's and providing consumer protection. So I think that, believe it or not, we are in a much better situation when you look at the Tier 1 capital ratio of banks today. And like the banks that have fallen have fallen because of crypto and some fraud and poor accounting and some runs. And the bank that fell today had nothing to do with the underlying assets or the people at the bank. It was a management decision not to hedge 91 billion of MBS on their balance sheet. They could have paid $100 million for a small hedge, right? There would have been a nominal cost compared to what they actually lost, and could have hedged the entire balance sheet. So I wouldn't blame this on the system. I think that these are idiosyncratic situations where you can blame the CEOs of both banks.
I guess I have a question for any of the panelists, including the gentleman who just spoke.
Jay.
Jay. Thank you. I wasn't aware of some of those regulatory reforms, and I'm very much a layman in this space, so you'll forgive my ignorance. But it seemed to me that 2008, one of the key issues was that the people who were taking the risks were able to really not assume responsibility for those risks. When we look at the home mortgage issue, for example, that you had these things, sort of high risk loans packaged up and then securitized and then backed by Fannie or Freddie or whatever, so that people could push these loans out because they weren't going to be responsible when people defaulted on them. And there was this kind of shift of responsibility away from the people making decisions for approving those loans. And so I guess my question for the panel is, what has been done with the banks to maybe push back against that tendency for decision makers not to hold the bag at the end of the day, or to be able to take risks that, if they were ultimately responsible for the outcome of those risks, they may act differently? Because it just seems at the level of these individual decisions that then have large collective consequences, when the decision maker can take risks with potential payoffs, but is cushioned from the downside of those risks, you're sort of setting up a house of cards, and you're setting up a system in which people are going to be incentivized to behave badly, and eventually that system is going to falter.
So that's a great point that you brought up. The Volcker rule exactly addressed that issue and basically disallowed these banks from trading for themselves. And when it comes to mortgage regulation, there had been a lot of more. When you think about down payments and no-doc lending, all that stuff is no longer an issue. We have different issues today, but those issues are definitely not the main issues that plague the banking system. And I do agree with you, very briefly, that none of these CEOs of the banks, Angelo Mozillo, I saw him, at court, but the CEO of Credit Suisse, he was fined 5.3 billion, didn't go to jail. Goldman Sachs, at that time, 887 billion, filed 5.1 billion, no one went to jail. Deutsche Bank was 1.67 trillion in 2008, was fined 7.2 billion, I remember. And Citigroup was 2 trillion, was fined 7 billion. Bank of America was 2.2 trillion, was fined 16 billion. So even JP Morgan, and part of it was because of Bear, they were roughly 2.5 trillion. They were fined 13 billion, but no one went to jail and no one was held accountable. So yeah, I agree with all of that. But I think the Volcker rule and I think the regulations around mortgage lending are completely different than they were back then. And obviously you still have, look at 1MDB, you still have bad people at any company, right? You have bad people that break the rules, and we need a system that better takes care of those situations. But I don't think you can just say that nothing has been fixed and the system has the same risk than it had in 2008. I frankly think that has much less risk than it had back then. And this run was actually based on what we learned. It was to contain the situation.
Isn't this about what?
I do. Jacob, basically, I'll let you ask your question and continue commenting, but I do want you to give it quickly, just again for the audience. I know it's been a while. Just give us again an overview. I want you in Stock Talk, if you don't mind, for anyone that just joined, just an overview of what we know so far and what we can expect over the next few days and weeks, such as the layoffs and the contagion. So, Kobeissi, do you want to kick it off because you've been with us since the start of the space?
Yeah, I mean, we've covered so much. I guess, I think the main point that we started talking about was how does this impact the Fed and how does this collapse kind of spread beyond just SVB? And we kind of, this kind of also feeds into the point that Aaron was asking. I think, this right now it's too early to determine if it's, a 2008 level thing. And I think we spent a while discussing that.
It's also very different to 2008. It's very important to make that distinction.
Right.
We're talking about, like, someone mentioned, I mentioned it was one of the first courses I mentioned. We're going through 2008 for crypto and tech. That's one way I would look at it.
Yeah, and I think these next few days are actually really important. But we're definitely going to see more stuff develop over the weekend. We'll probably have Secretary Yellen and Powell maybe even start to say some stuff to reassure the financial sector. But as far as who's going to be held accountable for any of this stuff, I mean, I think the industry as a whole kind of revolves or runs on just fees, right? Or fines, sorry. So no one's really ever thrown in jail for stuff like this. I know
they target the richest people and the biggest institutions, and then they charge them fees. That's how the
that's
SEC
exactly
works.
how it works. I mean, I worked on Wall Street. Anyone that has worked on Wall Street knows it's how it works. And the other thing is, I think we really are kind of paving the path right now for retail once again to pay the price for this, in a way, systemic failure that was spurred by the Fed. I mean, rates are the number one thing that are impacting what's happening right now. That's the whole reason they had to do, we talked about earlier, the fire sale, which resulted in almost a $2 billion loss on their bonds, and then they couldn't do a capital raise, and now they're trying to sell the company, which I think is the most bullish case out of all this, is just some other bank swallows this SVB alive or half dead now and kind of try to contain that risk. But I think at the end of the day, what this comes down to is the Fed now has to pick. Are they going to continue their fight against inflation, or do they say we finally broke the system and now we pivot and then let inflation kind of run its course? And I think what they're going to side with is, and this is definitely, we were talking about the Fed FUD futures earlier, and just interest rate expectations. I mean, this morning or last night, we saw an 80% chance of a 50 basis point rate hike this month. Now it's down to around 40 or 50, and it will probably continue to fall over the weekend into next week. And I think what that means is the market sees the Fed is going to start taking their foot off the pedal. They're going to start, to show more signs of a pivot. And at the end of the day, there might be some fines that come out of this, but I think retail and just your everyday person is going to end up paying for this in one way or another over the next however many months or years it takes to play out.
Sorry, I just couldn't unmute. Grant, welcome to the stage. I'll just give quickly the mic to Stock Talk just to continue the overview for the audience and what we could expect to see. And I would love to have Grant give us his thoughts and ask him a few questions. Stock Talk.
I mean, yeah, just to put it simply, in layman's terms for people, the interest rate environment has created a situation for banks and for private companies that doesn't happen in a quote unquote normalized economy. And, it's very difficult to see these things coming, right? Like, I mean, we even mock Jim Cramer all the time, and people like to talk about inverse Cramer, but I mean, Cramer quite literally was talking about the stock a month ago as a comeback stock, right? So it's very hard to see these things coming. It's hard to forecast, an institution like this being put in a situation like this. But the question always goes to contagion, and I know that you focus on that, or you've tried to focus on that in this space. We talked about that yesterday as well. I guess the silver lining of this situation is that this is a niche bank in terms of its focus, right? We talked about the fact that it is a top 15 bank or top number 16, whatever ranking that you mentioned earlier, but it's still not the size of your JP Morgans or your banks that are 10, 11, 12 times bigger. Now the
But the Domino's start small though, no?
Right,
I know
right,
it's
yeah,
again,
and
I know it's
that's the point.
unrelated though, but still.
Yeah, and that's the point we made yesterday, right? Like, and I mean, this is relevant even like to the FTX debacle that happened, where there was fallout, but that fallout was relatively concentrated in your companies like your BlockFis and your Geminis and those companies that were interrelated. And I think that in the immediate term, in the next 3 months, that's the type of contagion you will see. You'll see contagion in the VC tech-driven industries, right? I mean, you started seeing it today, right? I mean, half of the headlines in the second half of the day were on exactly what we were discussing on Spaces yesterday, which is these companies that are overexposed to Silvergate that either, sorry, not Silvergate, to I'm thinking of the other one, to Silicon Valley Bank, that we're using these credit facilities to basically continue operations, right? You're talking about some of these small growth and tech companies that have very, very high cash burns that are using these credit facilities to basically survive, to operate. And those companies are, in trouble. And the market spoke to that today. And then there's probably some other super regional banks that are in trouble that might,
We had Stock Talk. We had an employee at Bank of America.
Right. Yeah, he mentioned that as well.
Saying, yeah, this is where the concerns are. He mentioned the first that they don't have internal concerns at Bank of America, which is not surprising. And of course, you'll have an employee say that. We did have an employee from what was the other bank?
Wells Fargo.
Wells Fargo that had concerns, and they was kind of shitting on Wells Fargo while he was in the office there.
I mean, it's easy to shit on Wells Fargo, right?
Yeah. But the question I have for you, man, is in terms of startups that will just not have enough money to pay payroll, on Monday. The question I asked Dr. Danish is that why wouldn't VC step in? And he doesn't think VCs will step in. Do you share that sentiment? Like VCs are still sitting on a lot of money.
No, yeah, they are. I mean, the way that they've handled this is hilariously stupid. If you're any of these guys like Founders Fund, if you're Thiel, if you're Y Combinator, clamoring for bank panic here is the dumbest thing you can do. And
it was so bad. They have 500 billion of dry powder, right? Like they could have just taken 3 billion of that collectively, for 5 billion, then a high. Exactly. They could have saved now all their companies are going to get marked down.
Yeah, exactly. So what am I missing here?
So yesterday,
a lot of them,
upon hearing this news, right, and upon seeing the closing of their mobile app yesterday for business clients and all these things, Peter Thiel had a choice. He could have quite literally saved the bank. This isn't a $150 billion market cap, right? It's I think prior to this collapse, the market cap was at 13, 14, 15 billion. I don't even know the exact cap, but that's not important. The point was Y Combinator, Founders Fund, these massive VC firms with tens of billions of dollars of deployable cash could have saved this bank and prevented what is going to be a massive unraveling in venture-focused tech venture-focused funding, right? Because are these guys going to take their money out and go put it under a mattress, the ones that could get it out? No, right? They're going to go to some other banks. And so there may be market share beneficiaries on a regional basis. There may be some small VC tech-focused banks that may be market share beneficiaries. There may be companies that were dependent on these credit lines that will not be beneficiaries. They'll be the opposite. They'll be, sympathy shorts, if you will. And so there is different types of fallout that are going to happen from this. Not all bad. The question becomes, does this produce a bigger, broader, banking, anti-banking sentiment? And the point that Jay made earlier, which I agree with, is that before that happens, long before that happens, the Fed or someone else will step in, because that is prohibitive, right? An actual panic in banks like Bank of America, JP Morgan, that's just prohibitive. So in my view, could that happen? Yeah, sure. I'll never say never to anything to a massive panic like that. But I think you need a massive catalyst, something bigger than most people are thinking of to spur that. But other than that, I think this is likely a contagion that it may be a big contagion, but it'll be focused in tech and VC and startup capital and a lot of these small companies that are depending on this bank. But that's the immediate effect, I think. In the next
I agree that it's not necessarily a contagion to the banking system as a whole, and that it's within VC. I just don't think that people are quite gathering the scale of just how many of these, Series A to E companies were majorly exposed to this bank. Also, I've seen an argument which I kind of presented before, that for one fund specifically, we're not talking about hundreds of billions of dollars, but had $2.5 billion fund with multiple companies that were unable to get money out of Silicon Valley today. They themselves were unable to give these companies money for payroll because they are also banking at Silicon Valley Bank. I've seen, the question is how much of that capital that we're talking about that's on the sideline is also in some way exposed to this bank one way or another. It is really curious. The blame game is going to be very interesting to see, the Fed decision, the decision making at SVB, of course, and the VCs themselves that caused this bank run. I've seen, I'm in a lot of these sort of VC chats, people saying that big tech did this on purpose because it washes out all of the startups, basically vaporizes all the startups in competition. I'm not necessarily buying that. But I think that it's too early right now to conjecture why they wouldn't have stepped in and saved this bank when they maybe exposed themselves.
Well, and then there's a whole situation where, who's going to take responsibility, right? One person Founders Fund might say, okay, we're keeping our capital here, but then, Jerry Tan from Y Combinator, Tribe Capital, Activant, Canaan, and all these other firms might say, all right, let's let him take the bag. And let's still pull out all our money, right? And even if he were to put up, $3, $4, $5, $6, $7 billion, that's not enough to cover the $15 billion of held to maturity losses.
And that's why
the future.
The crypto industry tried this too. Remember, the crypto industry tried this crypto saving fund, right? It didn't work there either because the big players rarely get on the same page.
Right. And
that was FTX that was doing that, to be fair.
Grant, Grant, you were asking a question, Grant, as well?
Well, I was just nobody knows how much the unrealized losses are of this particular bank loading up into low risk treasuries right now that they're so far underwater on. They were lending money out at nothing. Or paying nothing on the money and buying, 3/4 of a point treasury bill. So if you notice the 2-year and the 10-year today, just like had massive moves. I think 40 bips on the 10-year and the 2-year. It's suggesting that future issues. I also know that in 2010, I was at a regional bank with San Diego called San Diego National Bank. They went underwater. I owed them $50 million in real estate loans that were all performing loans, perfectly good shape. The guy that owned the bank tried to fund $200 million, and the government refused it. It wasn't as big as this situation, but the government refused it, and instead gives a group out of Minneapolis almost $1 billion. The government gives him $1 billion and secures all the future possible potential losses over the next 3 years from the portfolio. So what I've seen in these cycles, 1995, when there was 600 credit loans collapsed, is the big banks end up being the beneficiaries, the consumers of these smaller entities. And I imagine some of the names you guys threw around earlier that could have easily just walked in and said, hey, I'll write a check. Maybe they'll get paid to actually do the same thing later.
Name redacted and jump in, guys. I'm just bringing Justin up as well to play some clips for the audience.
I just wanted to say, I've been listening for the last hour, and I really have to say it's what does all of this teach us, right? Whether it's 2008, whether it's the crypto blow-ups, the banking blow-ups, I really just believe that what all of these things are showing us is that people need to be responsible for themselves, and we need to start living life as human individuals, as being responsible for ourselves, being responsible for our own wealth, our access to capital, and different ways that kind of, I think civilization has changed over the last 2 decades, has really like started to push forward those themes, right? Whether it's people living off their MetaMask, or whether it's Silicon Valley Bank and startups, being that's where most of the startup, liquidity is. Obviously the VCs have large sets of money set aside that, feed through SVB to some degree to all these startups that they're funding. But I think that the greater themes are really that we have to like take a step back, and hopefully I can't even imagine what shoe could fall next. But what this really shows me is that the life that
commercial loans,
like commercial loans, or just accessing value in your daily life and being very attuned with how your wealth and money and how those two things are sometimes the same and different affect how you expend those resources in your everyday life and in your business life and for the endeavors that you want to accomplish, right? And you can't necessarily rely on these, whether it's Silvergate or FTX or Celsius, whatever it is. Like it's really crazy. I feel like there's a confluence of themes, like civilizational, societal themes here that have all come together to really teach us that, like, however we all have to move forward, we just have to be more conscious with who we give our trust to, right? We can't rely on the ways of old, the way that, like, oh, sure, my check always goes to my bank and, it clears because I have direct deposit, like, what if my bank isn't good anymore? Like, what if my debit card doesn't work? So just to be a little bit more conscious about where your wealth is. And I think that, me, because of how I've had to live the last few years and what I've been through with, being in Silicon Valley, then crypto, then Celsius, then, DeFi, then, now just me, I've like kind of lived this life where wealth and value comes in many different ways that aren't necessarily, money at all times, or items at all times, or collectibles. The collectibles have value, like this and that, how you borrow or lend against things in that world. It's like very profound if you think about it. Like it's really just a mental check on yourself of, how am I relying on others in terms of in terms of how I need to live my everyday life, right? Like, do I have access to my own capital? What are the rails that allow me to access my own capital and my own wealth? And how can that affect my everyday living? And I think that is like the major takeaway. And I'm not saying I know, I'm definitely not saying I know, like how this all ends up, right? But I think we've had these triggers on and over again. And Mario, I listened to a lot of the Celsius stuff you did in the FTX back in the day, and I really had a lot of respect for that. I was obviously going through a lot of stuff, on the legal side on my own last summer, but it's just been like a really incredible journey. And I think that we all need to grow from these types of things, right? It's like we need to evolve. It's how do we do better? How do our behaviors, how do we have to think about how our behavior impacts how we live our lives and who we rely on, and how these systems need to work for us. We don't work for these systems, and I think that's the kind of underlying theme of where we're changing in this TradFi to DeFi to people living for themselves once again, as we were thousands of years ago. I don't know. Maybe I'm crazy.
Justin, I know you've got a few clips to play for us. I've sent you a co-host invite as well. You just got to accept it. But the mic is yours, man. Let's play some clips.
All right, great. Yeah, let me play one. This is from Mark Susser. I actually know Mark well. He was involved an investor in one of the tech startups that I did a decade ago almost now. But he is talking with TechCheck.
Justin, just before you play it, can you accept the co-host invite?
Sure.
Just to I want to bring up one more speaker, so I need the spot on the
I'm
panel.
on there. There we go.
Oh, all good.
Okay, cool.
Just so I can bring up mad scientists.
All right, let me play a short piece. This is 6 minutes long, but I'm just going to play the first part just so you get this is Deidre Bosa from TechCheck talking to Mark Susser, investor.
With Upfront Ventures, Mark Susser, who joins us. Mark, thanks so much for taking the time to be with us today. Yesterday, you were one of the first and certainly one of the most prominent to tell the VC community to not panic. What were you telling your portfolio companies? Did you advise them to stay calm and keep their money in SVB?
Well, let me start with the fact that I don't believe anything was fundamentally wrong with SVB. What happened during the global financial crisis is banks were lending money to people who shouldn't have had money, but that isn't what was happening here. I believe SVB was largely solvent, hadn't violated any of the banking ratios that were just talked about. What happened was a classic panic. Everybody said race for the door. And then all of a sudden you're in a movie theater, people stampeding for the door, everyone trying to get out first. So what I think the Feds did today was an important move. By the regulator stepping in, they stemmed the outflow of cash. And I believe, I don't have any inside knowledge, but I believe you'll see this bank purchased by the end of Sunday night.
Well, that's an interesting take, especially with some of the comments we've heard here that they believe it was mismanagement that may have caused the downfall of SVB. I think it
was 100% mismanagement.
Yeah, I mean, Mark is a
question
smart guy, but I think there is some stuff to be said about what's going to come out from this. I can't imagine that things were that tidied up. Yeah, on the surface, those KPIs might have been pretty solvent, or at least within the black lines that hadn't gone out red. But my goodness, I think that overnight turn is really, really tough to say anything but a real mismanagement. And I don't think people really pull the plug on these things. There was another video. There's no real audio to it, but it's basically
But before you play, oh sorry, I thought you were gonna play another video. Go ahead.
A comment was someone did a drive-by SVB on their local.
I saw that. Yeah,
this is the line out the door. People stomping down to find out what's going on. So,
but just saying,
they should be furious. They should be furious. All of this could have been avoided.
Yeah, but saying it's mismanagement, fair statement, but it makes it seem like it's just like a one-off case that is unlikely to spread. Yeah, true. But then if
I gave you $500 million,
but what?
And I told you
what about the?
Okay, well, listen for 1 second.
Yeah, go ahead.
If I give you $500 million and interest rates were zero, and I told you to invest in something low risk, AAA, like an MBS security, and the spread and the total yield was like 1.7, 1.8%. It was, 5 to 10 year duration. And I said, I'm going to give you $500 million. You're going to earn 1.87% on that. You have a zero cost capital on the other side. And in order to hedge this risk, for every 1% move in the underlying asset, you're going to lose, with a 5-year duration, you're potentially going to lose, $10 million on, you're going to lose $10 million on the portfolio for every 1% move. And I said, you could hedge this out for roughly $1 million. You could buy a payer swaption and work with JP Morgan and hedge out this risk completely. What would you take advantage of that interest rate hedge, or would you just buy go full port at the top of the bond market, take $500 million and just buy all the bonds and hold them?
Well, but look, let me ask you. Let me push back and ask you a question on this thing. I'm here in California. I've seen the Department of Finance budget projections. We've been in this very, very.
And sorry, I meant 50 million, not 10 million, but because it's 500 million, not 100.
But my question is, they put out these monthly, Department of Budget, the budget reports, the multi-year projections, and we've been just swimming in black and awesome, surpluses for as far as the eye can see, and then all of a sudden all those corporate taxes just started falling down. So this might be an anomaly as far as an actual failure, but the trend is absolutely, especially here, Silicon Valley, investment rich California, we have relied on that Silicon Valley largesse of corporate taxes coming in. That is shallowing dramatically. That is the trend, isn't it?
Justin, I think that's a separate. I think it's a separate issue because this one guy, and by the way, the loss is probably closer to 20 to 30 billion now. This CEO and his CFO lost $15 billion in a few months. They built this $90 billion MBS portfolio in a period of months, and in that period of time, they weren't buying crypto, they weren't buying stocks, they weren't buying unprofitable tech, they weren't buying JPEGs. They were literally buying mortgage-backed securities, one of the lowest risk government-backed by Fannie Mae, Freddie Mac, and Ginnie Mae securities on the planet. And they ended up losing what could be $20 to $30 billion on $91 billion of securities simply because they didn't call JP Morgan and get a rate hedge. That is the most ridiculous thing I've ever heard in my
Yeah,
life.
but this isn't just this seems to be like the canary in the coal mine. This thing is dying. It seems like there's going to be a lot of canaries coming after it. Am I wrong?
I think that this bank would have survived for potentially 2 to 3 years without a need to actually raise capital if it wasn't for this issue.
Well, we'll have to see. I think I'm coming from a political point of view since that's my forte, and what I see is
saying
just
they simply didn't
buckets
buy
of
rate
red.
caps?
What's that? Say again.
What I'm saying is it's very obvious to anyone in the hedge fund or financial industry that the guys, I know people who are running $500 million shops that put rate hedges on. These guys have 200 billion of assets and 90 billion of held to maturity securities that don't know what an interest rate hedge is.
Yeah, but the question is, you could say the same thing for 2008. It was mismanagement of risk that led to the crisis. But it's just the question is, how
Yeah, but that
systematic
was
is that mismanagement?
mismanagement across like several institutions
Yeah,
and
but
across mortgage brokers across the entire country.
But how do
Because
we know
you
other
can read
institutions?
through financial statements, and I can tell you that like half the loans in the leveraged loan market, half the companies hedge their interest rate risk. I'm talking about hundreds of companies know how to hedge their interest rate risk, and that are less sophisticated than a bank of this size. That's not the same thing.
So
like
then
in
my
2008,
question.
like
Sorry,
every
go ahead.
single mortgage broker was allowing no doc loans. They're all getting big commissions, and every single bank was guilty of trading these toxic securities, CDO squared. There wasn't one bank that didn't touch these securities. Okay, Goldman Sachs got away with it because they shorted them in another part of the bank, but they were doing the same business that everybody else was doing. JP Morgan was doing the same business. Every single large bank was fined between $5 and $16 billion because of mistakes they made. I do not think that those same systemic mistakes are happening. I think
Then
not knowing an interest
why didn't you bailout then, Jay?
because it was the CEO's mistake. It was the CEO's own mistake that caused this. And after with Dodd-Frank, you're not allowed to the government's not allowed, is no longer allowed to bail out banks after the regulation in 2008. Now they can bail out depositors. Why would there be a VC bailout? That'd be the worst political thing for for both parties with this debt ceiling debacle coming up, to say that they bailed out VCs, which by the way have the most dry powder they've had in recorded history of 500 billion.
No, but why do we? So I'll rephrase my question. Why didn't VCs come in? So VCs are not supporting.
Why didn't they come in? I think it was a responsibility issue where, like we said before, if Founders Fund, were to bail out the bank, even if they put up $5 billion, the hole at this firm is closer to $20 billion, right? It was the 1.8 billion of AFS and probably 15 to 25 billion at the HTM. So this hole was a massive, massive hole. Let's say it's an over $20 billion hole. You could have gotten 2 or 3 firms to come in, and given, like I said before, it would have been possible if they had the proper risk management in place, because there's still a risk that they could lose more money, right? If interest rates were to go higher, they could have lost even more money. They had no risk management in place. So you could have had these VCs come in and put a Band-Aid on it and say, hey, we support the bank, and put $5 billion in, and the bank would have been fine for another 6 months.
Breaking news
right?
off
Until
of
the issue would have come up again.
Breaking news off of Barron's here, reported just an hour ago or so. This probably was scheduled, but it certainly doesn't look good. SVP Financial CEO Greg Becker sold $3.6 million in stock nearly 2 weeks ago.
See how bad management looks? Management selling stock 2 weeks before they do. By the way, they're doing a roadshow like 3 weeks ago and telling people the bank was completely fine.
Something
At the same time,
something that actually is just coming out right now is the filings after hours, and it looks like there are several regional banks that are filing offerings after hours right now, and even some bigger banks. U.S. Bank Corp, it's a bigger one, files automatic mixed security shelf. HBT Financial files 3 million shares common stock for holders. So clearly, I'm not saying again that these guys are all having solvency issues. I think maybe this is an attempt to reassure.
it's the Fed telling these guys, hey, raise some money so that we don't have to deal with this crap next week.
Exactly. But these are hitting, like, I'm just looking at the filings right now, and they're all hitting it's nonstop. Either all the headlines right now after hours are either companies, small cap biotech companies saying we don't have any money at SVB, and all the rest of the headlines are banks that are raising money here after hours that are filing offerings. So that's actually interesting, and that's just hitting right now.
Here's a small clip. This is from top economic advisors Cecilia Rouse from the Biden White House. She's kind of downplaying it. She's asked a question. This is her response.
It is the 19th largest bank in the U.S. It went down in about 40 hours. What do you say to Americans who have real concerns?
The audio's Justin. It's very hard to hear this time.
That was just a
It's very hard. I don't know what.
You'll hear the answer. The question
okay.
from the reporter is
Thanks,
sorry. The question is not on mic, which is, what do you say to Americans who are concerned seeing this thing go down in 40 hours? One here is the answer from Cecilia Rouse.
This is why we have the FDIC and other safeguards in place in our banking system. And what I would say to them is that our Secretary of the Treasury, Secretary Yellen, the bank regulators, those who provide the guardrails and are safeguarding, are closely watching and are prepared to use the tools that they need.
Yeah, we'll see how that goes.
So what are those tools then?
Yeah. Well, can I make a suggestion?
Your tax money.
Yeah. Number one, the executives can be locked up. Number two, the firms should not be bailed out. Number three, if the government wants to do anything, help the people who are working for companies that weren't able to make payroll this week. Let's start with that.
Yeah, but Aaron, in that whole scheme of things, you recall we had a recent incident where we tried to help people make payroll, and that was based on government intervention as well. And that didn't work out too well, did it, for anything? You and I both know that. I think we both wrote books
Fair
on
enough.
that issue, but
I think as long as some people go to jail, we will have taken a step in the right direction.
But are you going to send someone to jail for not putting on a rate hedge? I don't know if that guy deserves to go to jail. He's just a moron.
I'm going to read something out quickly from Gary Tan. Gary Tan just put out a great thread. I'm actually going to send him an invite. The number one pressing issue for these startups is payroll. You can't have people work if you can't pay them. This means mass furlough. It means thousands of startups die before the FDIC gets through its receivership process and release the funds. From what I hear, there are venture debt options coming from providers like Brex, but we're going to need a lot of options in order to avoid a mass shutdown of all American startups in the next few weeks.
That was the point I was making to you.
It continues. It continues. It gets worse than redacted. This is an extinction level. Okay, I don't know if this is an extinction level event for startups, and will set startups and innovation back by 10 years or more. Big tech will not care about this to have cash elsewhere. All little startups, tomorrow's Googles and Facebooks, will be extinguished if we don't find a fix. 30% of Y Combinator companies exposed through SVB can't make payroll in the next 30 days. As again, 30% of Y Combinator companies cannot make payroll in the next 30 days.
Who tweeted this?
Gary Tan. If you or I'll pin it above. If the handle
So Gary
is Gary,
Tan, for those who don't know, he's the CEO of Y Combinator.
If you or
I
your
just want to add a quick comment here. Quick comment about YC companies.
Let me just quickly read it out. It's one sentence, Tom. Just one more sentence. I'll give you the mic. Sure. If you or your company are affected, I recommend that you reach out to your local congressman to get this on their radar today. This is fucking insane.
$250,000 is like 1 month's burn, maybe 2 months burn for a lot of these companies.
And how long does it take for them to get that $250,000?
I never had to be in that situation. Couldn't tell you.
You typically for that range, you could typically go to your angels for that sort of thing.
But guys,
it's just adjustments.
Yeah, but
in many ways.
Guys, just a quick question. Like,
it's legit though.
Yeah, if Y Combinator CEO is ringing the alarm to that extent, is that just because he's impacted by this? His startups are impacted by this? Is he over exaggerated, or the numbers make sense? To call this an extinction level event for startups,
no,
and to set back innovation by 10. Yeah, he's impacted. Yeah, exactly. But like, how much bias is in this? Set back innovation by 10 years or more.
Oh, I see. Well, he's telling people to reach out to congressmen. You need to give them a story, right? So I understand why he's
no, but then again, he's 30% of YC companies exposed can't make payroll in the next 30 days. That's
a lot of those are lines of credit. I mean, those are lines of credit.
Yeah, that's what I was That's what I was
Yeah,
talking about earlier, Mario.
yeah.
Is the lines of credit to operate the business. These are all going to be frozen, and this is the problem. They will not be able to make payroll or operate their companies.
Yeah, it's not just the deposits, it's the fact that on the balance sheet, these guys are borrowing and making payroll from these venture debt lines.
I mean,
Yeah, so
they'll
Ryan,
scramble. But yeah, I remember
yeah,
my
go
own
on.
startup. We had an issue where we found a great opportunity to do some advertising to really hit a good swath of potential customers. Didn't have the cash and capital for it. CFO went scrambling in the back room and he said, "Oh yeah, I forgot I had this Chase pre-approved 35K," and we used that on the fly. I guarantee you, these guys are scrambling through their cupboards, looking in drawers, trying to find ways to make some ends meet. In some cases, just going to your if it is simply six figures like 250K, you're going back to an angel, you're going back to someone, you're going to modify some note terms, whatever else there. But that can't be sustained for very much longer if that's what you're surviving on, credit cards and a little favor from the angel.
Yeah, I pinned the thread up top if anybody wants to read it.
Also,
Yeah, thanks
from
a lot.
Jason
Go ahead, Mark.
Calacanis, of course, another one of these insiders who's been doing a lot of this talk around SVB. I think maybe this might have been hinted at you, Mario. He said about 2 hours ago in all caps, we could really use some advice from the lazy-eyed crypto bros right now on how to manage corporate treasuries. That may have been a swipe at this crew. I'm not sure, Mario.
Yeah, sorry, just going through all the DMs from the comments in the audience and seeing what we could share.
From what I see, someone can correct me.
So hold
but-
on, there's a question before you do that. There's a question he just says another one. He's Zach. There's an issue no one's talking about, and please, anyone that can offer more clarity on this. SVB allows people, Silicon Valley, SVB allows people to get mortgages by leveraging their equity. Won't this fuck the housing market there? The founders and employees leverage their stock to get a mortgage on top of these lines of credit. I'm a coach for startups. They are taking venture debt for housing for payroll.
Yeah, that's concerning because the value of that stock is going to be a lot lower.
Anybody talk about this happening on a Friday, given America all weekend?
That's true. It's going to make some headlines. At least it gives us a little space though before the markets open Monday. But still, it's going to be a lot of people pulling off early from the slopes in Colorado. Can't do any skiing, and the good thing is either the VCs are stuck in Tahoe because they're expecting 75 inches of snow and even rain at the base, and so no one's going anywhere there. But that means that if you were in the valley working hard, you're going to work all weekend because you're not going up to the slopes. You're not taking Surf Air up to Truckee to go to your house at Martis Camp.
And then Justin, there's $4.5 trillion worth of commercial debt that has been taken on in the last 3 years. That's all sitting on adjustable money with cap rates that are burning off right now.
But what I'm confused, that's the major risk, Grant. There's 21 trillion of commercial real estate, most of which is mismarked on a cap rate basis, and 40% of that is in office and malls, which we all know are huge problems. You had 5 defaults. You had Brookfield, you had PIMCO, you had Blackstone, and you had Starwood all default on buildings on the West Coast and the East Coast already. It's just the beginning.
Yeah, I think that's really. I was up in San Francisco. I'm from the Bay Area. My father's been in commercial real estate his entire career there. He's nearly retired, but yeah, he tells me 30%, 40%. I mean, these lay occupancies and everything else are really, really going to take a bite. San Francisco, as I've noted in my book, and then also things I think they lost about 10% of their population altogether just through the COVID crazies, and now people just vacating and not coming back there. I mean, I was there on President's Day, did the family thing, went on to Pier 39 and everything else there, and took my new young kids to my old haunts when I was a kid growing up in the 80s, the Bay Area, and it was dead. I've never seen it that way before. People are still not coming out. And of course, they're not going to work.
Breaking. JP Morgan says not interested in buying what's remaining of SVB Financial because of what happened to them with Bear Stearns.
Oh boy.
Yeah, I don't. This notion that SVB is somehow going to get bought out by Sunday, I do not see any large bank touching this institution.
Jay, did they? Sorry, Jay. Did they say exactly because of Bear Stearns? What did they say exactly? Do you have a quote?
This is a text message that I got from someone. Let me try to find the quote.
Thanks, man. I'm just trying to find an update there as well. I just brought up Austin and Tom.
I believe
Guys,
it was
feel free
from
to jump
Charles
in.
Gasparino. Charles Gasparino tweeted it.
If you can pin it, yeah. So I'm not sure if you come on spaces often, but if you want to pin it above for the audience, anything we mentioned, we try to pin above in the nest or in the pinned tweets. And so Jay, if you could click on the share button and then click on the space, you'll be able to pin it above for everyone to see. Name redacted, jump in.
So I was just going to say, I just looked up like the average time for, you know, a bank that goes into receivership until exit. It's usually 6 to 12 months. And I was looking at Gary Tan's his Twitter page, and he retweeted something Eric Swalwell said, who's calling on the FDIC to make sure all deposits exceeding $250,000 are covered. I mean, that is just ridiculous. The FDIC doesn't even have that much money to do that. The depositors at this bank, that's one thing. Again, it's really the credit lines that we keep talking about to all these VC funds and all these small startups that are going to be frozen, and they will not have access to this money to operate their business. So as far as depositors, like, no one's going to get special treatment. Nothing's going to happen, I don't think, until the whole receivership plays out. It's really sad for the startups that they're going to lose all their credit lines. But I do not see a large bank stepping in like a Bear Stearns style and buying this company or this bank by Sunday. It's too large. They're sitting on an exorbitant amount of mortgage-backed securities and commercial mortgage-backed securities that they already have a large, paper loss that that on their books. And I don't see a large bank like a JP Morgan or B of A like taking on that risk. Just because they were obviously the management was incompetent to have that large amount of exposure to mortgage-backed securities on their balance sheet, and I just don't see a big bank taking that on.
So they got until Wednesday for payroll, so you gave yourself Monday or Tuesday to iron things out.
Yeah,
people go begging on Tuesday night.
Royal Bank of Canada put out a note on your very point that if a bank were to acquire, if you look at merger accounting rules, if a bank were to acquire this bank, it's not like they can just absorb the securities and not mark them down. When you buy this bank, not only are you paying for the actual equity of the bank, you have to mark down, those securities by 15 billion plus. So it's not as easy to take over this bank as it would have been if they didn't have this securities hole.
So unless the government steps in and insures them against the losses, and that's what I was referring to back in 10.
That would be great. Yeah, that would be great.
Yes, to the point of the receivership and the FDIC insurance. So the FDIC official statement says now, customers who meet the insurance limit of $250,000 will have access to their funds by Monday morning. Customers who exceed the $250,000 deposit limit will receive receivership certificates on Monday for the uninsured balance. So, as Jay mentioned earlier,
what does that mean?
I don't know. That's what the FDIC statement says. It says that the people who do,
so what I understand is that you get dividends. So essentially, you get a first dividend out of FDIC receivership. You get your $250K first, then the non-insured deposits essentially get an upfront dividend, and as the assets are sold, you get dividends up to the point where you're made whole. That's my rudimentary understanding, and then the unsecured creditors are below you.
Here is that insured depositors will have access to their funds by Monday morning, the FDIC says. Depositors with funds exceeding insurance caps will receive receivership certificates at that time.
I think I read that 97% of accounts there exceed that 250. If I'm not mistaken.
Yeah, it's 150 billion.
Like 93%. Yeah, it's a large amount is uninsured.
Because if you think about it, right, these are not people, right? These are all companies. So they're all going to have more than 250.
Yeah, so it's similar to what you guys said. Just the private equity guy's been on stage. You might know him, guys. Mo, no bidders from larger banks to take it over, which is telling. and also seems shocking. It doesn't seem correct on how fast this has happened. I was going to ask that question earlier. Is that the speed in which this has caught us all off guard, or caught some of us off guard because the price has been tumbling for a while. Does that surprise anyone? Because I think, Ray, you mentioned how all this is public information. How come no one knew this could happen until suddenly it happened?
I think a lot of this information was public, but you needed a catalyst. Just like, Prodigal was talking about, there are a lot of risks in the market. There are risks in everything we do. You need a catalyst for them to materialize. And the catalyst for this was the bank run, which has resulted in all these different issues coming up.
Are you saying, but what you said earlier is that there's no other big banks. So would you say there's no other top 15 banks? So we're at 16 here. No other top 15 banks that have that same exposure?
There are no other 15 banks that have the 40% securities exposure with no rate hedges, completely asinine, like this bank.
So essentially, what the main concern here, the main concern we're all talking about, is not a concern among the banking sector. It's a concern among
there are places
the
like
tech
Schwab.
sector.
So Schwab has 170 billion of held to maturity securities. They actually moved securities to the held to maturity bucket. So they changed their accounting. I posted about this, and they transferred roughly, it was 108 billion, 79.8 billion from the AFS category to the HTM category. And if you were to mark those down based on the duration of the securities, they would see, so on a net 173 billion, they would see losses of 32 billion. The market cap of Schwab today is relatively large, so it's not like it's going to go negative like SIVB. But if you look at 32 billion loss on Schwab's market cap, which is 108 billion, that's like a third of their market cap vanishing if they were forced to sell, which means that they would breach their capital ratio. And that's what people are afraid. So it's not like there are no other banks that have this type of setup. There are other banks that have it, but the top 15 just don't have this type of exposure, nowhere close.
And where is Schwab on the ranking?
Schwab, in terms of assets, is 500 billion, so it's like twice the size of SIVB, but it's not considered a bank, right? It's a broker dealer. So I don't know if it kind of fits in that ranking, but if you think about it, it's twice as big as Silicon Valley Bank.
I'm just replaying videos, trying to find a clip from Mark Sister's VC conference Upfront Summit just the other day. I don't have anything except for just background noise to play you while I can explain it to you. There is a choir of angel-clad singers coming off the stage. There are acrobats in the air. Everyone is cheering and jumping for joy. And there's the SVB logo right behind them. So it was
sounds satanic.
That was just a week ago. Everyone was celebrating there at the
This guy did a non-deal roadshow 3 weeks ago. He's telling every single hedge fund on the planet that he's okay. He basically had fooled all these sell-side banks into pitching. JP Morgan 4 months ago was saying this was a $650 stock. Completely ignored the balance sheet and the fact that there are no rate hedges. There's no risk management at the firm.
I want to kind of build on what Jay was just saying too. I mean, that was a great summary of what, the catalyst. There's always risk. You need a catalyst. And I think it's important to note that the catalyst here was almost entirely just human behavior. And I think that speaks to just the overall market sentiment right now and the way that investors are uneasy right now. I mean, you see, I don't think we've had worse investor confidence since 08, and even and honestly, it's could be on the same levels as 08 now.
Hold on. Sorry. Basically, what do you mean it's the same level? Investor confidence is at the same level as 08?
Yeah, I think. I
don't think so.
I wouldn't say we're at 08, but we're at the lowest since 08, and I think that the uncertainty that has been created by the Fed and just the whole situation leading up to what just happened has investors are very reactive right now to headlines, especially because of how easy this information is being spread. All it takes is a rumor to emerge, and then all of a sudden, you see something like this blow up. So I think this is more of it, also just a comment on what's happening with human behavior and how people are viewing markets. I think it's definitely evolving compared to what we saw for the last 10 years.
Jay, before hold on, Jay, name redacted. Before I go to you guys, Justin, I've sent you a video that could be worth playing. I've sent it to you on WhatsApp, and I see we've got Austin on stage. I'll give you the mic in a bit. But Jay, just on that particular statement, confidence at 08 levels. I just think, in my opinion, that's an overstatement. But you guys know better.
I mean,
Do
you can
share
look
that
at
sentiment?
consumer confidence. You don't even need to listen to me. You can look at consumer confidence levels, and there's data published, right? You can look at consumer confidence. You can look at consumer spending. You can look at the regulations and the three major regulations I spoke about earlier around the banking system. You can look at the tier 1 capital ratios at the banks. You can look at corporate cash versus debt ratio. There are several things you can look at that point
But
to
I'm
the
confused.
fact
The
that,
White House said this is the best economy in 50 plus years. What are you saying?
no, I'm actually supporting a lot of that, and I'm saying that on several metrics, the economy is much better today than it was in
Otherwise, we wouldn't be
2005,
seeing.
2006,
Otherwise, we wouldn't be seeing the
2007.
same. Yeah, we wouldn't see the same hawkish approach by the Fed.
I
Yeah,
think
the
you have a
Fed
better
wouldn't have
economy, but
raised
I don't think
rates.
consumer sentiment is better. I think you can have worse sentiment with a better economy. I mean, I think there's just right now,
the stock market's still near all-time highs. Consumer sentiment has been going up. Believe it or not, I mean, it's a lot better than 08. It's better
No,
than
but
when I remember.
this is the thing. Like, I was just having a discussion with actually Wahid, who's here there. We're just having a positive discussion for the first time in months. That, hey, finally things looking at the up and up in crypto and in traditional markets. So it's just surprising how this caught us by surprise. I do want, and Kobasi, your comment, I want to kind of dig into it a bit further. Justin, could you want to play the clip by Gary Tan? If anyone can get anyone from Y Combinator, especially Gary, to come on the space, please do so. Please do DM me. Would love to have Gary come in and just give us a bit of an update and answer a few questions. But
All right, rolling
otherwise,
this now.
Justin, go ahead, man.
This is closing bell overtime. Here we go.
SE has funded about 3,000 active startups right now. I would guess that this affects more than 1,000 startups, and about a third of those startups will not be able to make payroll in the next 30 days in the current configuration. You know, as of this morning, Rippling, which many startups use to manage payroll and benefits, transfers were not being processed by SVB for payroll. And so that's a really existential threat for companies broadly. These are founders who are texting me and calling me saying, do I need to furlough my workers next week because I do not have other bank accounts? A Google or a Facebook, or even companies farther along with the Treasury Department, they're going to be able to weather this. But if SVB is your only bank, it's actually an existential risk. You're going to go out of business if you can't pay payroll. And that starts Monday.
Okay.
So yeah, it's interesting. He mentions Instacart. Also on the screen was Rippler, was Flock. If any of you know Flock, they just opened up a brand new multi-building headquarters there in Orange County. This is going to impact a lot of folks on this run. So we'll be watching that. There's more to that clip, but let's just comment on that. Any thoughts?
So my question about that is that still going to be the case even though the FDIC has basically taken over?
Well, absolutely. I think we pointed out that the levels that these folks have as far as I mean, if you're looking, what 250 will cover maybe 100 employees plus vendors and everything else there, maybe for a monthly payroll.
What were the numbers? 97% of the funds.
Sorry, the reason I'm asking Mario and Justin is because I'm just reading the BBC article that's just come out, and what they're saying is that the FDIC normally protects $250,000, as per you said, but now it's taken over the entire bank. So it has taken charge of roughly 175 billion in deposits.
So what does only about 20% or so, or is even insured of the $170 billion? Like 150 billion is uninsured. So like, for example, Roku just put out a press release or filed an 8K that on their balance sheet they have 1.9 billion in cash, but $500 million of that is at SVB. So
what happens if this isn't resolved by Monday with a backstop for wages and lines of credit? I mean, no board is going to assume personal liability for unpaid wages. Is everybody?
They're going to fire
You're telling
people,
me they're not going to step in?
They'll rehire
they're going
them
to have
later.
to lay off employees, or unless they want to sit there and work for free.
So we're expecting mass layoff announcements over the weekend through Monday.
Well,
I think that's the base case.
Yeah.
I think a lot of people, my experience typically is that they'll, if they don't make payroll Wednesday, they'll be late on payroll, but by Friday they'll have something to cover it. But yeah, plans will be afoot very quickly to lay people off.
This bug of cutting workforce to spur efficiency in tech, I mean, has been broadly accepted by markets in the last 4 months. I mean, every tech company that has slashed jobs in the last 4 to 5 months, the stock has ripped. And this is just another catalyst for that. I think you will see a ton of headlines early next week, if not over the weekend, on small tech companies conducting layoffs. I'm almost certain of it.
Yeah,
just want to read out one.
Different though than normal layoffs. Obviously, I mean, they're not going to be able to even continue operating because they don't have access to capital. So these layoffs,
right?
I'm not
saying the context is the same. I understand that in this case, they're not slashing jobs for efficiency purposes or because of market pressure in general. But either way, this is just like for tech companies that were sitting on the sidelines, especially to those that have exposure to SVB and we're considering another round of layoffs. Maybe we're considering another 8 to 12%, labor force cut. Now they're even more compelled to do that and probably more incentivized to do that.
So I do want to quickly read out, before you read out next clip, Justin, I just want to read out Tribe Capital, Arjun Sethi, who is actually getting a bit of criticism for pulling out of SBV before, pulling funds from SBV before most VCs. So he's very early in making the move. But he says the following: the venture ecosystem is wandering in the desert. Liquidity is dry. Headline media and podcasts will tell you that companies will fail. And then he continues going through some, instead of relying on how people feel about what's happening today, we decided to quantify forecasts and forecast the supply and demand of capital in our weather report. I'm going to pin that above. It's a pretty interesting report, some good numbers to look at. I'll pin it above in the nest for everyone to have a look at it, read through it as Justin plays the next clip.
Let me play the next section of Gary Tan's interview here. They're asking him a question.
Game this out for us. What happens? Is this just law of the jungle then? Are investors going through their portfolios and triaging who can we scrape together cash for to keep alive first? And are private equity firms swooping in saying, hey, if you can't make it, we're here for you, but here's the price that we're willing to pay?
Private equity and all of these later stage investors, you're going to be able to look at, balance sheets and do a lot of diligence. That is not what you can do for a lot of the earliest possible stage. Like we're talking about the things that will become Facebook or Google, but when they're only 1 or 2 years into it, they might be 10 or 100 people. These are small businesses today, and many of them will go on to become huge drivers of the economy later. 90 companies out of the 3,000 that YC has funded have become billion-dollar companies. And that, that's a crazy stat, but that number will come down very significantly, and this will hurt all of American innovation and our competitiveness in the world if we allow these startups to go under in the next 30 to 60 days.
That'll be interesting. I think the timing of this is so volatile and opportunistic as well, with ChatGPT, with AI really coming of age into the sector. So many pitch decks going around on AI stuff. I'd be kidding to say I wouldn't prep my own because there's one of my favorite topics, but that will be interesting. GPT-4 coming out next week with multimodal approaches. So we'll see what happens, because that seems to be like a next wave of investment opportunity, but it looks like that might go kind of garage style rather than incubator if this trend continues. What are you guys' thoughts on the timing with the new tech?
I want you, before anyone answers, and before we go to to just answer that question and go to Hallmars, I do also want to mention, Justin, I just got some information sent by someone. Some of it we've talked about before, but let me just summarize the size of Silicon Valley Bank and some of the numbers. We talked about it being the 16th largest bank. Another source says it's the 8th largest bank in the USA. I'm trying to get that source, but the person sending me this information, is a credible person. So I'll read out exactly what he sent me. Is just a bit of a summary. Let me see the source. I'll share the source in a bit. As of today, the 8th largest bank in the USA, Silicon Valley Bank, California, is insolvent. At the beginning of the week, Forbes, Jesus, I didn't know that. At the beginning of the week, Forbes magazine named it Bank 2023. There are probably 20K startups in the valley affected. So next week, no salary payments for employees. And as you said before, only 2.7% of Silicon Valley Bank deposits are less than 250K. So that means 97%, 97.3 aren't FDIC insured. $150 billion was non-insured deposits. Silicon Valley Bank has 50% of US venture capital backed startups as customers. There are over 130,000 VC-backed companies, according to PitchBook. That's nearly 65,000 startups that use SVB. Has anyone verified those numbers? Because these are too big, much bigger than I expected. So I probably want to know the exact source.
There's a Zero Hedge article, and it literally is taking the numbers off their balance sheet. So yeah, they have $173 billion on deposits, and 150 billion of those are uninsured. That's from their balance sheet. Like
now keep in mind that of that they have, obviously they have, cash and securities and assets in the form of loans that they can actually liquidate over time. So it's not like those uninsured deposits are going to recover zero. They'll just recover over several months. But in my quick math, about 2/3 of the uninsured deposits, they have some sort of asset coverage after the security losses.
So yeah, it's not going to be a zero.
Just to jump in,
so guys, just before you do Stock Talk, before you do, sorry, Stock Talk, you don't interrupt a lot, but Mr. Sethi, how are you, Arjun?
Well, how about you guys?
Yeah, good man, good. I appreciate you jumping in on such short notice since we don't even have a relationship before this. So I appreciate it. Your thread is being shared heavily. I'd love just a bit of an overview about the tweets that you've sent out over the last few hours that have gone viral, and what your thoughts are about what's going on.
I'm learning. I'm learning more from you guys than my team. I think my perspective is different because, I'm spending most of our time doing our fiduciary for our companies, which is, how do they get to the next stage from a company's life cycle from Series A, B, D, C. And so, you probably hear from a lot of folks. I was listening to Gary's thing around payroll. That's right. It's mostly for early and mid-stage companies, or a little bit earlier in the mid-stage risk cycle. It's less so the case for other companies. But I think one thing that's important to note that people sort of kind of forget about because they're looking at the balance sheet, which I think it's really important, is that majority of the Silicon Valley, I'd say traditional ecosystem, banked personally and professionally with SVB, right? So you're talking about mortgages, loans, capital call lines of credit. If you set up a fund or a funded admin account or an SPV, it typically went through SVB. We didn't do that. It's not to say that we were, geniuses in any capacity or not. We just decided not to because we had existing relationships, from some of the bigger guys from our previous firms. But I think what's kind of sad to see is that a lot of the folks in the ecosystem went out to try to defend the Silicon Valley Bank when the math was there. They made mistakes, the liabilities, et cetera. It's not a complicated thing, poor asset liabilities when the rates went up, and starting 30 to 60 days ago. And we told a lot of our companies that were a part of SVB even weeks ago, hey, you should really think about diversifying your risk. And then we just got louder and louder and louder over the last couple of weeks. But we came under a lot of shit. The number of boardrooms that I've been in where you're talking about luminaries in the tech ecosystem that I sit with, saying that we were crazy for thinking about it, and that we're just, crypto bulls, or, we saw something with Silvergate. But we've seen this before. We saw this with Terra Luna. We've seen this with Yes Bank in India. Obviously, we saw this with Silver Lake recently with crypto. But I think what's really important is that, like, what matters the most is the company, its solvency, how to make sure you pay people on time, and making sure that you have fiduciary to your customers. If you're in fintech, to your depositors. And I think a lot of people just forgot about that. They went to focus on their feelings of how to support the company, even though it made its mistakes.
And Arjun, the next question I have is the contagion that you expect. What could happen over the next few weeks? What's the best case scenario? What's the worst case scenario?
Yeah, I think worst case, it's hard to project. I can just tell you what we tell our companies, like sort of the truth of the matter, is that any fintech or neobanks that focus on startups, you should be wary of them, and I would de-risk it all. I wouldn't do it, but it's up to them. And then there's just segmentation of deposits, right? Like, where else in the economy are there depositors that might be fickle as well, right? Beyond just like a tech startup or earnings, right? So You can think about construction, labor, small to medium businesses within certain sectors as the interest rates have gone up. Like, where else is it going to affect certain demand cycles? And that's something to think through. I don't have all the answers, but that's how I would think about what does that mean for, the $5 trillion of deposits that went in, and they invested and or put what does a balance sheet risk look like for some of these banks, and what are they going to do, and who do they service, and who's at risk? And the honest answer is I don't know, but I think it's worth taking a look at what are the types of things that you want to do in a situation like this. It's not about having a run on the bank. It's just, where do your deposits go, and do you want to have it go into treasuries or things that make that are a little bit riskless in theory from a government perspective, or want it to sit in the coffers of a bank like Silicon Valley.
And the statement that we mentioned earlier, that this is an 08 like scenario for crypto and for tech, would you say that's an over exaggeration? That's a question number one. And the question number two from the audience is that, could we see contagion outside the tech and startup sector and outside the VC world into the broader financial world? We just the sentiment before was like unlikely. Jay made a good argument that this is unlikely to happen. It's a very different issue to what we had in 08, but would love your take on this.
Yeah, I would probably echo that. It's obviously different to 08, but I think what you've seen from here, what stands is that when some of these companies have made mistakes and people started making changes based on it, right? Like you can call it sentiment in the market, is that it affects their business. And when the deposits go down, like any other bank, it could be effectively impaired. And so what do you do? And so when I think about what does the contagion look like for the other banks, the question ends up being, do people focus on flight to safety? And if that's the case, yeah, I think regional banks and banks that have certain sectors that they're more overweight on in terms of their depositors, it's possible. I can't speak to if it's possible or not, but let's take into consideration just the tech ecosystem. There are a number of banks that also have the similar types of exposure to Silicon Valley Bank, and so it would be prudent to take a look at how do they manage that capital, and are they on the riskier side or on the conservative side? And I'd say someone like First Republic typically is more conservative, but could it still be deemed risky depending on the amount of depositors that leave? And I've heard about people leaving a lot of these banks and just going to focus on the top four and saying, fuck it, that's who we should deposit with. Let's just stay safe and let's not take any chances.
Hey, Arjun, could you comment just kind of on the culture of what's happening sort of Silicon Valley? 20 years ago, it was very much David and Goliath. I think 10 years ago, it got very New Yorky, everyone in blazers, everyone down at some of the bars there. Then, COVID hits, it kind of gets a lot of hubris. People really get into themselves. Now everyone's back on the slopes, back at Marta's camp. Is there like a biblical cycle? Do you think where would you sort of peg us culturally as far as what might have led to some of the challenges that SVB found? Was this just hubris? Was this overconfidence? Was this hiding things? What was your sense culturally in what's happening there in Silicon Valley?
So, honestly, I wouldn't say it's too much. Here's my perspective. I wouldn't say it's just the Silicon Valley. I think it's, the people that invested in tech growth stocks, public and private, obviously crypto. We had, you had Balaji's tweet. He's right. Like we printed a crap ton of capital. We obviously put it into assets. Those assets became riskier and riskier that we put it into. Deposits went up. Now what happens, all of a sudden the interest rates are going up at a fast pace. I think that's really important. It's not a slope that is sublinear or linear. It's like it looks like a super linear growth, right? Like you can compare it in the same way you would look at companies that are growing at a certain rate. And so that's had a knock-on effect on a lot of the way in which people have been thinking. It's had a knock-on effect on earnings. Gross demand, I think, is something to really take a look at. And all of these companies that got venture-backed, they relied on the capital that was being injected into the market because, it's startups are the customers of those startups. And so if you go, if you trace route that far enough, yeah, there's definitely a certain amount of hubris, which is the music's never going to stop playing, and we're going to all have fun all the way up. And I think what you're seeing is just the shortage and the availability of capital is, it's almost on par as what we've seen in 2001. I'd actually say it's worse. in terms of availability on a worldwide scale.
Yeah,
You know
2001.
what's really interesting
Go ahead.
about this situation? It's not just the deposits. A gentleman made the comment earlier, but I'm just putting two and two together. It's a multiplier effect, right? Because you have all these credit lines that you can't draw on, plus the deposits. So the actual, in the short term, until the uninsured dividends are paid, right? 2/3 of the deposits, uninsured deposits, might be recovered on. But in the meantime, not only do you not have access to your deposits, you don't have any access to loans. So the actual impact to the economy is twice as much as, the media is focusing on right now.
That's right. The credit markets is something to really pay attention to.
It'll be interesting to see. There's a couple articles, one on TechCrunch, one over on Bloomberg, talking about the impact on China incubators. Obviously, I think SVB has been over there for at least a decade or more, and I think just recently made a big deal with a Sino American bank there relation, and so it'll be interesting to see what sort of impact this has on a global basis beyond sort of the investment case across the U.S. Thoughts on that? And we have a good wing on that.
Yeah, guys, just jump in. I see a lot of hands up. In the meantime, I'm trying to verify something in the.
Let's go to. I saw Gordon come up. I'm glad he's up here. Gordon, tell us where you're coming from. What are your thoughts on this whole crazy day?
Hey guys, thanks for the comments. I just wanted to get anybody's view who has a deep insight into what's going on here. It seems to me that what happened with SVB, Silicon Valley Bank, is number one, it seems like I think that they were using adjusted EBITDA numbers to make loans to companies that were actually burning cash. And I think that that's one of the reasons that their credit exposure got a bit aggressive. In addition to that, it seems to me that they also clearly brought a bunch of treasuries when rates were low. And, a lot of their customers were crypto firms and quote unquote innovative firms that lost money. So when the market started to crash and things started to turn down, their customers started to withdraw their deposits, and they effectively had to use the treasuries that they had purchased at very low rates, where when rates had went up, to fund those deposit withdrawals. So they clearly had to take huge marked losses on that, and that's really what caused the decline. I just wanted to get anybody's view who thinks that's wrong.
So I think that part of that is right, but I think what happened was there's really nothing to do with the poor underwriting. We can say that they had poor underwriting, but a lot of the lending was venture debt. It was backed by receivables, and you're probably familiar with that business. But the biggest issue was that they're lending to companies that burn cash, and that they bought $91 billion of mortgage-backed securities with over 5-year duration without an interest rate hedge. If they bought the securities with a hedge, they would have been around today. They would have been around for the next 2 years.
I think that's the key point.
Yeah, but were they using adjusted EBITDA for their debt metrics? That's what I heard was a big problem.
I don't think it matters. I think it might have been. By the way, I think all private lenders use adjusted EBITDA, but in this case, I don't think it's what caused the situation. That would have been an issue next year that we would have caught up to. But this situation wasn't caused by that.
Okay, I would posit that I disagree with that. If you're lending to companies that don't generate cash and you're using adjusted EBITDA numbers, that results in disaster. But I'll turn it back over.
The issue here was they had a $15 billion hole in their balance sheet that was accelerated by bank run. If you want to know the immediate catalyst, there are a lot of things wrong with the institution.
Right,
but if you want to know the immediate catalyst, there was a bank run because they came out with an 8K that essentially stated, so the way this company worked is that it only worked if venture capital was growing. So these companies were essentially losing money. When a company does a Series A, Series B convert, or a Series C, they're raising capital for 6 to 18 months. It doesn't matter what the EBITDA is. You're borrowing money for a certain amount of time. You're going to burn a certain amount of money. It doesn't work like the leverage markets. So because they're burning all that money is leaving the system, and on the other side, they're raising money from new capital raises that's being put on the deposits. So the bank was growing because they're raising more money than companies were burning. When that flipped, what ended up happening was that they had to sell $21 billion of AFS securities at a $1.8 billion loss that would have hurt their their CET1 capital ratio. In order to avoid that,
go to JJ. Yeah, I just want to move on quickly because I don't want to get too technical for the audience, but also I just want to go back to the projects. I am getting a lot of DMs from projects, and I'll read out a message from the person that recommended I invite you, Arjun. There's a large a group of startups that were sharing your tweet, and I'll ask their questions. There's just a lot of concern. I have more than 250K in a bank. What do I do? This is a startup, and they're not talking about Silicon Valley Bank. What are you doing right now? What are you advising your portfolio companies to do right now? And then next question, if my funds are trapped, companies like Brex are offering debt for payroll. Would you take these or would you do something else? So essentially, Arjun, just like, startups are just asking for advice on what they should do next and how concerned they should be and what options do they have?
Yeah, one of the things which is really interesting is in 2008 when we had the GFC, a lot of what we had done, I had $4 million for my startup. We went to our banking partners and we basically said, can you set up, 4 million divided by 250K? How many accounts do I need to have? That still happens today. Like you can work with your treasury team or treasury management team to be able to do that. That's one. Two, on the payroll side, yeah, there are a bunch of debt providers that are out there that I think if you have a certain amount of solvency or you believe some amount of capital is going to come back to you from SVB, over the next, for payroll, et cetera. There are firms that are out there, but they're still going to underwrite you. And I think the key point here is that the underwriting procedures that they're going to go through now are going to be much more stringent than they were before. I'm not saying that's a good or bad thing. It's just that's what's going to happen. So if you're a startup, I think the traditional startup where you're raising capital and you're burning a certain amount of money in order to grow at a certain velocity, I think you do want to be prudent with your capital and find out who are the safe people to be able to put it with and what are the treasuries and deposits that you want to put in that are not just relying on a bank. I would not work with any neo banks. I think you've seen a lot of folks prescribe that recommendation. I just think it's a bad idea.
I've got the next clip from Gary Tan here. Let's just continue on with this. Last we left him, he was talking about how this was real dire straits and that could be hundreds, if not thousands, of startups affected by this. Here was his response. Let me go back just about 10 seconds for context.
Hurt all of American innovation and our competitiveness in the world if we allow these startups to go under in the next 30 to 60 days. This is a sort of a short-term thing. We really need the help, whether it's from the government or other places, to be able to free up this liquidity crunch. This is not, some people might be looking at this as a bank problem. Certainly SVB is beleaguered, but you shouldn't be worried about them. You should be worried about their depositors because this is the future of tech in America and the world.
Yeah. And just to put a number around it, at the end of 2022, the amount of uninsured deposits in the U.S. offices of this bank exceeded the FDIC insurance limit. That exceeded that insurance limit was more than $151 billion, almost $152 billion to your point. And we've seen a number of high-profile investors. Now you're starting to see some California lawmakers come out today and suggest and demand that depositors be made whole, even if that means the federal government stepping in to the tune of some sort of a bailout. Is there any reason to believe that depositors aren't going to get made whole in this process?
I guess I do not have special access to whether or not SVB is solvent or not. The experts that I talk to say that we're on a path where this, will be resolved in weeks or months. The opinions are sort of all over the place. It's a live situation. We don't know what's going to happen to the depositors long term.
Yeah, we'll see what transpires over here. You do not want to get on the wrong side of politicos here in California, especially as they're looking at budget shortfalls, which they are planning to use for all their pet projects. And those were mostly banked from the monthly budget numbers that we see from Sacramento, very much relying on corporate taxes coming in swaths. People leave, headquarters moved, and now this, it's got them seeing red, and they're very worried about it. So you can bet Newsom is probably going to cut his vacation short. I think he's coming back here. I think you're going to see a lot of very high-screeching assemblymen, senators there on Capitol Hill in Sacramento try to make beans of this because I think they want to get ahead of the game.
Who's going to pay payroll taxes?
Well, that's exactly the point, and that's that's primarily how they were, basically making bank on the surpluses that California was seeing. We had very huge successes, especially with the pandemic. With groups like Google and otherwise who are here in state, bringing in a lot of largesse with all their companies being, still at home and still operating functionally. Meanwhile, the mom and pop shops went out of business. A third of all restaurants closed down in California, as a reminder, folks, during the pandemic. So this had a huge impact on small companies. Big companies did just great. And in fact, a lot of largesses, a lot of people went virtual. Spoke to one of my colleagues. He puts out big telecom outlays for call centers. He thought for sure he would have to lay off all of his staff. He has tripled his business because everything went to call centers very, very quickly. And of course, the problematic AB5 as far as employment goes here in California, just a mess of things that are going to come to bear. And I guarantee you, the people up in Sacramento, they do not like to be caught shorthanded on this stuff. So they're probably going to get ahead of this thing. I would look to see if Newsom cut short his little vacay down south in Acapulco, wherever he was, and he'll be coming back shortly.
I just want to say we have a lawyer for any startups wanting some clarity. We have a lawyer that's going to come up and provide some color on the FDIC resolution process for anyone that has questions there. Stock Talk, jump in.
Yeah, I was just going to chime in to update. So SIVB is going to be removed from the S&P 500 Monday morning at trading open. It'll be replaced by Insolent, which is ticker PODD. And we were talking about earlier with the small cap tech and biotech exposure to this name. That's really hitting the lines after hours. There are, I don't know, at least 35, 40 headlines here. SoFi says no assets held at Silicon Valley Bank. Ginkgo Bioworks, ticker DNA, says 6% of cash held there. Payoneer says 20 million in cash held there. Ambarella Therapeutics says 17 million in cash held there. Rocket Lab says 8% of total cash and cash equivalents held there. Roblox says an undetermined amount of cash held there. Roku filed a filing that said 26% of their cash and cash equivalents is held there. So yeah, there's just countless companies that have anywhere between 5 to 30% of their cash and cash equivalents held at SIVB. And as we talked about earlier, the credit lines are an entirely separate conversation. Some of these
that's just cash and cash equivalents there, like 26%.
Yeah, all those yeah, for Roku, I think it's cash. Yeah, all of these headlines are cash and cash equivalents. But the real risk, I think, is that, like we mentioned earlier, there's some of these small cap companies that prior to this happening already had maybe 6 months, 8 months, a year and a half of cash and cash equivalents to just sustain operations with the rates that they're burning at. If you add this into the mix with frozen deposits combined with them not having access to credit facilities that they normally had, it's more than just a payroll issue for some of these smaller companies. For a number of these publicly listed small cap companies, anywhere between a 200 million market capitalization, I mean, some are even smaller than that, all the way up to 2-3 billion market capitalizations, have material risk here, right? I mean, their deposits, a lot of their deposits are uninsured. There have been a couple filings after hours where they're directly saying in the filings, 90, 80, 90, 70% of our deposits are uninsured. So, they're acknowledging that risk. Again, I'm not saying that all of these companies are going to lose all of their money, but there's huge operational risk to some of these companies that require these facilities and deposits to operate. So
no, I had a comment here. We had someone asking a question.
Pressure speed up.
So someone's indicating that FDIC insurance only covers personal accounts, not business
No,
accounts.
that's not true. It's any
That's
person.
not true, is it?
A person includes a partnership, an LLC,
correct,
a corporation. So that's not factually correct.
Okay, I want to make sure that was good.
It's not true, but I guess the point to make there is that the 250K doesn't matter for some of these deposits, right? I mean, it's a percent of some of these deposits, right? Less than that for some of these deposits. So
anyone know what that other question from the audience are being DM'd to me? What's going to happen to mortgages for the low rates? What will be sold? Those will be packaged and sold, or I guess no one's stepping up to buy the bank, but what about those mortgages?
They're going to have to just sell their mortgage-backed
They're going to have to sell
securities
them, yeah.
through their
Yeah, they're going to have to
receivership
sell them, right?
process
Yeah.
on the open market. And trust me, the banks like Goldman, Morgan
There's a
Stanley,
huge
whatever,
market for
they're
this
already
stuff.
going to start selling them.
Yeah.
They're going to front run this trade big time and then come back and be a down bid for when SIVB has to start liquidating. So like special situation, you know how that works. Like Goldman, these big banks, they know what's coming for sale. They're going to offload what they have, and then they're going to turn buyer like
You make
below market.
1 point. You make 1 point on, let's say on the 91 billion, they have 20 billion of mark-to-market losses. Make 1 point on, $70 billion, right? You make
Exactly.
700 million in profits. This
That's how it
is
works.
a dream. This is a dream for dealers.
Yeah, and they're already front running this trade. That's just how it works.
I was looking back into the news files about a month or so ago, February 3rd, BlackRock cut stake in SVB Financial Group, filed a 13 GA form with the SEC on that. So interesting. I think their stake, it wasn't like a massive decrease, but it went from like 8.8 to like 7%. So they chopped off a stake of their thing. I don't know who has inside information. I know BlackRock has been they've been divesting a lot. Okay, was it Jim?
Oh,
Oh, come on, come on.
Jim
I
Cramer
was
joke.
for that. I should find. There are some great clips from Jim today. Maybe I should pull those up. But
Yeah,
go on, guys.
please
Oh
do.
my God,
Please
he
do,
was
please do.
he
Yeah,
was
hold-
pitching this stock at 300 last month, and then just completely ignored it when he talked today.
I wonder if you'll cry on air again like last time when he did that with Coinbase.
Yeah,
It's
just
so
to
bizarre.
make something more clear too. I know we keep talking about the uninsured amount of 150 billion. That's not going to get wiped out. So even though on the
Yeah, they'll
balance
make
sheet,
2/3.
yeah, they'll
2/3 of
make
it back.
they have like what about a $15 billion hole right now. That will get larger when they come to liquidate. But the depositors will end up recovering at least 2/3 of that money. It's just going to take time. And again, it's not the depositors really necessarily at risk. It's the access to operating capital, which you see people like Jason Calacanis and David Sachs are the tweets they're putting up. I don't even know if they're in the room, but I mean, you could see you can feel the panic in their tweets. Like if this isn't resolved by Monday, a lot of companies are going to be going out of business just within a week or two.
Can you name? Can you pin their tweets above before Jay jumps in and
Yeah, I'll put
I
it on.
invited Jason,
Please.
but I haven't heard back. But
Yeah,
here we go.
it's not just the deposits and the fact that they're going to get maybe 2/3 or more back over time. It's that they won't be able to draw down on these credit lines. So even if they got 100% back from deposits, and Newsom convinced the federal government, the FDIC, to give people 100% back on uninsured deposits, there would still be a liquidity issue because these companies wouldn't have access to credit lines.
Jay, do you think there's a deeper testament here though to the, again, and I don't want to be hyperbolic here, but banks are better capitalized than they were last time, and everyone knows that, and the reserve requirements are higher than they were last time. But it's also common knowledge that in theory, the FDIC has never been stress tested in that way, even after these changes, right? In
No,
this
they
case,
they do bank stress tests like every year.
well, no.
They-
I know they do bank stress tests, right? But the FDIC insurance specifically, it's not well capitalized enough to, if this were to spread. And again, this is just
Oh,
hypothetical.
the Fed would just back the FDIC. right?
Yeah, and I think that's the bigger point here, right? Is that if this does get worse, then the Fed is just going to step in, and I think it's going to be difficult to navigate if this sentiment carries into next week. It's going to be difficult navigating around that to say at what point does the market start perceiving this crack in banks, or at least the market's perception of it, and start factoring that in as a potential for the Fed to change course. I don't know. And I don't know if just the negative sentiment overall is going to be overbearing into the next few days.
Here's let me give the quote real quick. David Sachs, this is tweeted just 2 hours ago. He says, "Where is Powell? Where is Yellen? Stop the crisis now. Announce that all depositors will be safe. Place SVB with the top 4 bank. Do this before Monday open, or there'll be contagion and the crisis will spread. Anybody who thinks that preventing bank runs and panics isn't a federal responsibility missed a couple hundred years of financial history. It's called systematic risk, and only federal banking authorities can stop it. He goes on to say Kraft has no money at SVB. But he says if the Fed doesn't nip the bank in the run, nip the bank run in the bud, regional banks be decimated, and all that'll be left is the biggest banks. You know that too big to fail ones. This will not help the little guy.
Yeah,
And
so
Brent,
basically,
we had the senior analyst at Bank of America. Again, I want to repeat it. Just said the same thing about their concerns with regional banks, the big banks. There's no concerns there, so it just leads to more to a bigger monopoly in the space. Name.
So
Yeah, look at JP Morgan today.
David,
Look at, I mean, look,
Yeah,
is
what
the
about
only
it?
bank that
What
was
about
up. I mean, you can look at
JP Morgan?
my
JP
timeline.
Morgan's up today.
Yeah, it's up today. So look at my timeline, right? The market was puking, and then I have a heat map. 4 or 5 tweets down. The heat map, they're like, 10
is
companies that are
crazy.
positive today. JP Morgan was one of the biggest gainers on the day, outside of Intel and AbbVie.
yeah, so basically what David Sachs is saying, I mean, I get it. His company Kraft Ventures, like they don't have any money on deposit. He confirmed that in his thread there with Silicon Valley Bank, but it's their exposure with all these investments they've made that their fear that if the government doesn't step in here, they're going to get wiped out on a lot of their venture capital investments. Same with Jason Calacanis. That's the fear amongst why they're calling for some sort of a bailout. And sorry to say, my opinion, it's not happening.
Yeah, I think that's probably true. A little Schadenfreude, just a quick moment here from our good friend Jim Cramer 1 month ago.
The 9th best performer year to date is SVB Financial, don't you want? This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB is the old Silicon Valley Bank. Recently bought one of our favorite research firms, Moffett-Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year, they could come back. Yes, some of them come back here, but the stock directly affects an oversold position. Stock was the 4th worst performer in 2022. I think the fears were not justified. It's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away.
So Justin, why does he?
So I hate to throw in over Jim.
Yeah. No, but does he still have a show for educational purposes, or is it just pure entertainment now? I've never.
You have to give the guy
respect.
I mean, he comes in daily. I know how hard it is to do like radio shows or performance show. I mean, you have to put in some grunt work, but you can tell even from he's just doing a teleprompter right now, just looking at it, right? And I think I feel bad for the guy, but also just you could throw a dart at a board and be more right than he has been in the last little bit. So I don't
realize that,
but sometimes
it's not just venture companies. Roblox has a couple $100 million at SIVB, and if you look at Roku, has like $500 million at SIVB.
Yeah, I think it was 26% of their cash.
There's nothing verified yet, but there's a lot of chatter, and I'm looking into some of it. But there's a lot of chatter that there are a few players that have not yet disclosed that have a few billion there as well. So there are, again, the question becomes how much of this that's over the 250K FDIC insurance is actually returned to these companies. You can make the argument that because this is the first big case that, many of these companies may receive the majority of their funds back. The question becomes if the contagion spreads, is that even possible? And that's the real danger.
Hallmars, just jump in, man.
Yeah, hey, so I'm here in Silicon Valley. I've lived here for the last 10 years, and I mean, it's just crazy just talking to people today, startups that have DM'd me, people I know. I've never really seen anything like this before, where it's really affecting quite a lot of people. I had a number of startups tell me that they were basically desperately pulling out their cash last night. Just sort of a major run on the banks. This is a situation where all of the bank's clients know each other and they all talk to each other, right? There's sort of a Silicon Valley way of thinking. And it's amazing how integrated this company is into the venture-backed startup world. In many cases, some of these venture deals, like some of these companies, AI startups that had just raised $1 million from Y Combinator, and they have their money in Silicon Valley Bank, because many times these venture deals, the VC firms, the accelerators, the venture debt they do, they often stipulate in the term sheet that it has to be through Silicon Valley Bank. So they're just amazingly integrated. And while some of the companies did manage to pull their money out in time, get it somewhere else, a lot who weren't lucky or just thought it unthinkable that, such a supposedly trustworthy institution could fail, are looking at a situation where they might not be able to make payroll. And I mean, that's going to have reverberations through the local economy, even things like real estate and stuff like that. When you look down the line at these exits and how much the venture-backed startup world really fuels the local economy here. So, it's
So
real.
if you had to go someplace tonight, where would you go? Would you go to the Battery or would you go to Rosewood for good juicy gossip?
The Rosewood for sure.
Oh, it's Friday for sure, right? Because it's got to go to Rosewood.
Hallmars, how's the what's the response with VCs? Are they speaking to their investors and what's their is there any support there yet?
Well, put yourself in the
Offering
shoes.
some sort of line of credit.
Put yourself in the shoes of a VC. You took money from your LPs and you put it into a bunch of venture-backed startups that most of them are likely going to fail anyway. They're all burning cash. None of them are making any money. And you tell them to all put their money in Silicon Valley Bank because that's just what you do. More than 50% of venture-backed startups had a bank there. The majority did. And now all of a sudden, all of your portfolio companies, or maybe some of them, maybe 30% don't have access to funding that they need to make payroll, to retain their employees. It's a potentially catastrophic situation that you can imagine their LPs are calling them. And that's why you have people like Gary Tan and David Sachs saying, hey, we need a congressional bailout.
Yeah, I think that, see, here's the question I have. SVB is also an investment arm. They have 844 investments. So what happens to the equity stake in those companies? Does it transfer out to the entity that takes them over?
It's a great question.
It's puked out in the secondary market, or it's taken over by the new financing company that is providing capital.
So this, to me, could be an attack. In other words, why isn't Sequoia or any of these other VCs set up like this? Silicon Valley Bank is a very unique entity that it can also be a bank and an investment arm. It just seems like once you find
they call it a merchant bank. All the big banks like DLJ, Goldman Sachs, a long time ago, they're all set up as merchant banks. That's what it is.
Well, I mean, this is like a hell of a bargain to sit on the sidelines and basically pick up 844 companies worth of IP as well. So I think the VCs have to step in, even if it's the Fed that goes to the VCs. In other words, go see the cash.
I think we lost you there.
Sorry about that. It just seems like the VCs really need to step out and correct this contagion versus the government, because then the founders, it's a great thing. If I'm a founder and I just wiped off somebody off my cap table, right? I mean, now I own more of my company because the government's not going to take.
I wouldn't.
equity.
I don't think it's that easy. But
Correct, but it's the
I know what you're saying.
confusion side of it. Yeah, just thinking about it.
Confusion.
Hey, breaking! You guys aware of the bank FRC? Apparently, venture companies are having trouble. First Republic Bank getting onto their website to access funds, especially if you're using Brex and you're accessing your money on First Republic through Brex. It's telling you to call 1-800-221-9777, and people cannot see how much money they have in the account. And this was another bank that was down 50% at the open. It doubled by 12 p.m. Then it sold off after the receivership news by about 20-30%, and it was extremely volatile. It's a much better capitalized bank, by the way, but it might just be that everyone's checking their accounts at the same time. And
it's possible. There were issues over at Wells Fargo as well. Lots of reports.
Exactly.
Of
These can be tech issues, but I just wanted to bring it up because someone asked me in the DMs where.
Yeah, but there's a lot of concerns about FRB as well. They're sitting there. They're a similar size to Silicon Valley Bank, aren't they?
They're almost exactly the same size. They're about 220 billion. They're almost exactly the same size. Yeah.
Yeah,
but they have less securities. They have less of a concentration of securities. and I need to open their filings to see if they.
But then again,
how they mark
if
them.
we see, but if we see a bank run, we could just become a self-fulfilling prophecy, even if
Yeah.
they're better capitalized.
Yeah, you could have these self-fulfilling prophecies, right? We're in a fractional reserve banking system, right? It's based on trust. So if you don't have trust and you start seeing these bank runs, like the issue that was brought up before is that the big banks will just get bigger, right? People will just take their money and they'll say, okay, well, I'm going to take all my money above 250K. I'm going to move it to JP Morgan or Bank of America or Wells Fargo. And that's just not good for by the way, we have 4,970 banks in the United States. There are a lot of small banks, right, that may not be that well positioned in that type of scenario.
So just on First Republic Bank, they've dropped 40% in the last 5 days. Can you tell us more about First Republic Bank? If they do go down, what gets impacted the most, and who their clients are?
Yeah, so First Republic Bank has a lot less exposure to the venture area. It's not a name that I've done a deep dive in, but I would say that they have less than 30% exposure to the venture area as opposed to SIVB, which was over 80% exposed. When you look at, this bank, it has very high quality customers. It's based, it serves the custody function. It has high net worth investors. It has, individual depositors. It's not just, private business banking. They do, essentially what they call this high net worth business, private banking for wealthy individuals. They're based in coastal markets, so they have wealthy clients. I think overall, it's like a much lower risk. Their tier 1 capital ratio is above 12%. It's a $15 billion market cap, very similar market cap.
Sorry, Jay, just quick update. Crypto keeps BlockFi 5 minutes ago from Watcher Guru. BlockFi has $227 million in Silicon Valley Bank.
Oh no.
Was it 227 million?
Yes.
Oh wow. Okay. So for people who are really interested in First Republic, doing something on Sunday that I'll go into more detail, but at a very high level, and they took FHLB advances, and if they were to replace their low cost deposits, which cost about 1.63, so like a 20-ish% deposit beta, with FHLB advances, which are almost 5% today, the reason why it's been selling off is people are assuming like a lot of NIM compression at the bank. So it's hard to value the bank because of that, because you don't know what the ROE is going to be or what the price to tangible book is going to look like after, for example, they adjust for their securities write-downs and they lower their NIM. The company, this bank might just be fundamentally overvalued if they see NIM compression, and I think that's more of an issue. But if you do have some sort of a run, because people are going to say, oh, they're lending to venture companies, even though it's a much smaller percentage of the business, combine that with the lower profitability, right? That's how you get like a crazy swing of 50% on a $220 billion bank.
I'm watching here. I saw an investor just post an email that he got just 2 days ago from a VP of startup banking at SVB, offering a 4.5 APY on 4 million, access to Innovators Card, new digital banking platform, SVB Go.
So do you know why that's so bad though for other banks offering that? Like these banks were paying 0 on deposits, and even First Republic today is paying 1.63% on deposits. Like going from that to 4 to 5%, like destroys like 2/3 of your profitability.
Yeah, I know that Mario likes to sometimes like simplify and kind of summarize this, but for the people that are new to trading and investing and don't really understand the mechanics of this, I pinned a tweet at the top. This is from the filings directly, and it says, despite the bank being in sound financial condition prior to March 9th, which is yesterday, investors and depositors reacted by initiating withdrawals totaling $42 billion in a single session on March 9th, causing a run on the bank. As a result, at the close, the bank had a negative cash balance of approximately $958 million. So mechanically, that's what happened. Now, there's more nuance around their exposure to bonds, and we discussed that earlier. But Yeah, that's in a nutshell, what happened here for people that I guess got distracted by.
Let me read something else as well. Actually, what I'll do is I'll just pin the tweet now as well, just a bit of a summary. Oh, you've pinned Stock Talk. No, I haven't pinned it yet. I'll do it now. The team just wrote a thread. For anyone that came in late, you could read it as well. I've just pinned it above and I retweeted it on my account. Just gives you an overview, just to kind of recap what we discussed earlier. Just a brief bullet points. But I want to go through a message I got here. We talked about it, but it's good to highlight. And let me know what you think of this point, Stock Talk. And then I want to go to Lindsay. But let me know what you think of this, and if you can elaborate on it for the audience. Loving the SVB chat. One thing to note is that VCs raise money from LPs. Store LP money in SVB, Silicon Valley Bank, in their fund arm. VCs invest in startups. Startups take the money and store it in SVB. And then he goes to say the whole VC ecosystem is in serious turmoil. You want to add on to that, Stock Talk?
Yeah, I think broadly speaking, that's not a crazy statement to make, to say that the VC industry is a threat. Now, do I think it's an extinction level event like Gary Tan said earlier? No, but the reason.
But why would Gary? I don't think so. I didn't think so either. But why would Gary Tan use such extreme words?
I think the point that Jay made is what
I think he wants to appeal to the governor and
he's trying to clamor for urgency, right? He wants the Fed or someone else to do something here, and so he's clamoring for urgency by saying, "Look, it's an extinction level event." Now, do I think that tech companies can suffer a lot because of this in the next 5 to 6 months or more? Yeah, I think in the short term, it's certainly going to have implications. But yeah, I don't think it's like game over for startups. It's just that these types of companies like Y Combinator and Founders Fund, I have actually a lot of very, very close friends that are involved in venture capital. My initial days in trading and investing were basically purely centered around small caps. And so I got a lot of exposure to the industry. I prefer trading public companies personally speaking, but, I have a lot of friends who are involved in venture capital, and, I talk to them all day to day and just texting back and forth. And so many of them are now thinking the same thing. They have allocations at niche regional banks similar to SIVB. And these aren't multi-billion-dollar companies. I have a friend, one of their companies is $250 million company, but he's already talking about them trying to move funds out. And his first question was, the trouble we're having is we don't know where else to move them, because, the thing with these niche banks that are focused on specific industry like this in such a way is that, they tend to be more amenable to the needs of these businesses, right? Like, venture capital tech companies have very high burn rates. They're typically not very profitable at their early stages. And so they have a different credit proposition than other companies, even other companies of similar size. And so it's more of like you're kicking out the golden goose in a way here. And that was the point that we were trying to make yesterday, which is it's nonsensical. It's mind-blowingly nonsensical for these guys like Gary and all these guys to be clamoring for bank runs or to be telling these companies to pull money out, because by their very nature, these VC funds cause these companies to have grouped banking relationships, right? I mean, these companies that are coming to these VC funds, getting capital, getting massive investments, whatever the case may be, and that are getting encouraged by those same funds, hey, just join our banking partner. Like all of our companies use SIVB. Just come on in. We have a revolving credit facility or whatever the case is, like any number of incentives that they can provide or convincing that they can provide to these companies. That is the issue here. And that's why the risk is concentrated, because so many, 30 to 40%, depending on what metrics you're using, of those tech VC companies are involved here. So that part is scary, right? That there's such a concentration in this specific industry at certain banks as a result of VC funds in this industry having their fingers in every pot, right? I mean, Y Combinator and Founders Fund and a handful of these other VC funds are responsible for like all of the big tech VC companies, like all of them, like 90% of them are within 5 or 6 of these VC funds, at least the meaningful companies. And so when you think of it that way, it is a risk to innovation, right? Again, I think that some of his statement was hyperbolic, like it'll set innovation back 10 years, it'll destroy the industry. I think that's hyperbolic, but will it set back some of these companies? Is it a risk to innovation? Yeah. And that's why I think there'll probably be some sort of backstop here. Somebody is going to save this because, I'm not talking about outright buying the bank. I'm talking about somebody is going to put a stop on this in some fashion, I imagine, over the next
It definitely
weeks.
feels.
Yeah,
Carol, can you give us I will quickly go to Carol. Carol, can you give us a bit of an overview on the legal process? What's next for Silicon Valley Bank?
Well, I think there are a couple of points of qualification, and thank you for giving me an opportunity to speak. First of all, typically when a bank is going down, the FDIC has a fair amount of leeway or lead time. It can be any place from a few days to a few weeks, and sometimes often months. And in this case, this has all really come down very, very quickly. Not that they haven't probably had some level of contingency plan in place, but the bottom line is that trying to arrange a deal, and I've heard some comments in this space over the last hour or so about why don't we force one of the top 4 banks to acquire Silicon Valley Bank? The process of getting somebody to the table to actually do a deal like that does take time. It takes a fair amount of negotiation, a lot of due diligence, and so on. So we've seen a lot of things compressed into a very short time frame here. And what I would also suggest, that people are very interested in learning more about this, the FDIC its website has a special section on resolutions, and there's a lot of data in there. And you can go in and you can see first of all, you can see how many bank failures they've had over the last 20 years. You can see how they resolved those cases over the last 20 years. There are very, very few situations that they have handled in this kind of fashion, where they haven't had it all sort of prepackaged before the bank goes down. Lots of things to sort out. I think there's also a lot of history here that gets lost in the translation. I would hazard a guess that Silicon Valley Bank has not necessarily been the most favored bank in the banking system, in part because of some of what we heard here of its investments directly into companies. I think it's been challenging. It's been the subject of some compliance actions in the past for maybe not running the tightest ship. I did a Google search just before I got in here earlier, and they had at least 10 or 11 compliance spots in just the anti-money laundering area that have been open for upwards of 30 days or more. So lots of sort of cleanup situation. It's not easy to hire compliance people in this day and age, but bottom line is there's a lot of moving pieces here, and I think everyone's probably trying to do the best that they can, but I think the silver bullet's not going to be an easy one to get here.
My 12-year-old daughter just came through the door and told me her entire Roblox bank account is gone now. No, I'm just kidding. But they did have, no, I'm just kidding. But they did have quite a lot in SVB. Apparently Roblox did.
150 million, 5% of their money in
crazy.
SVB.
Crazy. We'll see what that does to the virtual Roblox. I mean, my 12-year-old, she's got to have those blown up unicorns that she can put in the middle of her house in the middle of town square. So this is really impactful. It's impactful.
Yeah, we do have Ripple. Just so you know, Ripple Ventures, by the way, is coming. Is just sent us a message here. Maddie Cohen will be coming up on stage shortly. But I just want to give the mic to Lindsay. Who's been waiting for a while. Lindsay.
Hi Mario. Thanks for having me. Yeah, I posted a lot of stuff in the chat about this. I think like the kind of long and the short of it is we've been through this before. We're just going through it again. And I think being in the venture space myself, one of the biggest things that I'm always preaching against is sort of like this overcapitalization of startups too early, because case in point, if we do bail everyone out, and again, this isn't against innovation, this is pro innovation. It does not give them the opportunity to thrive. It doesn't give them the opportunity to beat their way out of that paper bag and to actually make money. And in this type of an industry, that we're in, and this kind of a time frame that we're in, where we have a limited amount of time to capitalize investments, we have a limited amount of time to regain losses. It's really important that the real entrepreneurs that are creating these startups really stand up and actually start making money and start creating that upside. And I think that that's something that, again, when we get lost in the headlines of like this company selling and that company selling, and all of these overblown headlines, because again, investors are extremely headline sensitive, like I think someone was saying earlier, and I see this heavily. I mean, you see it in the crypto market right now because of FTX and subsequent ruggings and companies. And again, that's one of the biggest problems with this bank, is that they accepted a lot of those kinds of companies without doing the due diligence, without there being enough regulation, and knowing full well that those companies didn't have self-regulation, which I think is one of the other big issues here. The other thing is we know how banks are capitalized, right? It's by fees, and it's by people making deposits and having access to interest. If people in this country are not paying their bills, that's a problem, because then they don't even have the money to cover the fees. That's one thing. So we can't think that startups are not in that situation too. But if we just bail them out without any consideration for, are they even a good company that's hardy, that can even make it, we're just perpetuating the same problem. So I think bailout is not the best effort. I think bail-in might be, but I also think that it's kind of like letting the chips fall where they may. And if these people kind of can think about, and I'm saying these people as in entrepreneurs that are early stage startups. And look, I've been one. I've been a founder for 20 years. I haven't had a job since I was 17 years old. I'm 40 now. Made my first million when I was 20. And I could just say to you that one of the most important things on the planet was, for me, was failing and learning from it and being the person that saved my own life. And I think that that's something that we have to push at this point, because we will have the baddest ass entrepreneurs on the planet and the best.
Hey, this is really interesting. If I could kindly ask, how did you make your first million at 20?
I invented a product and I licensed it, and I made an effort to not take capital early. I wanted to prove out the market and make sure that I had a very good item that would sell, and it did, and it sold really well. And then I negotiated for a higher licensing deal, and I
That's
did very
cool.
well.
What type of product was it? Just out of curiosity.
Oh, it was a head massager product.
Cool.
Makes
That's
your
awesome.
whole body tingle. And then I did like 4 of the biggest infomercial hits after that, like ShamWow, Slap Chop, Sticky, Smooth Away. And I just kept
Awesome.
like commercializing items. So, but I mean, I'm just saying you have to have, I think, that startup. I think what we're losing right now in the startup community that I see very rarely, and I do see it. I mean, I have venture capital rooms all the time on Clubhouse and also on Twitter Spaces where we help companies and we fund companies. But I think like one of the things we're missing is that hardiness of entrepreneurship. Like I think people are kind of fat and happy. We're not seeing the guys sitting in the basement eating ramen like we used to. People had their PPP loans and their, they got their little bailouts. And I think that that's not necessarily good for a thriving market. Like you look at anything in nature, when it struggles, it thrives. And again, I'm just speaking from personal experience. The more I've ever struggled, the more I've thrived. The more chaos that's been created, the stronger my business has gotten. But I think that that's the power of being in a time like this. So I posted some things about John Law, who happens to be my great grandfather-in-law. My spouse, it's my spouse's grandfather. But if you know who he is, he's kind of a famous economist who was also a con man, but nonetheless invented the British pound, the term millionaire. Kind of a really interesting guy, but also shaped our modern economy, did the Louisiana Purchase. But what we can learn from him is that money doesn't make anything unless it's being traded. That's the first thing. So money has no value really unless it has to do with what's put into it, right? Like it's how is it perceived? What are you purchasing with it? How fast is that money moving? What countries and what opportunities is it buying? And right now, our country is really devoid, I feel, of outside opportunities. I mean, one thing that I'm really puzzled. One thing I'm
sorry. I just want to go ahead. I'll let you finish it off just before jumping in.
No, it's fine. The last thing I was
Go
going to
ahead,
say is one thing I just wonder about is like, why is no one talking about like even Tencent right now and like the massive amount of, incredible backing that it has worldwide, but in China, but then also why is it backing every single gaming company, Tesla? No one's talking about it because it's like a super app and it was started by 4 guys who had $1,000, so
I think a lot of people cover the Chinese tech space and they're well aware of it. They're just avoiding that entire ecosystem on the public equity side because of Xi's increasing power over the financial system.
Oh, no, before moving into Lizzie, I just want to go back to Silver. So I keep calling it Silvergate, to Silicon Valley Bank, and then I can give you the mic back. But Matt, I want to ask you a few questions. You sent me a very detailed DM a while ago.
Can you
And
guys
I
hear
won't
me?
read it out to the audience. Yeah, we can hear you, man. The mic isn't great. I know you're out, but if you can get it closer or maybe change the headset to speaker or something, it would be great.
Yeah.
So we can hear you, just not perfect. But if you give us a bit of an overview, I know you're covering the
Sure.
situation.
Sorry, I was on the National Venture Capital Association call with the U.S. Senator. Yeah, so I'm Matt Cohen, founder and managing partner of Ripple Ventures. We're an early stage venture capital fund investing in early stage companies in the U.S. and Canada. I'm actually based in Canada, but we have a lot of U.S. company exposure, and we deal a lot with the Silicon Valley Bank. I think the one thing that people need to understand, like I was a trader on Wall Street for 15 years in New York, managing a liability book of business for Royal Bank of Canada during the crisis. So I remember all the bailouts that were happening and TARP and everything. This is not that at all. And we need to be very clear. There's no CDOs, there's no CLOs. There's nothing here on a leveraged balance sheet. It's obviously poor treasury management of a mortgage bond portfolio that they obviously got flipped upside down on. But the precipitous fall of SVB is all because of the venture capital community basically running from their own shadow within a 48-hour period. And there was 42 billion pulled from the bank. And no bank in the world could ever sustain that. Even the Canadian banks, who are well capitalized, would never be able to sustain a drawdown of deposits that bad, because nobody has that many deposits to wire out within a 24-hour period. And so I just want to make sure this is not a bailout. It's that they've had a negative $1 billion shortfall of cash when every night you have to settle with the Federal Reserve. They didn't have that $1 billion. So they failed on the signed letter to the Federal Reserve, and the Federal Reserve had to step in. Goldman Sachs was in negotiations to buy Silicon Valley Bank. That has been confirmed. But obviously, when the FDIC stepped in, they obviously stopped negotiations, and no bank's going to get in the way of an FDIC process. So basically, the U.S. Senator just told us, and that's confirmed in the note I sent to you, Mario, that there will be access to the $250,000 as of Monday morning, as the funds have already been transferred to a FDIC insured bank that's been created for the next 2 years. I forget the name of it, some international bank out of Santa Barbara or something, Santa Clara. And those will be available immediately. The mechanics of how people will get that money is not very clear, whether it's in real life or online, but they did say that that $250,000 will be made available immediately Monday morning. And then over the course of the week, the other deposits will start to be released. The one thing I want to be certain that people understand is the lines of credit that have not been drawn are not what we're talking about. Those are not deposits. I'm talking about cash saving deposits, checking savings accounts that our companies have to make payroll will hopefully be made available over the coming weeks. And we're obviously in conversations with our companies to bridge them to make payroll over the next 30 days.
Matt, just a quick question. How long were those negotiations going on for?
The Goldman Sachs ones?
Yes.
Well, there was an announcement that Goldman Sachs was hired to run a sales process. So you have to assume they were already in the room before that. JP Morgan was also in the room before that as well. But I think what happened was, as they were trying to negotiate on how much deposits they had, they didn't actually know because they were being wired out so quickly. We had a company wire $30 million in one day out of their bank account into the Royal Bank of
So,
Canada.
sir, could you please confirm? So it was confirmed that Goldman had put in an offer, but it wasn't
No. In negotiations to acquire the company. I didn't say put it in.
in negotiations. Thank you.
Yeah, that was confirmed. And then they were hired after they decided not to buy it to get the banking fees, which is funny. But the rumor that JP Morgan, that had been going on for 6 months that they were looking at buying it. There was also other rumors that Canadian banks were looking at buying the assets, but I think the precipitous fall over the last 48 hours has basically caused the equity to be worthless. There is no value in the equity of Silicon Valley Bank. We all know that, and that's why the shorts were pounding the thing over the last 48 hours. And I don't even know how shorts will cover their shares. We saw this.
Sorry, Matt, just a quick question. So did them negotiations end a bit in the last 48 hours or before that?
Yes.
Okay.
In the last 4, and so the shorts continue to push pressure on the equity, which is worthless. The deposits were being pulled. And I saw many emails coming across from many venture capital funds. We even saw Peter Thiel, Founders Fund, and Coatue, Sequoia. A bunch of the big names have been rumored to be telling their portfolio companies to be pulling their capital and drawing as much as they can. Some companies were even drawing on their lines if their savings accounts were not able to be transferred, so that they were actually trying to hedge themselves by pulling on a line, transferring it out to another bank, and then waiting for their cash deposits to be freed up. Some got out, some did not. So there's been a whole host of things that people have been trying to do to navigate this.
Do you know if there are any other banks outside of Goldman that were in negotiations?
Well, like I said, I think JP Morgan had been talking with them for the last 6 months or more, but they came out, I guess, today and said they're not interested because there's too much risk to take on this asset now with the FDIC involved and the Federal Reserve, and also with the OCC involved as well.
If the FDIC were to guarantee deposits, that would probably make it easier for one of these banks to acquire them, right?
There's nothing to acquire, I guess, because the goodwill's already gone. All of our companies are already setting up bank accounts with Pacific West, First Republic, Royal Bank of Canada, CIBC, TD, all the other banks. So I don't know what you would be buying if there's no customer faith in the deposits anymore. You're basically buying. I guess there's a bunch of other different parts of the business that you could say there's value in, but I don't think it would be worth going through the process of acquiring the assets, because you have to come in to acquire the assets. You have to acquire the whole thing and backstop all the deposits and everything else out there. And I just don't know anyone wants to take that on.
Right, but the moment you hear that Goldman is coming into, I'm not saying it's Goldman, but any bank comes in with a large balance sheet, aren't you just going to stop taking out your deposits? 'Cause it's not just about the deposits,
exactly.
right? It's about the loan, right?
Yeah, I thought the most logical thing that would have happened was all the big venture capital funds and tech private equity funds, Thoma Bravo, Vista, all these guys would have stepped in with $250 million each to backstop the drawdown. But when they saw it was creeping into the tens of billions, I think that's when everyone started to get really scared. I mean, think about it. Like Andreessen put a $250 million check into Twitter, for God's sake. Like you're talking about a couple $1 billion convertible note that they tried to raise. I think it was 2.25 billion at 12%.
And it failed.
It failed
It was $1.25 billion of equity, $500 million convertible preferred, and $500 million private placement with General Atlantic. So the total was 2.3.
That never got done because obviously first lien debt holders were not going to pass up on that. They were not going to let them step in front of them. So that made sense why a convertible preferred wouldn't have gotten done, even though General Atlantic put a staking bid in at 500. I'm shocked that all the other large private equity firms and venture capital firms didn't step in to rescue this thing, given how much is tied to it. You're talking like mortgages, family office accounts, wealth management accounts, like everything in California is tied to this.
Matt, is there another shoe to drop here? Is there another entity you think is next, or what do you think the cascade will be?
I mean, I've heard from friends of mine in other banks that they've never seen more deposits and accounts created in the last 48 hours than they have in the last couple of years. So to say like there's other people that have a similar mortgage and asset problem, I don't know. Like I haven't looked at all the statements of like Pacific West Bank. They're a pretty big bank. Comerica is a pretty big bank for startups and tech companies, but no one is as big as Silicon Valley. So I don't know. I mean, you look at the trading in Pacific West. I mean, the market cap is $2 billion. It's like nothing. No one's ascribing a lot of equity value to these companies.
Question for you. Go ahead, Jay.
Sorry, I'll be really quick. Question is, how long do you think it could take? Because the stock is now frozen, and people are asking me, well, XYZ, I'd sold calls or I'd bought puts.
Yeah, it's done. It's never going to trade again.
It's never going to trade again. So all they're going to get is if they were short or long, what the price was yesterday.
Yeah. So this happened. This happened in a Chinese stock called Sinoforest that was traded on the TSX and the NYSE when I was on the trading desk. And I remember all the shorts couldn't cover, and it took a long time to figure out how to settle all those trades. I don't know how they figured it out. I was going to go back tonight and look into it, but that was the last time I remember that shorts couldn't cover a stock that stopped trading indefinitely.
I remember when I was shorting the Russian stock market, and I had made a huge profit on it last year, and I didn't get any of it. It just froze.
That's usually what happens. Like the OCC steps in, and a lot of the like clearing authorities step in, and it doesn't work out well for a lot of people who think they're up a lot of money.
Yeah, that's not going to happen in this situation. The stock's halted by the exchanges until the company makes an announcement and provides
Right.
further detail, because the stock's been down so much. But they will end up filing bankruptcy, and it will be listed again on
Right.
the
It'll
Bolsa
be listed
website.
as a
So
pink sheet, but let's
it'll
say
be a pink sheet.
you have puts. Let's say you have puts that expire today, and those pink sheets aren't listed for 2 weeks from now, right?
Yeah,
In
we
that
might be
scenario,
SOL.
I think you're shit out of luck, right?
For
Yeah.
sure.
Yeah,
Unless
so
they're
just
in the
Matt,
money.
for anyone requesting to speak, just a reminder, there's a glitch. I cannot see any requests, or most requests I cannot see. So make sure you DM me for the team to see it. Matt, I've got a quick question for you, just about Gary Tan's comments. I know there's reasons why he's
Of course.
sounding the alarm, but still want to get your thoughts on terms like these depositors. Now, what was it that this is an extinction level event for startups? I think it was one of his statements.
Yeah.
So would love your thoughts on the narrative there.
Yeah.
So,
Look,
and then I'll read it now. Does it make sense for a generation of startups to die because of what because of the bank they choose?
no, it doesn't make sense, and it's not the right thing because
No, no,
these are
but no. I mean,
no.
not about the question. Just more the statement. It's a generation of startups
Is
to
he
die
right?
or extinction level event. Is that just too extreme?
I think it's extreme in the sense that they're like all of our startups are questioning payroll, but they're not questioning are they going to continue to still build. Like all of our companies are still in build mode, but a lot of them are talking about layoffs and furloughs on Monday. A lot of them are saying founders are going to stop taking salaries for the next 2 months until they figure this out. They have flexibility, right? Our early stage companies are like speedboats, so they can speed up and slow down as they want. I'd say it's the biggest companies that have a ton of money. You saw Roku's announcement. Those ones are really screwed. Rippling put out their announcement on how they can't even make payroll for all the companies they manage. It is a catastrophic event that will have cascading ripples throughout the ecosystem for years to come. But the founders themselves, they are resilient and they will continue to build the products and technologies that they are trying to build. It just will have a huge speed bump in the way, and it will take a while for them to get back to the level of productivity and building that they have. I mean, when you have a team of 40 engineers building and all of a sudden they're told they're not being paid, like they're not going to continue to work on those problems. And yes, you're going to slow down a lot of the momentum a lot of companies have been building over the last couple of years. He's right about that. Now, YC companies, I mean, he's a little bit kind of like YC companies are always, overly funded for the teams they have sometimes. And usually like the earliest ones they're only like 6 to 10 people. But yeah, YC companies, we have a bunch of YC companies that are at Series B stages right now, 150 employees. Like if they didn't get their money out, they would have been screwed for sure. So what's happening now is obviously you guys have been talking about this. Brex is stepping in with loans. We've had a lot of bank relationships being called on to step in with just payroll lines of credit, 10 million, 20 million lines of credit. I mean, these are $200 million recurring revenue businesses that spend 10 to 20 million a month on payroll that won't be able to make it because it was all tied up at SVB. That's a shame.
Just not to interrupt, but the S&P 500 now says, after stating that they'll remove SIVB on Monday, they say they expect SIVB to go bankrupt.
Right.
Exactly.
Yeah, it's a big thing when an S&P 500 company goes bankrupt like this. The ripples are huge.
It'll be delisted.
All right,
They'll
I have
add
to
a
go
Q
back
on
on
it.
another
It'll go on.
legal call, but I'll speak to you guys later. Thank you.
Thanks, Matt. Go ahead. What were we saying now? What were we saying, Nick?
Yeah, it'll once the company makes an announcement, it's just halted on the exchange until the company announces what's going on, because we're hearing things from the FDIC, right? We're not hearing an official announcement from the bank. So the bank has to put out a press release. They're going to file bankruptcy, and then it'll be delisted and trade on the pink sheets within a week. So one other comment, if I can, Mario, on these.
Yeah, go ahead.
Yeah. So the talk of, say, Goldman or JP Morgan potentially at Silicon Valley Bank maybe interested in buying them. I mean, maybe that's true, but this is a typical tactic of some of these large banks, and we saw it through the financial crisis, is they'll go into these companies and say, yeah, we might be interested in buying you. I mean, we saw Binance with FTX, right? Same thing. What they're really doing is they want to get inside the bank, look at their books, and see what exposure they may have. But there was no intentions to buy the bank. And there's not going to be, in my opinion, a deal to. No one's going to buy this bank over this weekend. These top four, J.P. Morgan or B of A. It's not going to happen because compared to the financial crisis, Silicon Valley Bank going down, how is that going to affect JP Morgan, right? Like in this subprime crisis, it was different because Bear Stearns going down affected and the markdown of those assets and the additional selling pressure of the subprime debt would have affected the balance sheets of the larger banks. That's why JP Morgan and Bear Stearns got together and some of those deals happened. That is not what's happening now with Silicon Valley Bank. There's no exposure like a subprime type situation on their balance sheet that's going to affect these top banks. That's why these calls from these venture capitals guys like David Sachs and whatnot, I get where they're coming from because they want to protect their investment, right? But there's not going to be a bank sort of bailout. It's just like from Goldman's point of view or JP Morgan, they're going to be in the market to buy the assets through receivership on the cheap. They're not incentivized to go buy Silicon Valley Bank. They'll buy the assets when they're on a fire sale or through the receivership process.
Thanks for that. Lucas, what are your thoughts?
Yeah, so thanks for having me, first off. I think extinction level event is ridiculous. 9 out of the 10 companies that spool out of Y Combinator fail. So you invest in 100, 9 will make it, and 91 won't. So again, that's kind of ridiculous. And I want to go back to what Lindsay said. She actually had an amazing point where this is basically the time to actually become profitable. Pivot to profit. Find a way to scale down, possibly, scale down people, scale down operations, whatever the case may be, and find a path to profitability quickly. And that's what these startups are supposed to be doing in the first place. If they're not profitable, they're a non-profit. And I get it. I get burn rates. I get it all. But at the same time, like this happens again, for 10 companies, 9 are going to fail anyway out of YC. And that's out of YC. Don't get me wrong. YC has an amazing track record. $600 billion worth of startups have spooled out of Y Combinator. So they have a really good success rate. But at the end of the day, this is not the end of the world. The problem I see with this is the ripple effect and everybody's made the point up here already, probably 10 times, the ripple effect for sure of a bank like this, failing is going to be, people are going to start panicking and the trust is broken and people are going to start pulling their funds. That's the danger. That's the biggest danger that we have here. Again, Gary, and I don't know Gary, I'm sure he's a nice guy, but he's worried about his lending partners. He's worried about saving face and making sure that his Y Combinator has that spotless track record and also making sure he's covered too. He might have been a little bit over leveraged in the bank. And I know his lending partners clearly were, and they must have some kind of a partnership with that bank where they make sure they keep it in the family kind of a thing. If you basically invest with them, you actually have to keep your money in, Silicon Valley Bank. So, it's pretty obvious what's going on here. So again, they're just trying to save their lending partners all their money so that those lending partners will keep coming back to Y Combinator. It's not the end of an era for a startup. It's the beginning if they want to be path to profitability, get scrappy and figure out a way to get profitable quickly. And if they weren't going to be profitable, and if they have a burn rate and if they have maybe 8 or 9 months of runway, if they can't find it quicker than that with a smaller, scrappier team, then they weren't going to make it anyway. So I'm not trying to be horrid or bloodletting here, but it's just the truth. I've built companies before myself, and I try to not take money and make sure that they're profitable, make sure there's traction, make sure all that stuff happens. And if I could do it, anybody could do it.
Well, ironically, in the Bay Area, there is doom and gloom in the weather as well. There's 70 to 100 inches of snow in some of the mountain ranges. On the lower levels, they're flooding in Tahoe on the west that I heard there. And then, of course, in the Bay Area, they're seeing unprecedented rain. So it's going to be a very, very gloomy weekend altogether for a lot of investors in Silicon Valley. We'll see how it pairs out. But I wanted to get the feel for it. Is anyone there in the Bay Area? I wanted to see what you're hearing on the ground there. I've heard from a few family and friends. I grew up there, and my dad tells me there is definitely a pall over the area right now with this this sort of feeling of dread from the SVB failure. What else are you hearing on the ground? Because I love ground speak. I love people who are kind of connected there. Anyone has some insights?
Yeah, there's Mars dropped out. He was giving us an overview that he was saying, not sure if you were there, Justin, but he's saying he's talking to other startups, and there's a lot of fear, there's a lot of confusion on what they could, what's expected on Monday. So I'll try to bring him back up, just give us an update. But yeah, man, it doesn't, excluding the weather, it just doesn't look too good there. I do want to go to King. King, I saw your DMs that you sent me. Would love you to share what you sent me with the audience.
Yeah, man. What's going on, everyone? My name is King Wabi, and I'm a general partner and head of VC partnerships over at the Calabria Group, and our media company, reports on all things digital assets. So when it pertains to the event over at Silvergate, basically what occurred is after FTX, they had a majority of their customer deposits withdrawn, and a large source of their revenue engine, which is called SEN, and it basically bridged fiat and crypto rails. It started becoming abandoned by many of its clients, and even though they had some.
You're dropping out, King. King, your connection. You're back now. Your connection was playing out. Yeah, man, it's bad connection. I'm just gonna bring you down and bring you back up. What's up, Mad Scientist?
Oh, King's back. Go ahead.
No, he's not. He's not back, man. He's off the stage.
Oh, okay.
This is a bit of a glitch.
Of course. I actually just got off a meeting with some other startup founders. We're all raising, and this is honestly, like, it's a little scary, right? Because it's also, right, all these groups that are raising or are building during this time, right? It's a bunch of VC money that's now locked up, gone, whatever. And yeah, they're going to get their 250K or whatever it's insured for with the FDIC. But ultimately, right, it's really slowing things down. But the other piece is everything else that SVB was integrated into. They had a huge biotech and agriculture fund out in California that they invested in up there, right? So I mean, this thing goes beyond, just our startup world and our tech world, and that's a little scary.
Shit, muted. Sorry, what do you mean? Hold on. Can you?
What's up? You're breaking up, brother.
My mic was playing up. Scientist, you were saying something about. Sorry, not saying something. You said it's going to go beyond our startup world and tech world. I was just glitching in and out. So can you elaborate on that point?
Yeah, like SVB, like, while they're known for their VC and their tech piece, they had a substantial amount in some of the, for lack of a better term, agricultural startups. I don't know what you want to call them, agricultural stuff that happens out in California. For everyone that thinks it's very limited to just founders and just the tech world, like, this has potential larger ripple effects well outside of this.
So, and can you elaborate more on what ripple effects you expect there?
Well,
so is it just startups not having the capital to keep operating?
So like, as a founder that's raising, this was the meeting that we just had, was kind of this conversation of, obviously there's a bunch of funds that are now locked up in there, right, from these VCs, right? So I obviously reached out to all of mine just to see what their exposure was, said hi, make sure they're doing all right. But you have all these guys that are raising that have been building for a while and that are like culminating into this moment of getting raised. And now all those funds are locked up. And then what's going to happen with their companies, with their products? They're, struggling startups classically. And they're everything, right? Like, how much is this going to delay them? Do they have runway to continue to go while they're in this process and trying to weather this storm? And then you have all of the investments in all the everything that SBC was into outside of just tech and startup, right? There's a whole agricultural piece, like I want to say it was like $900 million or something in the agricultural side that they were invested in, and lines of credit and everything else. So that's farmers, that's land, that's food, and biotech as well. So it's not just limited to, this small area. Those ripples continue rolling.
Distinction here, though, with their exposure to things like agriculture and these other sectors, the distinction there is that like these biotech and small tech growth companies are more dependent on these cash facilities or credit facilities to be functional purely in order to operate. A lot of those agricultural companies will find alternative, arguably equal banking partners. And the real concern is for these speculative companies that are not generating any free cash flow, that are generating very little, if any, EBITDA, if not are actually burning cash and every quarter. So those companies quite literally have a risk at not being able to operate. I think the biggest immediate fallout, especially for traders like me, when I look at these scenarios, and I'm not discounting the moral consequence, but I'm looking for where there are profitable trades to be made. And I discussed this at length on Jay's Space yesterday, but I spent most of the night last night just combing through filings, looking for small cap companies that have exposure. Almost every name that I put on my watch list last night was down today between 8 to 20 to 30%. That fallout will likely continue regardless of the resolution here, because it's going to take, even if this receivership process is accelerated, and that's what everyone is clamoring for. That's what Gary Tan was clamoring for earlier as well, is the acceleration of this receivership process to kind of calm these woes and to corral sentiment. Even if that is accelerated and it's done within, let's say, a couple of weeks, there's immediate, market perceived risk to these companies in the ability to operate. So anything with less than $1 billion market cap that was exposed here, the steps are to see how much cash is frozen, to see what the level of their uninsured exposure was, and to also see how dependent they were on a case-by-case basis on the credit facilities that were provided by SIVB. I mean, some of these guys have been operating the entirety of their business with SIVB credit facilities for 5, 6, 7+ years straight. So for those companies, this isn't as simple as just saying, all right, let's go find a new lending partner. It's finding a new lending partner that's offering the same rates, finding a new lending partner that's offering the same borrowing requirements. All of these things add nuance to the issue that's not going to make this a simple swap process where these guys are going to step out and just throw their money over in the other thing. I mean, these are businesses, as anyone knows that's operated a business or owned a business before. I mean, you have expenses that have to be paid regularly, and that's the risk, I think, is the immediate short-term operational risk to the companies that were involved here. I think the banking contagion effect is probably going to carry in sentiment, but will be less material than the actual the small companies that are involved here.
Hey, Ruben, I know you're on the ground there a little bit in Silicon Valley. I always like using proxy data to help understand what's happening. During the pandemic, we looked at reviews on Amazon where people buying candles said they couldn't smell them and returned them. And this seemed to correspond to actual COVID spikes in infections there. I wanted to run a couple things by you. So tell me, we could throw out a couple things like giant season ticket holder passes. We're starting up with spring break. How will those be impacted? Russian hotties at the Rosewood, how will they be impacted? Memberships at Martis Camp or at the Battery. I just want to know, kind of ancillary, are people really clamping down on these extracurricular activities, or what do you think?
I think that the immediate shocks that we'll see will happen inside of 30 days. A good chunk of the remainder will happen in 30 days after that. The reason that being is that payroll is probably the first court of order. If a company fails to make payroll, not only is that company sent into receivership, but it pierces the corporate veil, which makes the shareholders accountable, at least for those receivables, for those employees at that time, which means that for the companies that have 250K FDIC funds that they can draw upon, either directly or through credit with a third party, if they can't make payroll, if you can make payroll for half of your staff, that means you have to kill half of their staff. I'm not saying it's going to happen, but I'm saying that it has to happen relatively quickly if it does. And so, I see numbers like 30% of Y Combinator's, portfolio bank with these guys. I don't know what that looks like in terms of volume, but my guess is that it has to be hundreds of companies, of which I would say comfortably dozens of them fall into that category of hand to mouth, may not be able to take a sharp shock like this. And so it makes me nervous for doing hard, big things in general, because I think that flows on to seed and A round capital raises, right? In spirit, in fact, but in fact, because a lot of these founders had personal mortgages with this bank that were backed by the startup shares, which is an insane idea if you ask me, but it's a thing. And so the side effect of that is if you see a market shock in the real estate market, where do you think all those LPs for those venture firms are? And where do you think they get their money from? Probably a good chunk of it's in real estate, right? And so if you see a cascade over into real estate, that hits the LPs, which means it doesn't just hit the people with Silicon Valley Bank, but it hits everybody investing in early stage, including seed and Series A. And that makes me nervous.
Hey, speaking of early stage, I had an earlier question. Obviously, I'm sure you've seen probably a dozen pitch decks on Chat GPT and AI related startups or ideas. How do you think that's going to impact? I mean, they're coming out next week with GPT-4, multimodal, some really promising, very quick stuff. Lots of people, creating garage startups here. What do you think that impact will have? Were a lot of people banking on that sort of being a next big wave they could catch on?
Potentially. I think that there's more of an implementation gap than there is an innovation gap. But you know who would be really good at answering that question? Lucas Bean, who's on the stage.
Yeah, I cannot answer that question, but thanks for the shout out, Ruben. I still think this is such an interesting play right now that we're talking about like startups that are 91% of them are going to fail in like 8 to 9 months anyway. It's definitely not a catastrophic event in that space, but I do agree with Ruben what he said about people are taking loans to get property and things like that, and what happens to that? Do they get liquidated now too? Like I didn't even think through that, but I've definitely heard of founders actually taking funds like getting funds from their their funding rounds and stuff like that against their funding rounds. So yeah, I'm not really sure how that works, but again, this is the time for them to become profitable, guys. Like this is literally time that some people are going to lose their jobs, and the companies are going to be tested to pivot to success.
I'm down here in San Diego, and Illumina dominates a lot of the biotech space down here. A lot of companies gravitate around these big wigs. I see major buildings going up for biosciences. I think they're going to do okay. But if you had to peg it, which industries do you think will weather this the best, and which ones are you most worried about? Ruben, what do you think? What industries do you think you're sorry, or Ruben or Luke? So just want to know, like, which startup industries are you most worried about versus ones that you think will be able to sail through some of these high winds?
Anything SaaS companies will make it through because you can actually there's a path to profitability like very quickly with software as a service. So that those guys are going to be okay. Pure internet plays for sure. But people who are literally blue skying innovation right now are not going to make it. The next giant, like great idea that comes out of nowhere that we don't even see coming, that needs like, eventually $100 million, $200 million before you actually see any kind of profit, like a Facebook, like they're not going to make it. The next big idea, like, we're talking, like I said, that needs crazy amount of burn to make happen. We're not going to see that. that might get eliminated, but it might be a good there might be a good reason it gets eliminated. Maybe the burn's too high. Maybe the idea is
Guys,
too
Matt,
blue.
guys, just trying to get your thoughts on this. Matt Gates just tweeted, "I will not support a taxpayer bailout of Silicon Valley Bank." So
Well,
it
that's
just came
just
out of Matt
responsible.
Gates. But
Yeah,
Is that a
not
shock
gonna
to you,
happen.
really?
Eric Swalwell tweeted earlier that he's calling on every dollar over $250,000 being insured, or basically all the depositors
Unsecured, yeah.
made whole. That's just not going to happen. I mean, are we trying to battle inflation here, or we're just going to like print a bunch of money to bail out everyone? It's just not going to happen.
Yeah, the crazy part about this to me is that like a good chunk of the reason that this happened was they took out, I don't know how much of that 150 billion was mortgage-backed securities, but I think a good chunk of it, right? And that is not a Silicon Valley.
Yep, 91 billion.
91. Okay. So 91 billion. Great. So the crazy part about this is that it's not even like Silicon Valley stuff that's doing it. It's their exposure to boring assets, historically boring assets, that took them under because they made a 10-year bet in an environment where things are kind of weird right now, right? Like it's hard to tell. Flight to safety is relative, right? And so there's so much uncertainty in how things are swinging in general. I can see how if they got a bunch of depositors, like so many depositors that they couldn't rely on their return, that, oh, I guess we're going to diversify to some different asset class. It's just that the asset class that they chose to put that into happened to be screwed by macro conditions, right? They got
The problem too is they didn't diversify, and that's where
right.
Special situations was talking
sorry
about.
sorry to interrupt. There's just a breaking headline on this Silicon story, so I just wanted to. The Bank of England is now seeking to place Silicon Valley Bank's UK branch into a mandated insolvency. Earlier this morning, Silicon Valley's UK branch put out a statement and said that they were a separate entity and that they wouldn't be affected by this crisis in any way. So now apparently the Bank of England is saying that they are seeking to place them into a forced insolvency. Jay, do you know what that means? I don't even know how that.
Yeah, they're forcing them into bankruptcy.
Yeah,
I read the piece
They're
that came
basically
out.
they're just sending the regulators there into the company, and they're just going to take them over and manage it.
So it's actually not, to be very clear, it's not like a traditional Chapter 11. What they're actually doing is it's like receivership in the U.S. to be.
Yeah.
So what they're saying is that the bank insolvency procedure would mean that.
Sorry, Jay, you cut out there.
Sorry. So the Bank of England, is basically doing the same thing that the U.S. is doing in terms of receivership. It's not like a Chapter 11 bankruptcy or Chapter 7. What they're doing is they're putting the subsidiary bank in England in receivership, and the bank insolvency procedure is going to mean that eligible depositors are paid out by the FSCS as quickly as possible, up to the UK limit of £85,000 or up to £170,000 for joint accounts. And that was directly from the Bank of England. So, correction, what this means is that they're putting the subsidiary SVB UK into receivership. That's what it means. It's not like
that was my
bankruptcy.
question. I didn't know if it was a legitimate bankruptcy process or if it was, like you said, receivership. So
it is receivership. That's correct.
Okay, perfect. Okay, so it's similar to the receivership that the FDIC would conduct in the United States, or a different sort.
Very similar.
Okay, cool, perfect. I just wanted to clarify that. But
go ahead. I just got a few questions from the audience, and some of them are pretty basic questions. Some of them are a bit more complex. Before going through them, I want to give the mic to the scientist. And then, so I'll give the mic to the mad scientist to jump in. And then Stock Talk, I want to go to you, just give a quick overview, recap for the audience of what we've seen, what developments we've seen over the last, let's say, 6 hours. I know you've been covering this since yesterday. And then I want to go to the questions from the audience to the bottom right corner. So anyone that has a question, put it in the bottom right corner, that purple little circle, and we'll be going through them now. But go ahead, scientist.
I was actually just going to ask everyone up here, and I don't know the answer to this because I've never seen it. Right. So the funds are FDIC insured that are in this thing. Right. I know the standard is 250K. There's some that do 1 million. If they had more than that in there, what happens? And then also, Watcher Guru just posted 50% of VC funds have exposure to SVB, by the way.
Yeah, we've talked
Yeah.
about this. We've talked
Yes, we
about
did
this
talk about
earlier,
it. So
which
basically, what
these
happens is
these are insane numbers though. Just kind of, it's a reminder. 50% is crazy.
so what ends up happening is you essentially have a waterfall. So on day one, you can pull out 250K, right, for every individual, LLC, partnership, etc. On day two, you're going to get essentially a receipt that says you are owed XYZ of uninsured deposits, which are about 150 billion. Now, on those deposits, you'll receive a front, like you'll receive an initial, they call it a dividend from the FDIC, and that's going to cover your initial costs. And then over time, as they sell assets, for example, as they sell this MBS, as they work through the loans, cash will be sent, pro rata to all of the uninsured depositors until, there are no assets left, right? So my calculations are that the uninsured depositors, might recover like as high as 50, 60%. But in prior FDIC bankruptcies, if you look back for the last 30 years, the average recovery for uninsured depositors has been closer to like 20%. But this is a slightly different case because it's a lot of MBS securities that are super liquid.
Special report. I have a question, if you don't mind me asking. Special situation. Sorry. Yeah. How often do people actually spread out their funds so that they're all FDIC, basically protected under 250,000 like accounts, right? Like, no, I don't.
I mean, I've been doing it since I was very young. I mean, my
Same
parents
here.
were aware of it,
Yeah.
and and I think a lot of people's parents that were around during the savings and loans crisis in the late 80s, and when Michael Milken blew up the junk bond business and all these savings and loan institutions went bankrupt. We had 17,000 banks at that time. Today we have 4,950. I think a lot of those parents are aware of it, but I think a lot of younger millennials, may not do that. And I got several DMs today of people that are kind of freaking out that have not done that are trying to figure out where to put their capital.
Yeah, it seems like if you actually have multiple accounts that you would have been safe here, your money would be covered. So it just seems like such an easy thing to do.
No, it's not. I think it's dependent. I think you can have. There's a limit on the number of accounts you can have per institution. So if you had like a bunch of accounts at a bunch of regional banks, right? You had one at Comerica, you had one here, and you had $1 million split across 4 banks: First Republic, Comerica, SIVB, and the fourth. You would be absolutely fine. But I do think that there's a limit per entity. So let's say you had a personal account, and you had an LLC account, and then you had a partnership account with someone else. Like maybe you could have 750,000, right? But I think if you just had a bunch of personal accounts, you'd still be in trouble.
Interesting. So theoretically, if you opened up a bunch of LLCs and spread it around, actually, the amount of money it would take to maintain those is actually minimal for the protection it offers, though, right?
Yeah, but you could basically do it for free just by putting 250K at different banks.
Right. Okay. Yep. Yeah. See, that sounds like an easy thing to me. It just seems like it's a lot more work for people, and they just didn't want to do that.
Yeah, I mean, but think about it. For that, like probably 30 minutes of work, you save 250 grand, right?
Oh yeah, heck yeah, absolutely. You could, theoretically speaking, $5 million, right? It's not that hard to spread around to that many bank accounts.
I know basketball players. I know NBA basketball players that have like 40 bank accounts, and they're like their agents will counsel them on that.
Guys, just want to jump in quickly. So Elon just tweeted a little troll there. I'm just gonna pin it above, so check it out. It's just 2 buttons, 2 emergency buttons, and someone's just sweating. One of them says, "Crypto is a scam. Keep money in banks." And the other button says, "Banks are scams. Keep money in crypto." I know Elon's taking a break from Spaces. I've just sent him a message, see if he wants to join and talk about this. But it's a good tweet. Just came out 2 minutes ago. I'm just gonna pin it above. But in the meantime, Stock Talk. Do you want to just give a quick overview of the latest developments for the audience? Anyone that was late in joining? Jesus Christ, 2 minutes already. How much engagement he gets? 1,200 comments, 1,600 retweets, and 9,000 likes in 2-3 minutes. That's crazy. But yeah, Stock Talk, do you want to give a quick overview for the audience, the developments we've seen in the last few hours, and then what we could expect, based on all the panelists we've had so far, what would you say are the best case and worst case scenarios that you've heard from the speakers so far that people could expect?
Yeah, so just for the summary part that you were talking about, I mean, to basically break it down, this is, one of the top 20 banks in the United States. It is a significantly sized bank, but it's a niche focused bank focused on tech startups and VC, specifically in the tech industry. One of the points you brought up initially, which we talked about today, was the fact that 97% of the deposits at this bank are over the $250,000 FDIC. So that's $150 billion worth of deposits that do not qualify for the FDIC insurance that's provided. And so that was the first point to kind of give you the magnitude of the fact that it is a significant event. But, more importantly than that, we talked about the fact that that is what exposed this bank to the risk of a bank run more linearly than it would have happened at a bank like JP Morgan or Bank of America that has so much exposure to, retail banking clients, regular people, right? This company had outsized and very specific exposure to VC firms like the Founders Fund and I'm blanking now on the name of the other one. Somebody fill me in on this.
Thiel.
Peter Thiel's backed one is the Founders Fund. Jay, what's the name of the other one? Y Combinator.
Y Combinator, Canaan,
Oh, like a whole bunch of
Tribal,
companies.
Activent.
I was mainly talking about, sorry, I was just blanking on the name. But yeah, Y Combinator and Founders Fund. They spurred this panic of telling companies that they were invested in to pull their money out of this bank. And we talked about how silly that decision was because it spurred a mass run on the bank. I'll pin the tweet again for people that might have missed it. But essentially what happened was there was $42 billion of withdrawal requests in a single banking session. And so by the close, the bank had a negative $950 million balance. And that's what happened here. But the reason that $42 billion bank run happened was because of this notion that was put out by VC funds that the bank was not well capitalized and they were advising companies that they were partners with to take their money out. Now, why was the risk even more concentrated? So I've given you 2 layers of concentration already. The third layer of the concentration of the risk in this situation was the fact that these VC funds encouraged the companies that they invest in to bank with the same banks, right? So like in SIVB's case, the reason that you're hearing these numbers, 40% of the VC industry exposed, 50% of the VC industry exposed, the reason you're hearing that is because funds like Y Combinator and Founders Fund, the companies they're investing in, they go to them and they're like, hey, just move your money to SIVB because we have these credit facility agreements, we have whatever, et cetera, because we have 150 companies that we're invested in that are all banking there, right? So they have relationships with these banks, which further concentrates the risk. And that's why, Jay's made this point earlier, I made this point earlier as well. I think a lot of people have made this point that yes, it's a big bank. Yes, it is a real risk and it will have follow through and there will be other companies, in my view, especially small companies that are affected. There will also be beneficiaries from a market share perspective. But
one thing we didn't talk about yet, is that the one of the audience members just brought up a good point for everyone here. It's not just the loans, it's not just the deposits. The VC firms, when they raise a round, they're putting it at Silicon Valley Bank as well. So there are a lot of VC firms that are just going to be shit out of luck.
But yeah, the point is that because of their specificity to catering to these VC tech firms and these growth companies, if a bunch of companies, if 600 companies, hit up the bank to withdraw hundreds of millions of dollars each, that's different than a bunch of retail clients going and asking for a few $1,000s. That is another reason why the risk was more magnified here, because the clientele is very, very different. If you look at the tweet that I pinned about the 97% withdrawals, I shared a table. I'll pin that tweet again. But I shared a table, and I know the font is small, but zoom in. And if you zoom in on the bottom right of this table. If you can't see the pin tweet yet, it should show up in a little bit. There's just a lot of people in the space. But if you look at the table and you look at the bottom right, look at the percentage of deposits that are over the 250K limit for this bank specifically. I mean, they're at the bottom of the list, right? So that shows you that their deposits were concentrated, right? So when people went to withdraw, they weren't withdrawing a few $1,000s. These companies were withdrawing millions, tens of millions, maybe hundreds of millions, and in some cases billions of dollars, right? And so that's how you got 42 billion of withdrawal requests in one day. In one day. And for a bank of this size, I mean, that's just not. You can't service that. And that's what happens.
Just to add
right?
some
It's not
perspective here, having been like, obviously.
Sorry if you guys can hear background noise while you're talking, because the space has so many people that it's glitching. So my mic is literally not mutable.
No, your mic is good. Your mic is good. Go ahead, Blau.
Yeah, so just to add some perspective.
Oh, you can't. Hold on. You can't mute Stock Talk. Yeah, if your audio if there's background noise, I'll just remove you and put you back up. But it seems to be silent on your end. Sorry, jump in, Blau.
Oh, nice. Can you hear me? Okay, Mario.
Yeah.
Okay, cool. Just to add some color here, and I got to get back to another meeting, but someone told me to come to the room to check out what was going on. Tuesday, when the initial news broke about obviously long-term debt getting hit by rates going up, SVB having liquidity issues, having to sell that debt at a huge discount. Once we saw that, we were monitoring the situation. We had like 25% of our treasury, or actually even less than that, at SVB. But what happened was a lot of my, A-tier crypto investment firms, whether that's Paradigm, A16Z, everybody sort of started raising the flag Tuesday, Wednesday. And, a lot of people did have enough time to move. We did have enough time to make a move, which we got our small amount relative to our total treasury out. But what really happened in the cascading event that followed was, the reason why this happens in the billions is when one person smells contagion, everybody wants to be first to jump out. And, we saw the same thing in 2008, and we're seeing it now manifesting in a completely different way. Obviously, I'm lucky. Obviously, our company is fine. Royal's fine. But just for everybody listening, my heart goes out to anybody who was affected by this. I mean, this is, I think, correct me if I'm wrong on the statistic, but I believe 50% of US-based startups actually bank with SVB, which is an insanely large and high number. It's something like that. Don't quote me on it, but I'm pretty sure I heard that somewhere. And so a lot of founders who've spent, many, many years building things are in a really terrible position. Their employees are in a terrible position. And this is the nature of a poorly run financial system, where we've been printing money for years. QE combined with low interest rates, and the consequence of reversing that really quickly is just destructive. And we've barely felt the consequences of that yet. So yeah, that's my 2 cents. Glad that we're okay. If you're in the room and you're listening and you're not okay, my heart goes out to you. And this is a tough situation.
Yeah, I just wanted to jump in, if you don't mind, guys, just real quick. I got a text from a tech founder that's here in New York with me, but he was out in California for a number of years. And I asked him if he had a large account there. He just wrote me back, "No worries. We totally had money there, but it's sorted out on our end. Parentheses, we think, close parentheses. We should catch up soon." And so that's how we had left off. So, but I'm sure, because I talked to other people, and there's a lot of other people that have been tremendously negatively impacted. So.
I do want to go to the point that the chief of Silicon Valley Bank sold $3.6 million of stock days before the bank's failure. I know we talked about it earlier, but we didn't dig into it. And the press is starting to cover it. Stock Talk, how I don't understand the legality of this. That's insider trading, no? Again, I'm outside my area of
I can
expertise.
contribute to that if it's useful. I just want to take a start.
Yeah, please do. Yeah, man, go ahead.
TLDR, the mechanism that was used to extract those funds is an unusual mechanism that.
Your mic, just Ruben, we can hear what you're saying, but there's a bit of background noise. Not sure if you can change mic or get it closer to your mouth.
Testing?
Yeah, go ahead. Give it a shot.
Right. TLDR, if the The mechanism of withdrawal is consistent with previous behavior. That is, you can have a withdrawal event by a C-level or major shareholder prior to this kind of event, but it has to be consistent with previous behavior. What's more interesting to me is that not just the 3 million, but there's been a hell of a lot more than 3 million that was taken out over the last 2 years, including but not limited to the chief risk officer extracted something like 4 million not too long ago, in conjunction with another 8 million from the CEO at that time. And so,
hold on, can you sorry, so chief risk officer, what did he do exactly?
At Silicon Valley Bank, sold $4 million worth of share relatively recently. Now, yeah,
Is it
February
this
28th, I
year?
believe.
Yeah, it's the one you posted, 3.57 million.
Can you send me, Slammy, can you send me a link to this, please, with the numbers
this
and
is in
everything?
addition to the 3.75 million.
Oh, okay.
And that's,
Sorry.
yeah, so that's 4 million. So that's 4 million by the chief security officer?
Relatively recently, yeah. And so if you, what's more interesting than the last, 20 days is the last 2 years. And that's what I would be looking to for signal if I were the plaintiff's counsel on a securities case. Not that I am legal information, not legal advice, etc. But yeah, there would seem to be evidence of behavior that is consistent with people who have tried to extract before a dip like this. I think in fact, but as to whether or not those movements were made in a way that is compliant with the kind of lawsuits that you would probably be getting from your shareholders and LPs, rather than the startups per se, or the other sort of stakeholders. This feels to me like a securities issue, but I would be very, very I've never seen legal language that is more tight and clean than that of the banking industry, right? So it's if anybody was going to be able to do it in a compliant way, to be these guys, but certainly behaviorally, it would seem as though this was visible, a lot long before today.
And
It
what was the
was
number?
visible long before today.
Can someone just update me quickly? Sorry, I'm not sure who's speaking. I think it's you, Jay. But just quickly, can someone just give me the metric again? Was it 50? By the way, Stock Talk, yeah, I know you can't mute. I'll have to try to fix it on your end. Nothing major. But can someone give me the metric on, was it 50% of startups in the US used Silicon Valley Bank? Is
That's right.
that the right metric?
That's right.
I know we've talked about it like 3 times, but I still want to reconfirm it because the number just sounds ridiculously high. Jay, jump in.
Yes, and for anyone that wants to see, Gregory Becker's stock sales, you can actually go on SEC Edgar and go under ownership disclosures and pull up the March 1 filings. There are 2 filings, and it shows all his sales on February 27th. And you better believe he knew about this issue on February 27th.
Yeah, Mario, I have the Form 4s up. I can go through them if you want. There was 3 insiders that sold stock. The CFO, Daniel Beck's, just only small amount, sold 2,000 shares on February 27th. Then the president and CEO.
CFO, hold on, CFO, I'm writing it all down. So CFO sold 2,000 shares.
Yeah, CFO,
on
he didn't
February
own that much. Yeah, he only sold 2,000 shares on February. All these sales were made on February 27th. Okay, so the CFO, Daniel Beck, sold 2,000 shares. And then the CEO, Gregory Beck. Part of this was stock option conversion, but he sold 12,000 shares related to conversion of stock option. But then he sold, looks like, another 10,000 shares as well, all on February 27th. And then the chief risk officer, Olson Kim Petra, sold. Actually, I'm not really sure about that. That might have just been. Does someone else have information on the CRO? Because it looks like maybe 5,000 shares stock options, but it was mainly the CFO and the CEO.
What's interesting to me,
and that's all on the that's all on February 27th.
Yeah, so basically the CFO and the CEO sold stock on February 27th.
And was that the value of the stock that was mentioned before? What was the value of the stock, if you could just confirm?
Let's see. Hold on.
You can send it through to me on WhatsApp name. I'll
Okay.
forward Slimline. Sorry, someone's just jumping in. Go ahead.
So what's interesting to me is not so much like the value of the stock per se, as much it is the percentage of that particular individual's stakeholding in the company overall, right? Because I would say there is like a difference between the chief risk officer or chief security officer selling 1% of their stock versus selling 99% of their stock. To me, 99% is not what I would call consistent trading. But if it's 1%, you know, you could somebody could rationalize that kind of behavior as a consistent part of the trading profile.
I actually posted up a quick screenshot. So the CEO sold 11%, $3,578,652, and the CFO sold 32%, about $500,000. So, and the CMO,
Yeah, the CFO only held like 5,000 shares or so, not that much.
not much. So,
and the CEO sold about 10% of his holdings.
Yeah, if someone can send, or whoever is mentioning those numbers, if you can send them through via DMs, Slayman, I've just sent you a message about it as well. I want to get it all into a nice tweet and get it looked into as well, and just tweet it out to bring a bit more awareness to it. All right, yes, just sent you the information. While I bring Stock Talk up to fix his mic, I want to welcome Nick to the stage. Nick, how are you?
I'm good, thank you. How are you?
Yeah, good man, good. Anything to add to the discussion while I sort out Stock Talk's technical issue?
No, I'm just kind of sitting on the sidelines here for now. Like the direction the conversation seems to be going in. I was really interested with the stock sales amongst executives at SVB in recent history. I'm curious if anybody can sort of contextualize at what point, this is a little bit outside of my particular sphere of experience, at what point is it incumbent upon an executive at a publicly traded company to disclose a reason, why they may be selling? I know obviously, insider trading and all of that. Or is there really any sort of regulatory burden to disclose a particular reason for selling off stock, being in that position?
Jay, do you want to take this one? I'm just getting all the numbers, all the DMs that I'm getting.
Yeah, sure thing. Could you just summarize the last part of that question, please?
Nick, do you want to ask the question again?
Sorry. I'm wondering if at any point there's regulatory burden upon executives who are significant shareholders to either disclose before selling off a significant volume of stock, or disclose why they might be selling off a particular volume of stock.
Yeah, and better way to ask, is there any, do you think, from what you've seen, and I've just brought up Jason as well, who's a former capital markets regulator during the global financial crisis, so it'd be good to get his thoughts on this question. Is there anything shady from all these sales?
I'd like to hear Jason's perspective on that as well. But one thing I'll say about stock sales in this environment is that, a lot of people have been selling stock for a lot of reasons in the last, 6, 8, 10 months. And I'm not saying that he didn't know that there was, if it's found that there was some kind of core solvency issue that led to the susceptibility of the bank run, then I would say that constitutes as insider trading. Now, why else would he have sold stock? I don't know. But the point is that, like, it's easy to just jump to the assumption, all right, he sold stock. I mean, pretty close to it. You would imagine that he knew something. But
well, at the very least, Stock Talk, he knew he was going to sell 21 billion in securities.
This transpired in about 17 hours, right? 18 hours. So it's like,
no, people knew that they were liquidating 21 billion of securities. And to be very honest, in the 4Q, when KBW and all these big banks were talking to the CEO, he told them that the bank had $180 billion of liquidity. And when you look at the financials, you realize that 55 billion of the securities were pledged to the Fed's discount window. So I don't know where he was getting his numbers, and the rest was what he calls off-balance sheet financing. Now, why would he sell 21 billion of securities, take a 1.8 billion dollar loss, and raise 2.3 billion dollars if he really had 180 billion of
No,
liquidity?
Jay, I get the point you're making, right? But I'm saying if like it was so forecast, right? You know, why did these why was it so susceptible? Is my point. Is that the bank run happened in, essentially one session with 42 billion in withdrawal requests. That was the stimulative event. Now the question is, was there a core issue? And I get what you're saying about them selling 21 billion in securities. I just don't know if that was a testament to a core issue or if it was forecastable enough. In hindsight, it's easy to say that, right? That's what in hindsight,
there's a way
it's
that
easy.
he can get out of this. He can just play dumb and say, "I had no idea." I'd be forced into
But
receivership. I was just selling.
think he will? You think like this will easily be?
I think it warrants a shareholder lawsuit. I think that there will be shareholder lawsuits, and we'll see how those play out. Will he be proven guilty? I don't know. It's a little bit of a stretch, but I guarantee that there are going to be shareholder lawsuits.
Just remember. Let's not dismiss what Michael Burry tweeted about this being something about Enron. He tweeted about comparing this to Enron and then deleting that tweet. So not sure if there's more behind it. Not creating FUD. Not speculating anything. But,
He deletes all his tweets. So.
Oh yeah, true. He does that. I remember he did that during the.
I want to say something on these stock sales though. Part of the CEO's selling was stock options that matured, so it's not the rest. There were other ones outside of that were direct selling. It's a very insignificant amount compared to his overall holdings. And to answer the other person's question earlier, no, insiders are not required to give a reason why they're selling stock. But usually if it is a large, say it's like Tim Cook wants to start selling shares of Apple, usually what these insiders will do to get around any sort of perceived insider knowledge or anything like that is they'll just enter into I think it's called a Rule 10b-5-1 program.
10b-5-1. Yep.
Yeah, so they'll just go into it. It's just given to a broker and it's sold every day, same amount of shares every day, pretty much, and they're just it's out of the loop. But that's not what happened in this case. It was very small amount of shares.
I want to go to Michael. Jason. Jason, as a regulator back in the global financial crisis, we were trying to compare I think we had Kobeissi, correct me if I'm Stock Talk, Kobeissi letter. Am I saying it right? Stock Talk?
Well, it was IndyMac Bank.
No, there was an account. There's an account here on the panel. The Kobeissi letter. I can't remember what they were called. Anyway, so we had a panelist that was talking about the sentiment among investors being the worst since 2008. Now, a lot of us disagreed, including myself. There's also been comparisons to what's happening now and what's been happening recently to 2008 version for startups, tech, and crypto. Would love your comparison to what you're seeing now, Jason, to what you've experienced back in 2008 and whether comparisons should be made.
Sure. So full disclosure, I'm not like a macroeconomist. I'm an FDIC regulator. So, I'm not so much a macro person as I was with the FDIC and helped with the IndyMac failure that's similar to the Silicon Valley Bank failure. So I could probably provide expertise best, Mario, with like what exactly the FDIC is doing, why they chose to do this by law. I'm not really good at the part about macro.
Yeah, sure, man. Go ahead.
That's awesome.
With IndyMac Bank, it's very similar to what happened with Silicon Valley Bank. IndyMac Bank, what we did when I was at the FDIC then is you go out. They always go out on Friday, and they shut down the bank about 4 p.m. Looks like they did it earlier here. Basically, you take the state charter off the wall, and the FDIC will be working there over the entire weekend. The tellers will come back all day Saturday, all day Sunday, getting ready to open on Monday, where it'll just be the IndyMac Bank, the Silicon Valley Bank insured federal government-owned bank that is just for the insured depositors, which is 250,000 plus all the receiverships certificates that they're going to hand out to people that had more than 250,000 in their bank. they're going to try to sell all the assets of Silicon Valley Bank. So similarly, an auction process will start on Monday, where people will look to buy parts of the bank. FDIC will look to get the best results in those auctions to pay back those folks that had more than 250,000 on there. So if you're like a crypto company and you lost money with Silicon Valley Bank, or think you've lost money, maybe you had 2 million in deposits, 250,000 of it is something you can get Monday, and then after that you'll be able to get the remainder probably over, unfortunately, a long period of time. Now, if you had FDIC accounts set up in different ways, like for yourself or for your wife or in a trust or a joint account, those all count. So you could have more than 250,000 in coverage. Regarding if this is the same, I think they're causing a major crisis the way they did in 2008. And Mary, that's where I can maybe just help just explain for 2 minutes. Basically, the problem is the FDIC here didn't sell the bank. The bank wasn't sold to another bank that bought it. So the government has essentially acquired the bank, and then they're going to try to sell it off. That's usually not a good result. It wasn't with IndyMac in 2008. It's a problem because no one really trusts the government to own a bank. It's better if like a Wachovia Mutual is bought by Wells Fargo, and then over the weekend you just have to find out what your new account numbers are. This is a whole different thing. Eventually, what happened with IndyMac Bank is the former Treasury Secretary Stephen Mnuchin came in, and he bought what became One West Financial. So the FDIC gave up on this idea of just having a government-owned bank, and they ended up selling it back to the private sector, which is really where they want it to belong. So there's a similar feel for the amount of hysteria I'm seeing that we saw in 2008. And I think, so what typically happens, in the question about the executive who may or may not have known, I don't know what the CEO knew or didn't know, so I'm not speaking to that or making any accusations, but the FDIC usually tells you far in advance if you're going to be sold. The typical time is probably 60 days before you're ultimately going to be closed. You don't know what Friday it'll happen on, but you're told, and what the FDIC does in the background, Mario, is they set up a secret bidding process where they try to find other banks to acquire the bank. And what they have to do by law is meet this thing called the least cost test. So they have to figure out what's going to be the least cost to the FDIC insurance fund and us, the taxpayers. And if the least cost method means that another bank buys them, then they pursue that route. If not, then you see this scenario. And so it's not a good situation from public perception perspective. It's not a good look from a trust perspective. Anytime you have this scenario where the bank basically shuts down, is shuttered, they sell off pieces of the institution to pay back the receivership certificates. And so as to the CEO, he might have found out Thursday and then sold. When the FDIC comes in, they come in at 4 p.m. or whenever they come in. I've done it before. You walk in the bank, you take down the state charter, all the managers leave because they know they're not going to have jobs. All the tellers typically stay. And what they do is they tell the tellers, look, we're going to pay you over the weekend to help us understand what's going on in the bank. Get all the documents that you can, all day Saturday, all day Sunday. And then Monday morning, you open up the bank and you're probably going to have a zillion million customers outside all trying to talk to find out what exactly happened. And they're going to, have to show you, this is your 250,000. This is what's covered. You can withdraw that now. And here's your certificate representing the rest of your deposits that you had in the bank. That certificate, though, that might take 2 years. We're talking months, if not years, as far as recovering any of that money, if ever.
Hey, Jason, question for you. So what prompts that action 60 days before? Is it case by case basis, or is it across the board? There's a threshold.
Basically, there's a CAMELS rating that banks get, whether from the FDIC, if you're a state level bank, or Federal Reserve, or if you're, an OCC, a federal bank. And usually it's when you get a rating of a 5. So 5 is the worst rating, meaning you're failing. And so if the examiners issue a 4 or 5 rating, a 4 means it's probably happening, and then a 5 kicks in this process. And I believe it's actually in their receivership manual online. So, they explain a lot of this, publicly as to what they do, which they have to. They don't have to share who the banks are that are going to buy it. They keep all that secret, but they have to show this process and document it. because it is a law as to how they close the bank, because they have to close it in the least cost to the taxpayer.
And then Jason, quick follow-up, sorry. Quick follow-up. What responsibility does the bank have to its members regarding the the current state of the bank? Like, until 2 days ago, SVB was claiming everything was okay. So, what responsibility do they have to disclose?
They don't have a responsibility. In fact, they're for them to say, "Hey, we're going out of business," would actually be considered irresponsible by the regulator. So the FDIC will come in and close down the bank and try. And this is for better or for worse, right? This is just the way we've done it in this country, even since the Great Depression. Is we go in, we close down the bank without telling anyone, and they usually do that. The FDIC has done that since 1933 because typically there's a run on the bank, meaning people are running to take money out, even though this guy was saying, "Hey, everything's fine." Now, had he known, if he knew, if he misrepresented to shareholders, that's an issue with the SEC and the shareholders. What might happen from that? Like even unfortunately in the IndyMac Bank case, if you go back and look, you'll see even the regulator had done things that were illegal. The regulator said IndyMac was fine by saying that as March 31st, 2008, the bank had plenty of capital, but had actually backdated capital to be allowed in May. That's one of the reasons why the Office of Thrift Supervision is basically gone and got molded into the OCC. So if you did on my scope, but that's where the FDIC would refer the case to the SEC and Department of Justice. As we stand now, though, Silicon Valley Bank no longer exists, right? So it's a closed institution, and it's a matter of what might have been done, as it was closed, sort of similar to kind of what we saw a little bit with FTX or anything else. But no, a bank, you never should misrepresent facts. If they're asked questions, though, they really need to refer to their regulator. And it's a bit of a cat and mouse game because you're not supposed to say anything that's going to cause a run on your own bank, right? Because the idea is the FDIC is here so we don't go back to pre-1933 runs on banks where we lose faith in the whole banking system.
Are there any? Go ahead.
The way that,
sorry,
just real quick, the way, if you think about it, the way banks are built, like if you ever actually hear, as anyone's ever gone into a real bank, and the way they were built back in the 10s and the 20s and in the beginning of the 20th century, they're built really long where like the teller's at the one end of the bank. So if you think about it, before phones, cell phones, and all this kind of communication the way we have now, the idea was the bank tried to build itself long enough. So if ever there was a quote unquote run on the bank, they would always hope the line wouldn't go out the door. But the second the line went out the door in the towns, everyone would run on the bank. And I think in a sort of the social media space that we have now, you saw that happen with Silicon Valley Bank, where enough word got around where they just couldn't keep it quiet anymore. Sorry.
well, and literally the line was out the door there. We saw some video on that today, even in the rainy weather they're having there in the Bay Area. Want to ask you, obviously, there are legal protections when you go into a bankruptcy status. I'm assuming there's some type of protections when the FDIC comes in and locks you down. But what sort of protections does that grant? I mean, there's obviously going to be some very angry people coming after blood for the people that it seems had some serious mismanagement, perhaps not illegal, but you mentioned if they misrepresented statements, if they misrepresented data. What are the protections these guys have under this new FDIC thing, or what are some of the still liabilities these people could face down the road?
So I wouldn't call them so much protections. It's going to be, even with the FDIC would take exception if their CEO was misrepresenting facts to a certain extent. Keep in mind, it's less like a bankruptcy and more like what they describe as a receivership at this point, because the minute they took the bank charter, they essentially ended the bank. I don't know about the holding company for Silicon Valley Bank. That's something I plan on taking a look at soon over this weekend, because the holding company could still exist, right? But the bank itself isn't in bankruptcy. It's in what's called receivership. There's a whole division of the FDIC that deals with this called Division of Resolution and Receiverships. And they're going to manage, and the CEO, as far as they're concerned, or anybody who has management of the bank is history. It doesn't matter to them anymore. Their main goal right now is like their mission, which is trying to pay off the insurance because it's a failed bank,
paying 250,000 everyone who's owed it, and then trying to, sell off the assets to pay off everyone else the best they can. So that's kind of their main function. They're not going to be looking into this, but like with the IndyMac Bank in 2010, I don't want to speculate, but I mean, it could be anybody from the FBI to the Department of Justice, the SEC, that may start an investigation. Of course, they never publicly say they're going to, but if there is something that happened here, with the CEO or anyone at the bank, they would definitely start, an investigation. But the key is like, you're better off not saying anything, right? You don't want to say everything's great if it's not. That's where you get into dangerous territory. You're better off simply not saying anything in the eyes, of the FDIC, because they want to try to handle this in a way that it's not working out to be, right? This is turning out into a serious crisis. And this is where they worry about the systemic risks of people trusting banks in general.
Now, taking you back to September 2008, obviously the political election for the presidency, John McCain in the Senate, Obama as the incumbent. We have Bear Stearns failure. You have a major set of cascading awfulness that happens there. 2008, the mortgage-backed securities and the wrappers that went through that. We've all seen the films. We all at least have some notion as to what happened there. But I'll never forget, because I had certain people that I knew in the room there who were debating with senators as to who was going to get the bailout, how this happened. It was a yelling fest between bankers who were there trying to lobby for these bailouts, everything else there. Is this the prelude to another 2008?
Well, certainly we've just seen the second largest banking run in history. I will say, to your point, Paulson has said in his documentary recently about that he asked for about $700 billion because it wasn't $1 trillion, it wasn't less than 500 billion, and it was about as much as you could get. And what's the difference between 500 billion and 700 billion? And he literally says in the documentary, most people don't really understand the difference between 500 billion and 700 billion. So they asked for 700 billion to end up getting a bailout. And at that time, though, that's a little different because we had, as you just said, all the mortgage-backed securities that were failing. And I did the analysis like with Lehman and then AIG and how we ended up, resulting in wanting to do that bailout, right? And what I would say is that bailout, if you remember, it was given to all the banks, even Wells Fargo, that didn't want it, right? They didn't want the bailout because they're like, we're fine, we haven't done anything wrong here. So the question is like, is the subprime mortgage crisis the equivalent of like what we're seeing with like, Bitcoin and crypto and fintech in general? Is it going to spread that large, or is it going to be contained to like Silicon Valley, Silvergate? I think that's what people have to kind of ask themselves is there a bigger underlying issue similar to a subprime mortgage crisis that we feel is going to potentially rock, a lot of the large banks and a lot of the investment firms? I mean, I haven't heard anyone yet saying they think Goldman Sachs or Morgan Stanley is going to go down. So that's when you get to serious, like the markets aren't working anymore, right, Justin? So
Let me play this. Oh, go ahead. Sorry. Yeah, go ahead.
So we were talking one other comment too in 2008 when they basically forced all the banks to take these bailouts. The reason they did that is they didn't want to single out, a specific bank to make it seem like this bank's in trouble. So they forced all of them to take, I forget the number, it was like, 5 billion to 20 billion, something like that. But my question is, we've been discussing before you came up, and I have too, about how essentially the bank's now in receivership. So it's not operating as a bank as far as like making new loans, but then all these open credit lines that all these businesses have with them are all, I've said this, that all those are shut down and a lot of these businesses won't have access to those funds. I assume I'm correct, or can you comment on that? Yeah, those will be effectively shut down. There's no ability to take any more credit or loans from the bank. There's no ability to make more deposits on the bank, in the sense of like a bankruptcy, right? That most people are used to with corporations. Think about it like the Chapter 13 is filed, so they won't. They wouldn't even. You could say, "Hey, I want to take 50,000," but who's going to send you the money right now, right?
Yeah.
But what
So
about the
in
other side of it?
receivership status, they're basically essentially just going to wind it down, sell the assets, and settle up with all the depositors, and that's it. It's not functioning as a bank anymore.
Right. Think of a receivership as what, the bank regulators call a bankruptcy. They just call it because it's in receivership, meaning the FDIC is in charge of going through the process. Now, I will just say two things, which is, of course, they've kept open, or they're opening up a Silicon Valley FDIC bank, which is the same thing they did with the IndyMac Bank back in 2008, where that is going to open on Monday, but that's only going to be so you can take out up to whatever you had, but up to 250,000, give you receivership certificates to tell you about the receivership. And really, it's a lot of public relations, right? Just to help everyone who maybe experienced the failure understand what's next, what they have to look forward to, who to contact, that kind of thing. The only caveat to what you said, which is absolutely correct, is essentially it stays in a receivership. It's not operating more. Is, as I mentioned before, Secretary Treasury former Mnuchin came in with his partners, and the FDIC changed its mind because they felt like the IndyMac Federal Bank was not going very well, and they in turn ended up selling that, which what became One West Bank. But as part of that deal, they gave the FDIC left some skin in the game by saying they would take responsibility for 10% of any loan losses if they sort of reinvigorated it into a bank. So that is what happened there. So if the FDIC has trouble selling off these assets, and their goal is to sell it off as quickly as possible for the most amount of money to pay back as much of the depositor's money that was uninsured as possible, you could see an incident where some big investor comes in, whoever that might be, and says, hey, I want to buy all of this, and become a bank. And that's essentially what One West did with all the loans from IndyMac Bank.
Yeah,
Hey,
there's been a lot of talk about people are calling for a big bank to step in and buy this whole bank, so Silicon Valley Bank, by Sunday. I just don't,
It's not gonna
based on the past, I don't see that happening.
Hey, Jason, one quick question around loans. So let's say you're an organization that has already received a loan and you're making payments. Received a loan from Silicon Valley Bank and you're making payments. Could the FDIC now do capital calls to retrieve that loan amount, or a full capital call? And
Absolutely.
now is that how
Yep.
it works?
Just like a bankruptcy judge may say, if there's just like the bankruptcy with FTX, right? Just because maybe you owed money to FTX doesn't mean it goes away because it's in bankruptcy. Typical bankruptcy, right? It's the judge and the appointment of whoever's in charge of that bankruptcy to recover all loans and bring it back. Same thing with the FDIC. It doesn't mean that they're going to call the whole capital amount immediately.
Oh, okay.
What they'll probably do is send out a note to them saying, please continue to make payments. Here's your options. Here's what it's going to look like, kind of thing. But that's going to be between the FDIC receivership and the person who maybe had that loan. I will just say one thing to Doctor, which is you'd be surprised how fast the government works in scenarios like this. I wouldn't be totally surprised or shocked if we learn they're not going to do the bank opening on Monday and someone comes in and buy it. I mean, with things like Bear Stearns and others, we're talking about 48 hours of time where someone comes to the deal. So like, if somebody comes in and wants to pay the FDIC almost 100% of the value of Silicon Valley Bank and wants to take it over, the FDIC is not going to say no to that, right? Because that's their mission. Their mission right now is to try to recoup as much as possible. It's unlikely, I'll give you that, but don't be surprised, because back in 2008, a lot of deals happened over the weekend, and by Monday morning, it was done.
The reason why I was kind of pushing back at the concept, and I'd love to get your thoughts, is what would be the incentive at this point? Like, why not wait longer? Couldn't they just wait it out for until the situation is pretty dire? Because, like you said, if they give 100%, obviously FDIC will sell. But I'm assuming they try to buy it for cents on the dollar, and the longer you wait, the better the deal gets. Is that not how it usually works? Is that what happened with IndyMac or other banks?
It usually is, but see, IndyMac was a bit of a problem, and what I guess I'm saying, the X factor, which I don't know and no one really knows, but you hear Justin talking about people like lined up outside the bank, that kind of thing. If they believe that the right answer to stability in the system, so everybody calms down, goes home, don't starts runs on other banks, is that they need to sell this thing by Sunday, then it'll happen. You see what I'm saying? But if they don't factor in, if they don't think it's going to be a total mess with other banks and other runs, then yeah, they'll wait it out. But part of this is also they have to maintain the trust, of the American people, and that's a lot of what
happened in 2008 when I was there and saw what happened, and kind of, started me down sort of the Bitcoin and kind of path of, what does trust mean even in banking, right? What if we have the, fiat money, but it's not necessarily backed by anything. So without public trust right now, there's nothing. So a lot of the factors going to have to be where they can feel they can regain or keep people calm during this crisis.
Let me play this last 50 seconds of Gary Tan on CNBC. This is just hours ago. And again, he's a little panicked. He's asked about, well, what are the options if they can capitalize? Some public companies come in to help these, these startups. What do you think will happen? And his response is basically, no, they don't have the money for it. Listen in.
The financial world does not have the capability to save these companies. Like, we will just wholesale throw out startup innovation in America if we allow these companies to die in the next weeks. And it really is a matter of next week. I have companies that are calling me saying, how am I going to make payroll? All of my legitimate cash that I was using to plan out to be able to even just run the business, was in a bank account that I do not have access to anymore. And so, what the FDIC really does need to do is take into account these people. These are the small guys who, if we damage them, it hurts us all. And there will be a catastrophic. This is a national security issue because this is a lot bigger. This will splash across all of the economy.
Okay, there's the plug. It's a national security issue, and therefore,
Yeah.
you're going to have to bail us out. I get the anxiety. Obviously, he has a lot of love for these companies, but most of these are going to fail outright, anyways. It's hard to prop those up without really, really skewing things dramatically. What are your thoughts on that, guys?
I think we talked about it earlier. I just don't think. Yeah, go ahead. I'll let you answer.
No,
Jason.
Mario, sorry. Well, I was just gonna say real quick, just remember, I'm an ex-FDIC regulator. The FDIC's only responsibility, and they care about this very deeply, is paying back the little guy, meaning the insured depositors, up to $250,000. They really don't have much of a say beyond that, and they don't really have a responsibility under law of trying to resolve a bank thing any quicker, unless it does rise maybe to those occasions. But that would be speculation. Sorry, Mario.
No, all good. I was just eating anyway, so glad you answered it. Ram, who some of you might know from previous spaces, he just did a thread, and I haven't had time to read it, so I've just invited him to come and share it. But it's just gone viral, and I'm going to read out the first three sentences. Is Jay still with us? Yeah, Jay's here. Jay,
Hey.
I think I've sent you the link to it, Jay. But I'll read out the first sentence. He says the following: I found a bank that has $1.5 trillion in market-to-market losses because it bought treasuries and mortgage-backed securities. Ram, good to have you back, man. How are
Hey
you?
Mario, I'm doing well. How are you doing?
Man, long time. Last time you were on our stage was dissecting the FTX collapse, and here
I
we
think,
are dissecting Silicon Valley Bank.
there's a common theme, Mario, in all of this, which is non-bank lending. Sorry, I got a connection issue here. Give me a quick second.
Yeah, cool. No worries at all. I'm just gonna open up. Actually, what I'm
Right.
gonna do is I'm
Sorry.
gonna pin the
Does that work?
tweet. I'm gonna pin the tweet. Yeah, of course. I can hear you fine, and I'm gonna pin your tweet above for audience members to go through it. But yeah, go ahead.
Look, so the higher level theme here is you've got non-banks acting like banks. That started with FTX, Voyager, Celsius, and BlockFi. They all blew up. And of course, what are banks doing? Banks are doing three things. They're doing liquidity transformation, credit transformation, duration transformation. What does that mean? All right. And we'll come back to the Fed in a second. So when you make a deposit at your bank account, you go to your ATM or you log in online, you see a balance, it's got a number. But we know that behind the scenes, the banks are doing something called rehypothecation. That's the nature of fractional reserve banking. So they make a loan on the other side. And this is very different than, say, a brokerage or securities account. When you have shares of Google or Tesla in your brokerage account, you know that those securities are being custodied. And there's no rehypothecation, although technically there can be some securities-based lending taking place, right? So, with Silicon Valley Bank and with Silvergate, we have two bank runs of the internet era. The first bank runs of the internet era And both these banks were created by the internet in some sense, right? Silicon Valley Bank was the first technology bank, and it was based in Silicon Valley and grew dramatically. And Silvergate Bank benefited from the growth of crypto. And both of these were undone as well by digital banking, right? So for the first time, we have bank runs done by wire transfers as opposed to lines around the block, which is what historically you've seen. So this is it's a new era. Banks may be less stable than they have been because of how easy it is to move money. That said, Silvergate and Signature have some special considerations around them. One is they had a high concentration of commercial depositors. Why that matters is that a commercial depositor can make a transfer very easily through a wire transfer. A CFO can panic and make a decision quickly and act in their interest to do so. Whereas other banks have a greater reliance on small retail deposits. So think about like your local community bank. Your local community bank, one of the safest banks in the world right now, because they're not going to get a bank run. They're not going to do an online wire transfer and move their funds. So that's one key factor around Silvergate and Signature Bank. Obviously, the other key factor is their concentration risk. Both were highly indexed to these sectors. And then third is the customers of Signature Bank and Silvergate. Well, where do they live? They live on Twitter, social media. So the movement and velocity of information, including fear, uncertainty, and doubt, some of which may be legitimate. There's a lot that's not legitimate, but unfortunately, perceptions of fear, uncertainty, and doubt are enough to undermine a bank, right? Because a bank is playing a confidence game. A bank is borrowing short. They're saying, hey, Mario, I'm going to give you instantaneous liquidity. You have a demand deposit. You can call back your deposit whenever you want, and I'll honor that. And they're making that same obligation to all depositors. And the game only works when two things are in place. You have FDIC insurance to guard against bank runs. Well, guess what? Doesn't work with commercial depositors because $250,000 isn't enough. The second thing you need is a lender of last resort. That's called the Federal Reserve, or the Federal Home Loan Bank. The issue there is that those lenders of last resort only lend against what's called eligible collateral. And that consists of treasuries and mortgage-backed securities. It does not consist of things like Bitcoin, nor does it consist of things such as venture debt.
Sorry, guys, struggling to
I think
unmute. Yeah, sorry, Justin, go ahead if you want. But I had a quick question for you, Ram. So continuing on the discussion, what would you expect next? How deep is the contagion, and what would you say is the worst case or the best case scenario in the next few days and weeks? What type of bailout do you expect to
No,
see?
there's no bailout coming. There's no bailout. This is not a system.
None of the you don't think
No.
any of the big financial institutions will scoop
Well,
this
that's
up?
the difference. When you say the term bailout, I think government intervention.
Governmental bailout. Yeah,
Right.
yeah, no.
So
No, I wouldn't expect
what I
anything.
would expect and hope to see is over the weekend that some number of regional banks like Signature Bank and First Republic Bank do a capital raise. Okay. By the way, it's not easy to do these capital raises. It's one of the reasons why Silvergate was such an attractive target for these shorts, and also Silicon Valley Bank, which had a lot of short interest, and now also Signature Bank. And the reason why is, see, a private equity company can't own more than 9.99% of a bank due to federal law, which should change. And so it becomes very, very challenging for a bank to raise capital quickly. And then you say, well, okay, what other bank would step up to the plate here? We've done some thinking around this. I've talked to a few friends today, some of whom were on the board of like WAMU when they were bought by Wells Fargo and a number of other banks. So here are a couple different scenarios. I think one is private capital raises. That's necessary. That's the right move to make. The second thing is, there's a limit on the ability of large mega center banks on their deposit thresholds. They cannot exceed 10% of deposits. So that would rule out banks like JP Morgan or Citibank from acquiring. However, those banks could seek an exemption from the regulator to make an acquisition. The question is, would they? If JP Morgan can get an exception and they had the strategic interest, then they could be a good buyer for Silicon Valley Bank. But it's not clear that those two things will happen. So, we shall see, right? What are you buying when you buy Silicon Valley Bank? You're buying a California presence, you're buying a vertical focused on technology. You're not buying deposits, and the big banks are awash in deposits. They don't need the deposits. You're also buying an asset portfolio that isn't as high quality as JP Morgan's, right? You are buying a bank that has loans to unprofitable startups, just to put it very directly. I don't mean that in a derisive way at all. It's just the reality, right? So it's challenging, right, for a bank to say, hey, I'm going to go buy SVB unless there's some kind of strategic intention around, the market that SVB
in
represents.
this climate, making that sale is really hard. If you're the specialization of this bank has created concentrated risk, and that's one of the issues here, is that if this bank wasn't operating in the niche that they are operating, it might have been a bit of a softer scenario. But yeah, I mean, you're absolutely right on the last point that you
But then
made.
stock talk. Question to
Yeah.
you. Then what will happen to the space? What will happen to tech startups? 50% of startups are banking with, to a certain degree, banking with Silicon Valley Bank.
Yeah,
what will happen to all
my
these guys?
concern is that startups that couldn't get their money out cannot make payroll. Okay, that's a real issue. So those startups will have to do layoffs, and that's incredibly unfortunate. And this is going to pour cold water on the venture market, on venture debt. Of course, SVB played a role in financing capital calls for venture firms, meaning if a venture firm was in between funds, they could get a credit facility from SVB, and they could draw against that, or they could say, "Hey, SVB, we're doing a capital call in 1 or 2 months. Can you give us an advance?" And SVB would do that. So SVB played a key role in creating liquidity for venture firms. And so, yeah, look, you're going to see over the next few weeks a high number of announcements of startups that, through no fault of their own, their bank just blew up, their payroll is trapped. And you're also going to see opportunities for dislocation and distressed investing, emergency funding opportunities. So there are two examples that come to mind. One is, if you recall, in the dot-com bust in 2001, there's a guy named Seth Klarman who created Baupost. Baupost, for those that don't know, is a $30 billion value-based hedge fund. Extraordinary performance, right? And what he did is he bought distressed claims out of these bankruptcy proceedings, and by providing liquidity. So I think you're going to see a lot of opportunities like that, right? That's one comp. The other comp is, if you go back to the Resolution Trust Corp. This is actually the creation of Apollo Management. So Apollo, what they did is, in RTC, for those that don't know, it was a consequence of the savings and loan crisis. You had another banking crisis. Seems to happen every 10 years, right? Anyway, you had a banking crisis, and the Resolution Trust Corp was formed by the bank regulators, and essentially you could go through and pick different assets, and that's what Apollo did. And both those institutions created a fortune. So I think there are going to be really interesting opportunities if you have two things. One is, you got to have the cash and capital. Second, you have to have access. What I mean is, what you really want to do is get direct deals and avoid a public auction process. Now, the FDIC, who's taken SVB in receivership, is most likely to auction off these portfolios, like to auction off the venture debt portfolio, and they'll provide a data room saying, hey, here are the listings, here are the holdings. And if you can price that quickly and efficiently, that's great. Even better is if you can choose slices of the debt, at the name level. Even better than that is if you have access to some SVB management to do a direct deal. And in some cases, the FDIC in the past has done that. And one step better than that is if you can get the bank regulators to ring fence your risk, which has also happened, in the past, including the 2008 crisis, meaning that they'll shoulder losses for the performance of the debt. So those are the options that you want to consider.
Umbrella and also jump in, guys. Not sure if You can, Umbrella, actually, can you hear me? Because it's glitching on my end. Can you hear me,
Yeah,
Umbrella?
I can hear you fine. I don't know. Can you hear me?
Can anyone hear Umbrella, or is it just
No,
me?
I can hear
It's
him.
sort
We
of
can hear him.
glitching for
You're
me.
good. I can hear him.
All right, cool. Yeah, all right, cool. So Slayman and Stock Talk take over, because Umbrella is it's a glitch that happens when we hit a certain number on Twitter and we go on for too long. So I won't be able to hear Danish and Umbrella. So just so you know, guys, so you have to take over Justin, Stock Talk, and Slayman.
Yeah, I just want
Go for it,
I
brother.
just wanted to bring up something quickly. I see there's a lot of kind of feedback and on Twitter and Telegram and other social media around USDC and the impact that this is having. And I'm seeing, like, from an on-chain perspective, USDC is depegging quite a bit, and kind of thought it would be valuable for everyone in the audience that a lot of centralized exchanges offer kind of slippage-free ways for you to kind of convert if you kind of want to take the safety of your USDC to either USD or other stable coins. Like both, I know Binance, Coinbase, and Crypto.com allow you to deposit USDC and either take USD straight to your bank or convert it to another stable coin. So I just kind of wanted to let the audience know that, because I know there's a lot of people kind of directly swapping on chain, and that's kind of depegging quite quickly. USDC from kind of I see the main movements from USDC into USDT.
Thanks for that. Also, you got your hand up.
Yeah, actually, I just have a question for Ram, and he kind of brought this up at the about the .com. So, Ram, because I think a lot of people are talking about like the 2008 financial crisis, and I think we all kind of agree, or there's a consensus that that's a little bit hyperbolic. But do you think in a worst case scenario, because obviously it's too soon to really know, or maybe you do, but do you think this is more relatable to the .com crisis in the early 2000s, or where do you see this kind of, if there's any historical comparisons?
It's a great question. And look, history rhymes, it doesn't quite repeat. There are analogies to both the 2001 cycle. There's some element of 08, but look, this is not another 2008 banking crisis. That's not the case. So if the FDIC and the Federal Reserve came together and said, hey guys, we're going to insure all deposits, including commercial deposits, there would be no bank run risk, and the banks could hold to maturity, and the banks would be fine, right? In fact, today, the Fed has $1.5 trillion of mark-to-market losses on their balance sheet, and the balance sheet's only about $8 trillion, right? So, and the regulators had these interventions in 2008 when you saw like the Reserve Money Market Fund break the buck, which was the first time that ever happened. So my point is, like, they're not going to do that now. It's not systematic, but they have levers. Like a mere announcement like that.
I mean, but isn't one of the isn't one of the illustrations of why this isn't systematic, and one of the I guess reasons that this is, I don't want to call it an isolated case, because again that implies that there's no chance of contagion, and I don't want to imply that, but with the table I shared earlier, I'll pin it again at the top, about 97% of the deposits being over the 250K limit, like, they're just so far removed from most other banks on that list, right? Like they were at 3.5 to 4% of their deposits were in excess of the 250,000, compared to most banks that are, anywhere from 28% up to 55%, some of them in the 60s or 70s. So, isn't that a testament to the fact that this could be an isolated case, and maybe the banks at higher risk are the other banks with similar, uninsured exposure? Because if you look at if you just look at the market in the last couple of weeks, right, and you look at the other tickers of the banks that are at the bottom of that table that I pinned at the top, those are the tickers that have been targeted, right? And so, if you think the market has any kind of perceptive ability, then that's the perception now, that those other banks are also at similar risk.
It's a rich set of topics that you're unpacking here. It's really great. So I want to call it a few things. I'm trying to give a nuanced and clear and accurate take as possible. So this is not 2008 in the sense that there's no need to recapitalize the banks. That's one. That's hard to do. Remember this whole toxic banking, clean up the bad banks, separate bad banks from good bank balance sheets. All the regulators need to do is stop bank runs, and the levers they have to do that are a lot easier than 2008. We're not there yet. That's one. So On the other hand,
Guys, sorry, just I'm not sure if this came out. I do apologize. It's Stock Talk. Tell me if this you already guys discussed this, but Gergevin just tweeted this. Silicon Valley Bank had negative cash balance of about just under $1 billion.
Yeah,
Yeah,
that was
that came
because
out.
of after
Yeah.
the run,
The 42
over
billion.
time,
$42 billion
the
run
greatest,
led to a negative $958,
the greatest
58
Uh,
million cash balance at the
an
close. Yeah,
overdraft.
we already discussed.
But yeah, let's go to your second. So the second point is this, and we'll come back to the banks and the targeting, because I think you have really legitimate observations there, right? So the second is this. I think this has been covered before, but in this 14-year experiment with quantitative easing and ultra low interest rates, banks buy high quality liquid assets. That's per the Basel rules. That's what they're supposed to do. By the way, that's called eligible collateral. These are the banks were doing what they're supposed to be doing. And of course, when rates go up and the fastest pace of rate increases since we've seen since 1981, then something goes bump in the night. And we're starting to see the tide go out. And of course, the sectors that benefited most from liquidity were crypto. Right behind crypto is venture, long duration venture. And in the banking sector, the expressions of that are Silvergate, as well as SVB, and then a few other banks. So now this third point is really interesting too, because there is a campaign from motivated short sellers, right? It's kind of like Wall Street Bets has come back, maybe a different group. And it's tough if you're a bank because, again, private equity can't bail you out. That's one. Two, you've got loans that you can't really pledge to the Federal Reserve because you can pledge your treasuries and mortgage-backed securities. But beyond that, most banks have commercial real estate loans, and certainly venture debt is not going to be accepted. And you see that, right? If you look at like Signature Bank, they have record put options that have been purchased on that bank. And again, banks are a confidence game. They borrow short, lend long. They tell everyone you got a demand deposit, and that game works when you have the backstop, and it can be challenged. Like perceptions matter, right? So that's so is there contagion? It's not the kind of contagion you see from like the FTX, DCG, Genesis, Gemini, Voyager, BlockFi. That was a credit contagion, meaning you could follow the loan chain. You could see a default and then see, okay, who had this loan on the balance sheet? Now they're going to default next. It's a very clean causal mechanism of contagion. This is about confidence. If people don't believe in their bank's ability to honor their deposits and meet their withdrawal obligations, that's the risk. So it's not contagion, it's around public confidence in their bank.
I've got a question on confidence, and again, I dropped out for a few minutes. We just take a few calls, but we discussed this a few hours ago. We've been going on for about 8 hours. Do you think confidence is more delicate than it was before, as we still deal with the scars of 2008? And does that mean that any contagion, if it does kick in, it could spread faster than it did in 2008, considering the fee that we have?
I think the first answer is yes. However, look, if you talk to like mom and pop, like go call someone not in Twitter. I talked to my wife. I said, hey, a bank blew up today. She works at Bloomberg. She's tech savvy. She said, what? Okay. So a lot of people aren't on this Twitter space with us right now. So I think I think we'll see what happens this weekend. Let's see if these banks, raise private capital. But I don't think it's meme. I don't think it's pop culture. I don't think it's gone viral yet. You're not seeing Drudge Report with a headline saying banks blowing up.
But then,
Right.
then how would a contagion among startups look like, Ram?
Well, that's, I think what you're going to see is similar to what you saw in 2001, right? Where, and of course, Ben Horowitz wrote a whole book about this, Opsware, the founder of A16Z, which is that, when the tech cycle turns, you start to see all the beneficiaries of that tech demand decline in earnings. So who are some of the biggest beneficiaries of the startup ecosystem? Certainly Facebook, right? Direct marketing, Google, AWS, big tech companies. What percentage of every venture dollar ultimately found its way into a big tech company, right? And of course, you're seeing 6 quarters straight of consecutive quarterly earnings declines across the S&P 500. I expect you'll see more of that. You also see that in semiconductors and these other big tech firms. So I think that you're going to keep seeing that infrastructure around the tech ecosystem, diminish.
And I've got one more
Yeah, I
question, if you
think
don't
the
mind, Stock
deeper.
Talk.
I'll go for it.
Go ahead. Do you
Well,
mind just one
one
last
thing I just
question?
wanted to comment
Oh,
on.
go ahead, man.
Yeah, go for it. I think there's like a deeper macro narrative here as well, right? Because when you think of the idea that a bank of this size could have had the granular focus that it did on VC tech and VC growth companies, but so many biotech companies. I mean, we were talking about this earlier. The amount of biotech companies that had filings after hours today was insane. I mean, I haven't. Had to have been at least years and years and years since I've seen that any magnitude of that amount of filings. Everybody disclosing that they had 6, 7%, 8%, 10%, 12% of their cash here. The question is was the perception of risk in providing long-term credit facilities to these companies over the course of the last 15 years of relatively easy policy and relatively low rates, was the perception of risk then different than it is now in the face of not only a dramatically quickly changing rate environment, but also uncertainty in how long rates will stay as high as they are. And so that's the question: is has the perception of risk changed there? And I think that's an interesting part of this narrative as well, and is what is magnifying the risk in this blow
Yes,
up
no,
too.
no
So,
question. So let me be really
Ram
brief here, and I'll go ahead. Yeah.
Ram, you brought up a point that's related to that. You said that, with respect to the actual banks, that they were doing what they were supposed to do. And, if you pull up a 10K or a Q or an AK of any of the other regional banks outside of SIVB that have fixed rate securities on their balance sheet, you can pull up PNC, for example. PNC has 40 billion of cash flow hedges and 24 billion of fair value hedges, and they're hedging their interest rate exposure. Whereas I would argue that SIVB did exactly what they're not supposed to do, which is top tick the MBS market, buy $91 billion of MBS at the top of the market with 10-year duration and not hedge interest rate risk. None of this would have happened if they had done that.
Yeah, that's fair. Like that CFO and the Treasury group, and look, they're not here on the call, so it's hard to give the other side of that, and it's easy to be a hindsight quarterback on it. But yeah, when you look at that, what the hell were these guys thinking? On the interest rate derivatives, though, I'm mixed on this. Like you're right. Like think about what are the tactics a bank could have done apart from diversifying their customer base, that's a mixed bag. Like people don't like these big to fail banks like JP Morgan that are touching every single sector, right? Is interest rate derivatives. But here's the thing. You really don't want your banks and community banks to be dealing with interest rate derivatives. You want them to focus on originating loans, underwriting well, servicing the customer. So that's where you're right. Interest rate derivatives could have managed this better, but that likely would have created some other blow up. In fact, in the UK, a lot of these pension funds that have these long durated liabilities use interest rates to hedge their risk. And that caused the UK government to bail them out, right? So
yes, but the types of hedges they were using were very inferior to what, they weren't like pair swaptions or the fair value hedges that short of put short, type hedges. So it was a lot different.
It's look, like PNC is a very sophisticated bank. It's run by a guy named Bill Demchak, who's a former vice chairman of JP Morgan, and incredibly sophisticated bank operation. The vast majority of banks don't have that capability. And I look at this as symptomatic of the 14 years of QE and ultra low rates. Like, do we really want Silvergate technically is a community bank in La Jolla, California. I think it's only got one branch. It grew quickly. Anyone there know what an interest rate derivative? They probably do.
No, that was a little bit different though, right? He was investing in short duration treasuries. He wasn't investing in 10-year securities. I actually think the CEO of Silvergate was smarter when it came to managing risk. He just had clients that were scummy.
You're right. So Silvergate, to their credit, I looked into this, they had extraordinary liquidity coverage ratio, and it's a testament to the fact that they've been able to honor every single depositor, and they had a high quality liquid asset base. But fundamentally, what's the core issue? The core issue is you had 14 years of quantitative easing and ultra low rates, and banks buy ultra safe securities, and those have low rates. So yes, are there things that someone could have done differently? Sure. But by the way, I've seen this other chatter on Twitter about people saying, oh, if Silvergate or whomever, Signature, et cetera, bought only treasuries, they'd be okay. That's not true. That's not true.
No,
In fact,
if they bought very short-term treasuries, like 3-month, they would be fine, but they wouldn't earn anything.
there's a bank, I'll look it up and send it to you. I'll put it in the thread. And the only thing they bought was short-dated treasuries, and they blew up in the 90s. So running a bank isn't easy, right? Asset liability management, you're in the business of duration mismatch. It's the nature of what banking is about. You're borrowing short,
Well, I mean,
lending
it
long.
then depends on the leverage, right? With 15% tier one and the size of the balance sheet, if this bank was in 3-month treasuries, they would have been absolutely fine.
So we've talked a lot about fallout and contagion, and I think we've covered it pretty well. We've talked about the small cap, biotech and growth tech companies, even the publicly listed ones that are exposed either by their cash being frozen or by credit facilities that they're dependent on being suspended. I want to go to Mel really quickly, who's had her hand up patiently for a while, and just hear your thoughts, Mel. But then the second part of this, after Mel chimes in, Ram and Jay, we can discuss, and Jason as well, and anyone else on the panel. We can discuss maybe the reaction over the next few weeks, the expected reaction. Mel, we'll go to you first.
I appreciate it. And I first want to start off with thanking everybody for their time. It's Friday and we should all be getting drinks and pencils down, but yet there's like a bigger thing going on that we all have to kind of wrap our heads around. And that's why I'm here. I'm good at what I'm good at. And I look and crutch off of so many people, Stock Talk, everybody else that's on this panel. Appreciate you guys jumping in and adding your insight because it's valuable to me. And I think I could possibly add a little bit. So would love to jump
And
on.
just
for you,
before,
Stock Talk.
yeah, thanks, Mel. Thanks a lot for joining. But before you do add anything, just if you can get the mic a bit closer, we can hear you, but it's just not too clear, not too crisp, if that's possible.
Oh goodness, is it still this? Is it?
No, we can hear what you're saying. If there's nothing you can do,
Okay.
it's all good. Go ahead.
Yeah, I'm sorry. I'm on AirPods, but I did just
All
want to
good.
add just one thing. So to give a little bit of a background in my perspective, and I love all the macro insight and everybody else that has so much outreach and everything else that you're adding, and that's helping me tremendously because it's just not my lane. I tend to look at what is money flow from a perspective of dark pool activity or options flow, and that's where I like really have an edge. And I do want to kind of add that there was some activity last Friday, and I even posted this and said KRE with 1.5 million share dark pool print, unusual. And I don't even know enough about the sector, nor have I traded it enough to even know the names. And so it was a missed opportunity for me. I can't even act like I traded this and profited because I should have, but unfortunately I didn't. So just a little bit of a it's okay if you didn't or you saw anything and you weren't able to jump in on anything. For any of the people that are day traders, I know we have a very mixed audience that's going to be, investors versus day traders versus scalpers, and we're going to be across the board. But I will say, today they also came back in and added a little bit more into KRE, which I thought was unusual. We've had this bigger decline, and you had a 1.51 million share dark pool print at 49.09. They also came into the KBWE, which is Invesco Bank Core ETF. And so you're starting to see some of these ETFs getting hit. But really, the only reason, and I mean this with like my biggest heart, the only reason I raised my hand was because I saw the most unusual thing today. And I've been looking at this, and I know Jay knows me.
When was
Stock
that
Talk
KRE? When was that first KRE short on the
3-3,
dark pool that you saw?
3-3.
Yeah,
And I
so
don't
we
look.
touched on this. Just Mel, just to
We
go
don't
for it.
know it's a short. We don't know it's a short. We don't know if it's a
Right.
buy.
But I just was
But
wondering the date.
yeah,
Yeah.
but at the same time, you have to pay attention. And I know that's why like you and I always connect and we go back and forth with so many things. And same with Jay. just because there's some familiarity there. When you start to see some things that are unusual, you got to kind of go, what the hell is going on?
Yeah, so
And
not to put on the tinfoil hat here, but what you're talking about with the
yeah.
flow in the front of this month,
Mhm.
from and there were other signs in some of the regional banking names in the first week of the month, combined with the fact that there were significant executive stock sales, combined with the fact that, and perhaps this is the most curious part of the equation, because we talked about this briefly yesterday. We didn't talk about it too much in detail on the space, but the idea that Y Combinator and Peter Thiel and the Founders Fund created this panic within the VC community to withdraw money at SIVB is odd. Not because there wasn't an issue, right? And we'll discover over the course of the next few weeks what other solvency or liquidity issues there might have been. But that's not why it's curious. It's curious because they are not idiots. Peter Thiel, whatever you may think of him, he knows markets and he understands the mechanics of these things.
Oh, he's
So
brilliant.
they
He has an
knew
equity hedge fund.
exactly. But Jay, we mentioned this yesterday, right? It wouldn't be surprising if some of these guys knew the impact that this would have and took short positions in advance of issuing these statements. I'm not, again, this is very assumptive and speculative. I'm not saying they did that or not, but it's interesting to pair the options flow, whether, again, and it's impossible to, as you know, to decipher options flow on whether it's truly long or short, but it's interesting to look at the options flow on the 3rd, the 4th, the 5th, the 6th, leading up to this, pairing that with the fact that executives of the company were selling droves of stock days before this happened, pairing it with the fact that this bank is particularly susceptible to a run on a bank because of the fact that less than 2% of the deposit, or less than 3% or 4% of the deposits are qualify for FDIC insurance, and they know that there's massive individual party risk here, that of a domino effect in withdrawals, which is exactly what happened, right? So
and
I don't know.
Stock Dog,
It
the
seems
biggest
like it was an easy target, right? The fact that it's at the dead bottom of that list of that
Right.
table I shared earlier, it seems like they knew it was an easy target. It seems like they knew that hundreds of companies involved with these funds were banking not by force, but being assuaded to bank with the same banking partner as a part of being involved with the fund. It's all fishy. I'm not again, I hate
yes.
to put on the tinfoil
Yep.
hat, but
It's
it's
very
No, I
fishy.
know. And the only reason I bring it up is because I went, KRE? What the fuck? Who? Wait, what? Like, and I went and looked at historical, because I never put anything out without a little bit of due diligence. Like, I don't do it for likes. I do it for like, wait, really paid. And I didn't even know how to play this. I went like, I don't even know names here. Did not capitalize 0% off of any of this move because I was so dumbfounded. And that's why I'm jumping on this space tonight, is to kind of get some education. Like, what the hell is going on here?
Yeah, no, I agree. Like we saw this with Silvergate as well, and it goes back to this idea
Yeah.
of you have internet banks, the first bank runs of the internet era, and these banks have a couple shared properties. Their customers are on Twitter. There was a taking advantage of the meme culture, for example, in Silvergate, where you saw deliberate disinformation from short sellers to take down a bank. And again, there are very few people that can rush to the defense of a bank. Like we all cannot go crowdfund a bailout for a bank. We can do that for any other public institution but a bank. And the reason why is if you own more than 10% of a bank, you are deemed a bank holding company and you're subject to supervision by the Federal Reserve. So I agree. And here's the other thing, like First Amendment is, which is a critical value and bedrock, of our civilization, society, or the rest. It does, it offers protection, and we have to ask ourselves: should there be a limitation on speech when there's a financial incentive? I think there should be. I think there needs to be a public policy debate around this because we've seen 2 banks go down, and again, Signature Bank has record put interest. And the age of internet banks means you've got the age of internet moving information, including fear, and that can cause a crisis of confidence.
Hey, so I got
This
just
is a
added
major
here.
issue. I agree with Ram. Anyone can call, a fire alarm
at a bank that's relatively okay and change perceptions and cause a bank run, in an environment where there's a lot of uncertainty. And there should be, if you have Mark Cahodes, on a Twitter space tomorrow saying that First Republic is going to go, bankrupt, you're going to see a ton of people, just because of his short seller background and what's happening in the market, take money out of the bank, and it could be for no reason. So I agree that there should be some limitations on what people can say and do. And I would not be surprised if Peter Thiel, had a short. I wouldn't be surprised at all.
Yeah, I wouldn't be surprised either. And I think, without putting too much speculation on, like, I've just been combing Twitter all day in the midst of this, and it's obviously difficult to verify everything. And so I've tried only tweeting the stuff that is verifiable, like, the percentage of the deposits, the fact that there was 42 billion in withdrawal requests yesterday, the fact that 30% of Y Combinator companies are exposed. So I've tried to only tweet the things that we actually know. But in terms of the things that are being rumored or chatted about, there are already companies that Y Combinator, Founders Fund, and some of these other funds have invested in, that members of the company, not necessarily the directors or CEOs of the companies, but members of the company, employees of the companies, are tweeting that there was chatter about this way before this decision was made, that there were quote unquote memos sent out to some of the top companies in which Y Combinator and these other funds had a significant stake, to withdraw their money before these public letters were issued over the course of the last 2 days that spurred the bank run. So again, if any of these things are proven to be true, right?
March 3rd.
Yeah, all the way through March 3rd, there's some of these going back. And again, these are just screenshots of people tweeting. So, I mean, I have no personal way to verify this, but if any of these things are actually validated to be true by regulators or people that look into this, which there will be plenty of people investigating this, that does constitute, illegality. I mean, if this was planned, right, and this many people are affected, that there are consequences there.
Yeah, I'll tell you right now. So we got a lot of companies that are tweeting out their particular liabilities within this mess here. Unusual Whales has collected those. Here are the ones that are publicly known. Roku had 26% of their cash or cash equivalents there. That was about almost $500 million. Roblox had some as well. Rocket Labs says about 8%. Kohu, I don't know Kohu. Sagamo Therapies, unknown, but it looks like about 34 million. DNA Ginkgo had about 5%. Umbrella, Quotient, 17 million and 400,000 respectively. BlockFi, 247 million.
Yeah, what really matters is obviously the percentage, and we went over some of those earlier, but it's really it's a combination of the percentage of cash and cash equivalents that are frozen, that percentage relative to the market cap, and then also, there are different levels of dependency on these credit facilities between these companies. Some companies are entirely dependent on the credit. Sorry, what did you say, Jay?
So some companies are burning cash, like you were saying. And
Exactly.
They need the credit
cash
facilities.
burn.
So
You're right. Sorry, you broke up in the middle of that. But yeah, the not only cash, there are just some companies that operationally, like there's some biotech companies specifically, and that's why a lot of the clamor today was in biotech. Even after hours, a lot of the filings were focused there, because those companies specifically, especially unprofitable biotech, again, I don't want to say they're fucked, but a lot of those companies are just not going to be able to turn around and find a source of capital to operate that is, meaningfully similar to this. And that's the issue, is when you combine that with frozen deposits, there's an inability to operate for a number of these companies, probably dozens of them, if not more, even publicly listed ones. And that's part of, I don't want to say the problem, but there's a lot of focus here on the fact that they're labeled as a venture capital bank. They're focused on venture capital. They are, but the venture capital market is not all that big, broadly speaking, especially considered to the relative financial system. I mean, it's a blip on the radar. But, these companies are also exposed to public companies. Now, Roku, 26% of cash and cash equivalents, that's significant. Some of these other companies, 6-7%, I don't know. The stocks might trade down a little bit, but I don't think it's, a cause for collapse. The question becomes, for the companies that have a combination of an inability to acquire a new credit facility while also having X amount of their cash frozen, those companies are in operational danger.
So Stock Talk, the main reason I wanted to jump on was not to throw slight at hindsight. That's never the thing that I
Oh
want
no, of
to
course
do.
not. I'm not
No,
saying you did
no,
that.
but absolutely. And I know you didn't. And I appreciate you bringing me on. What I would like to say is what I saw today, I have never seen. And I watch Darkpool, I watch Options Flow. I have a fucking eye for this. And what I have never seen in my life is how much leverage had Darkpool activity. And so I don't know if that means that this is a complete and I hate to be somebody that goes big move coming, but I don't really know what to say because I think everybody's trying to
What were the
digest.
dark pool prints versus the market cap? What were the
Okay,
sizes like?
nope. Jay, go pull up SSO. Look at that volume bar on SSO.
Got it.
Because you had 7.21 million share Darkpool print at 44.50 after hours. And then
Wow.
let's look at, okay, so that's a 2x SPY long. Let's look at QLD, which they were hitting in smaller lots, but you probably had about 7 million there as well. Let's go to UPRO.
Hey Mel,
And
while you're doing this, I know we have a wide range of people who have different experiences. I know there's people here who have no idea exactly what you're describing here. Can you give us just a brief 30-second overview of the dark pool?
absolutely, thank you. And I usually try to do that. So a dark pool is it is ominous and has a very bad rep. But what I would like to really impound on people is that it is a private exchange. There is a man behind the curtain, and usually that is your larger, bigger institutions. And while most people think that there's somebody driving something, it is really, in essence, a way for larger institutions to be able to facilitate larger trades without disrupting the market. And if you were trading when we had this about 2-3 years ago, RTOs.
Sorry to interrupt, but I just got that notice at the top that the host is having a connection issue. So the space is going to, the space is going to crash.
Well,
in a minute.
last piece of the news then, since if we're about to close out, but this is just hitting the headlines now. I'm trying to verify it, but apparently the CEO of Silicon Valley Bank was a director at the San Francisco Federal Reserve until today. Is that true? Does anyone know if that's true? I'm trying to look it up right now. Silicon Valley Banks.
That
If
would be
that's
really
true-
hard to believe. Typically, if you're in a bank, you're also not on the Fed side.
Yeah, let me see. So, former CEO. Oh no, not the CEO. Former CEO. Let's see.
That makes more sense. Former.
Yeah. Sorry, I don't know why I misquoted that. Let me read. Let me check though. The Fed.
So one thing that I just want to bring up really quick here, while you're checking on that, is
We'll be crashing in about 10 seconds.
No,
so keep
he
going.
is. He is the current chief executive officer at Silicon Valley Bank. Greg Becker was on the board of directors at